I'd like to call to order the Joint State and Federal Relations and International Insurance Committees. First thing I'm going to do, I know we have a lot of people joining us on Zoom virtually, and I'd like to have legislators that are on Zoom please introduce themselves. And I know you're going to do it one by one, but just somebody pipe in, be the first.
Kevin Cahill, New York.
Assemblyman Ken Cooley out in California. Good morning.
Morning.
Deborah Ferguson, Arkansas.
Jim Gooch from Kentucky.
Lana Tice from Michigan.
We good, Will? Yeah, I think we're good. So now I'd like to take a roll call. I'm sorry, Paul. I'll wait a second. Sorry, Paul. Anyone else on Zoom to introduce themselves? Normally we take a roll call, but I thought we'd just go around the room. Roger, if you'll start, just introduce yourself. Where are you from?
Roger Pickard from Rhode Island.
Thank you.
Ronnie Cromer from South Carolina.
Ken Blankenbush, New York.
Thank you.
Justin Hill, Missouri.
Jim Dunnigan, Utah.
Steve Westfall from West Virginia.
Kevin Coleman from Michigan.
Sorry. Yeah, you know, for Ohio and Michigan, we have these nice rivalries, but my little brother played football for Michigan, but my dad and older brother, my dad was an All-American at Ohio State, and so we have great family rivalries between Ohio State and Michigan. I'd like to first ask for a motion that we waive the quorum. If someone will make that motion, if I can have that, please. Yeah, Roger moved. Can I have a second?
Second.
Yeah, all in favor, please say aye.
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 Thank you. And opposed? None. We've waived the quorum. We'll get right into the meat of the individual. So the first topic of discussion. Oh yeah, I've missed one thing. That's why Will's here. Everybody, if you'll please review the minutes from our last meeting to see if there are any corrections or additions. And it doesn't look on Zoom. I don't think anyone said anything on Zoom. So in Ohio, we just basically say if the minutes will stand as approved, we won't need a motion. Okay, now we'll get into the meat of the discussion. The first discussion we have is on the new federal balance billing law on the No Surprises Act. And Chris Garman's a PhD from senior consultant from Compass Lexicon. He's an assistant professor of health administration in the University of Missouri. And Ohio is one of those states, we passed a law in December, and a lot of the questions are coming up about how the state and federal legislations work together. So Chris, can you with us?
Yes, can you hear me okay?
We can, and you're on. We see you're on the screen, and your place cards are on the screen. So we're good. Go ahead.
Excellent. Thank you. And thank you for giving me the opportunity to present today. I'm going to be talking about, excuse me, I'm going to be talking about the No Surprises Act and its relation to state surprise billing laws. The No Surprises Act protects patients from surprise out-of-network medical bills and regulates the payment disputes between health plans and out-of-network providers. So what is a surprise medical bill? A surprise out-of-network medical bill is when patients receive treatment unexpectedly or involuntarily from an out-of-network provider, and then they are sent a bill requiring that they pay the difference between the insurer's payment and the provider's full charges. So this can occur in a number of situations. The most common that you hear about in the press, say you break your leg and you need to go to the emergency department. You go to the ER for the nearest hospital in your network that you know is in your network, but it turns out that the physician treating you is not in your network, and you end up getting a balanced bill later on. One of the first examples from the past 6 years or so that got a lot of press was from the New York Times. Elizabeth Rosenthal documented a case of an elective out-of-network bill. So this patient was very experienced with how our health system works. This patient made sure he needed an elective neck surgery. The patient made sure that the hospital was in network, made sure that his surgeon was in network, even went so far as to make sure that the anesthesiologist on call that day would be in network. Goes into the surgery, is put under general anesthesia. The surgeon calls in a secondary surgeon who turns out to be not in this patient's network. And then a few weeks after the surgery, the patient gets sent a bill for over $110,000. So these surprise out-of-network medical bills can occur in elective situations. And they can also occur related to emergency transport with either ground or air ambulances. So how often does this occur? Well, our research has found that the ambulance cases, it can occur quite often. In air ambulance cases, roughly 60% of the time, there's the potential for an out-of-network balance bill like this. Ground ambulances, about 50% of the time. So it's basically like flipping a coin if you need emergency transport with an ambulance. Emergency department cases, somewhere between 1/4 and 1/5 of the time can have surprise bills. But then even in elective inpatient cases, such as obstetrics cases, roughly 9% of the time, you can have a surprise out-of-network medical bill. The financial burden on patients for these can be extensive. So research that we just published last week shows that for emergency department patients that are hit with a surprise out-of-network bill, they end up paying on average over 10 times more than other emergency department patients where all of the care was in network. So this has understandably led to a push, bipartisan recognition that we need a solution. And many states have passed balance billing laws, but of course they only cover a certain portion of the commercially insured population. So the federal government finally responded by passing the No Surprises Act, which is federal prohibition against surprise out-of-network bills. It was included in the Omnibus COVID Relief Bill in December of 2020. It protects patients from balance bills in emergency situations, in elective procedures where there are, for instance, an out-of-network physician and an in-network hospital, even for a scheduled surgery, when there is not prior approval for that out-of-network physician. And even in that cases, there are exceptions where certain specialties like anesthesiologists and radiologists are prohibited from balance billing with or without prior approval. And then it also prohibits balance billing in air ambulance cases. Those balance bills can be quite extensive and extreme. Patients are not protected from ground ambulance balance bills. So that is one area that is not covered by the No Surprises Act. The NSA establishes an independent dispute resolution process subject to baseball-style final offer arbitration. I'll talk more about that. And then these protections don't start until January 1st of next year. So I wanted to talk a little bit about the independent dispute resolution process that is in the No Surprises Act. The first step of that, after a patient is treated by an out-of-network provider, the insurer must send payment to that provider within 30 days. What's important to note, many of you may be aware of the greatest of three rule that was part of the ACA that regulated out-of-network emergency payments from insurers to providers. That it no longer applies. The No Surprises Act amends the 2719A section of the Public Health Services Act, which the greatest of three rule was part of. So this process supersedes the greatest of three rule, so that will no longer apply. So the insurer could send any payment, could be very small, could be the entire charges, whatever. So there's no regulation on what that initial payment is. If the provider is dissatisfied with that initial payment, the provider can initiate this independent dispute resolution process. Starts with a 30-day negotiation period, followed by that final offer baseball style arbitration, where the arbiter has to pick one of the two proposals. The arbiter can't select some amount in between them. The claims can be bundled as long as they involve the same provider, the same insurer, and the same service. The losing party pays the cost of the arbitration, and then the arbitration cannot be used for another 90 days after an arbitration hearing for the same provider insurer service combination. So the independent dispute resolution process in the No Surprises Act is really designed to get the parties to the table and settle before arbitration. So the hope is that arbitration will be rarely used and that these disputes will be settled beforehand. So what factors can the arbiter consider? First, the arbiter in the legislation is specifically prohibited from relying on charges, including percentiles of the charges, the UCR, usual, customary, and reasonable rates, and Medicare and Medicaid rates. What can the arbiter rely on? The arbiters can rely on the median in-network rate, and there's a lot in the No Surprises Act that suggests this will be the benchmark that arbiters will often use. So the median in-network rate they can rely on, prior contracted rates between the insurer and provider that are the subject of the arbitration hearing, market shares of either or both parties, patient severity of that case, and the provider's training, experience, the provider's quality, if this is a hospital, the teaching status of the hospital, the case mix of the hospital. So many things that the arbiter can rely on, but the arbiter cannot rely on charges or Medicare or Medicaid rates or the UCR rates. So there are a few other things that in air ambulance cases, the arbiters can rely on the vehicle type and make the judgment conditioned on the vehicle type and the population density at the pickup location. Air ambulance providers will be required to submit cost and charge data to the federal government, and the No Surprises Act also establishes an advisory committee on air ambulance quality and safety. So how does this relate to state laws? So as many of you already know, state laws only apply to those health plans that are state regulated, the fully insured health plans. The No Surprises Act will apply to all health plans, fully insured and self-insured. And so it preempts state law with certain exceptions, which are explicit in the No Surprises Act. So the exceptions are the methods for determining out-of-network payment. If a state has its own IDR process, for instance, or it uses its own benchmark to determine that out-of-network payment, the state can continue to do that. Fully insured health plans in that state can continue to use the state's process for determining that out-of-network payment. If the state already regulates provider directories, the fully insured health plans in that state can continue to follow that regulation over on provider directories. And the state law is allowed to exceed the patient protections in the No Surprises Act. So for instance, if a state law prohibits balance billing for ground ambulance cases, then the state can continue to do that. It's the No Surprises Act does not preempt state law when that state law exceeds the protections of the No Surprises Act. So the states can go beyond the protections of the No Surprises Act. So there are still many remaining questions. The final rules have not been set for how this will work in practice. So we're still waiting to hear from the Department of Labor, Treasury, and HHS how this will work, how the No Surprises Act will be implemented. But many remaining questions. What about state laws, for instance, in Virginia? This is the case. What about state laws that allow self-funded plans to opt in? Could those self-funded plans choose the payment dispute resolution process that they find most favorable? Sort of pick and choose, we'll go with the state or we'll go with the federal, depending on which one is more favorable. The legal scholars that I've read suggest that the regulations, HHS and Department of Labor will probably come down and say that no, self-funded plans cannot do that, and they have to follow the federal dispute resolution process. But that's still an open question until we see those final regs. What if, like in my state of Missouri, what if the state's arbitration process is optional or non-binding? Would the No Surprises Act preempt state law in that case? So we'll have to wait and see what HHS says there. What happens if a state patient residing in one state sees an out-of-network provider in another state? This seems to be the perfect example of a situation where federal law should apply, but it's not clear from the statute itself whether the provider's state law, if this is a fully insured plan, whether that would apply, whether the patient's state law would apply, or whether the federal law would apply in that case. And then, of course, there are many parts of the dispute resolution process that will have to be detailed by HHS, Labor, and Treasury. For instance, how will the arbiters weigh all of those different factors? How are they supposed to weigh market share, for instance? That's a big question mark that many people are wondering about. How will they weigh those different factors in coming up with, in picking one of those options from the providers and the insurers? Last thing I wanted to go through, some of the research on the effects of state laws. So I was asked to briefly describe some of the research that's been done. Not much research has been done on the effects of the state laws. Probably the best research that I know of on this, with the best research design at least, and covering the most outcomes, Zach Cooper, Fiona Scott Morton, and Nathan Shikita's paper last year, looking at New York's surprise billing law. They found that it led to a reduction in out-of-network bills and a 15% reduction in in-network cases. This is the only paper so far that's looked at how a state law has affected the negotiations between providers and insurers and that in-network price, because it can affect the leverage of one side or the other. And they found a 15% reduction in in-network prices. However, their data is only using one insurer, and they only had 3/4 of data after the implementation of New York state law. So there's still room for more research on New York state law. And in particular, Lauren Adler looked at the arbitration awards from New York state law and found that the mean arbitration award exceeded the 80th percentile of charges, which suggests that New York's law should be inflationary and should lead to an increase in network prices. So the Cooper, Scott Morton, and Shikita paper seems to contradict Lauren Adler's research. So again, suggests more research needs to be done about New York's law. Lauren Adler and other co-authors also looked at California's surprise billing law, found that it led to a drop in the number of out-of-network claims. They have ongoing research about some of the other effects of California's state law. Ben Chartok, a PhD student at UPenn, looked at New Jersey's arbitration awards and found that they are clustered around the 80th percentile, which is no surprise because the arbiters in New Jersey are shown the 80th percentile of charges. And that's one of the things that they can use in choosing the award, in choosing which proposal to accept. And then finally, just in the past few weeks, Sabrina Corlett and others at Georgetown looked at New Jersey, Texas, Colorado, and Washington's independent dispute resolution processes and found that New Jersey and Texas handled thousands of arbitration cases, whereas Colorado and Washington, the IDR process was rarely used. And the only difference between those two sets is that New Jersey and Texas, in those cases, the arbiter can rely on the provider charges. So suggesting that providers are using that more often to settle disputes. And then finally, I can share these slides with all of you. Just let me know. I've already shared them. I believe I've already shared a draft version of this, but if the references and additional resources are included at the end of the slides. With that, I'll take any questions that anyone has about No Surprises Act or the research that's been done on state surprise billing laws or anything.
Chris, we appreciate it. And before I turn it to the committee on questions, I have a couple. When I was really involved in Ohio, one of the things that we like in Ohio on our resolution process is that we didn't want, and I know baseball arbitration is a giant term, but we wanted to make sure negotiations went on strongly, and then that when it got to the arbitrator, they had to submit their last, the last offer. We didn't want it to ever go back between, because if you have these wide differences as it is when you started, and it showed like up to 10 times, is, in reality, you're making winners and losers. And so we think we were real successful in Ohio because we don't want to create an arbitration system where everybody's running to arbitration all the time. And so we wanted it to be fair. Our Department of Insurance Commissioner, she did a phenomenal job of bringing the IP people together, and the providers and the plans got together and they finally agreed on a plan. And the feds did the same thing. But one thing that really helped us with the emergency room was the ability, doctors, was ability to go back and look at previous network charges. Because one of their concern was they'd have a network phase, and then the new network, they didn't have any really negotiations, and the network charges were reduced and reduced. So the arbitrator has the ability to go back over the last several years and look at what actually was paid in network. But that was the only question, is on baseball arbitration. Do they mean, is the federal law, does it mean that they take the last offers?
Yes.
How do they handle that? Do they take?
Yes, it's final offer arbitration. They can only take, they have to choose either the provider's offer or the insurer's offer. They can't split the difference. As you mentioned, the prior contracted rates, that's one of the things the arbiters can consider. So, again, the hope is that this arbitration process will be rarely used. And I think it's been designed that way. We'll have to wait and see how often it actually is used. I think it's been designed, with a 30-day cooling off period, a prohibition against going back in for 90 days. I think it has been set up so that it encourages a settlement beforehand, so that the arbitration will be rarely used. But we'll have to wait and see.
In Ohio, they have it's broken down on who pays for it. I think it's 3/4 and 25%. How do they do it in the feds?
Yes. So the losing party pays the cost of arbitration. Both parties will pay a fee to cover the federal costs of just administering the system, but the losing party will pay the arbiters' costs.
And I think in Ohio, it's split, but you're right. The loser pays more than the winner. It's not a 50-50 split.
Yeah.
I'll go ahead and turn it over. Any other questions? Any questions from the committee? Yes, sir.
Jim Dunnigan, Utah. So I have a question. You said that a state can be more protective than the NSA. Did you say they could be less protective?
No. So if the state's law is less protective, then in those situations in which the federal law applies, but the state does not, then the federal law would apply. The federal law would preempt.
All right. So if one side or the other is unhappy with the federal law, they could not successfully pass a state law that would supersede that and water it down beyond the federal protections.
That is my understanding. That's my understanding. The only area of uncertainty there, again, is in the cases where there is a state law that allows a self-funded plan to opt in. And we'll have to wait and see whether it's possible for that self-funded health plan to basically kind of pick and choose which system. depending on, which it sees as more favorable in terms of the payments. But in terms of the patient protections, the state cannot pass a law that would protect patients less than the federal law. The federal law would preempt in that case.
Okay,
That's
and
my
this
understanding.
also applies to non-network ER.
Yes, this applies to out-of-network ER facilities. It applies to, out-of-network ER providers, whether facilities or physicians, and elective out-of-network providers, for instance, physicians. It applies to them as well. All of them without prior approval, but then certain specialties it applies in a blanket fashion, like anesthesiologists. An anesthesiologist cannot get prior approval to bill out of network, for instance. It applies to them regardless of prior approval or not.
My last question regards air ambulance. I think many of the air ambulance providers do not have contracts or not in network. So how does that work if the majority of them are not contracted at all?
So in an air ambulance case, the insurer would send a payment to the air ambulance company within 30 days. And then if the air ambulance provider is not satisfied with that payment, they can initiate this independent dispute resolution process. Since most air ambulances are out of network, it will be interesting to see how HHS and the Department of Labor determine that median in-network rate. That would be one of the things the arbiter could consider. And I also, I forgot to mention, the median in-network rate is what will determine how much the patient owes. So their cost sharing will be based on that, their typical in-network cost sharing based on that median in-network rate. So it'll be interesting to see how the HHS and Department of Labor determine that median in-network rate for air ambulance cases, given that so few are in network. But we'll have to wait and see what rule they will use for that.
Thank you.
Thanks, Jim. Next one in line is Kevin Cahill from New York. Go ahead, Kevin.
Thanks, Bob, and thank you, sir, for your presentation. I apologize. I might have been a little distracted while you were giving your presentation here, having a few technical issues. But my question goes back to the tools that the arbiter has in the determination of what is the appropriate fee. Am I to understand that the arbiter cannot refer or use as a guideline UCR or Medicare and Medicaid rates?
That's correct.
And what is the logic behind not allowing them to be considered?
This was all politics from my understanding. So the health plans obviously would like for Medicare and Medicaid rates, since they tend to be lower than commercial rates, for those to be used as benchmarks. The providers obviously would like to have their charges used as benchmarks because they tend to be higher. So in order to get this bill passed, the big compromise was to explicitly include in the bill that arbiters cannot rely on charges and cannot rely on Medicare and Medicaid rates, and also cannot rely on UCR rates.
So if a state has a more comprehensive system, one that gets past the federal preemption, could that state then also use UCR, Medicare, Medicaid rates and other indicia that could lead to a balanced determination by the arbiter to arrive at the appropriate conclusion?
Yes, the state can use its own. The state can use its own method for determining that out-of-network payment for those health plans that the state regulates, those fully insured health plans that the state regulates. The No Surprises Act explicitly includes that exception to the blanket preemption of state law. So the state can continue to do that. Yes.
Are there, and Bob, this is my last question, are there any other restraints upon state regulators, legislators, and state insurance regulators to regulate state plans beyond the things that you previously stated?
No. Again, the state can use its own method for determining the out-of-network payment. If the state has its own regulation of provider directories for fully insured state regulated plans, it can continue to do that. And if the state's protections go beyond the No Surprises Act, it can continue to have those protections. The state cannot have, I mean, the state could pass a law that is less protective of patients than the No Surprises Act, but in those cases where they don't overlap, the No Surprises Act would preempt state law, and patients would be protected.
Just Bob and colleagues, just as a quick aside, I got a surprise bill a few months ago myself, and I chose, instead of just calling the provider and saying, "Hey, Joe, my friend, I got a surprise bill from your practice," I filed a claim just to see how it would work. And it was like kryptonite. The providers and the insurance companies just jumped to attention, and they took care of me right away. And it was better than trying to pull some strings. So just to advise colleagues that these programs do actually work. They are taken seriously by both providers and insurers. And I think it behooves us to fill in any of the gaps and make sure that we can get the consumers out of the mix altogether whenever possible.
And there was something I failed to mention. The No Surprises Act explicitly prohibits the provider from even sending a bill to the patient. So patients should not even be aware of what's going on. After this starts in January 1st of next year, patients should be unaware of anything. They should not get a bill even in the first place.
I have a question is, and the federal thing is we see where the ground ambulance were not included, but in Ohio, they were included. And then there was a major push at the end to try to get them to opt out. So do you know the thought behind of why the ground ambulances were not included?
That's a great question. I'm not sure. What I've heard is that because in many jurisdictions, ground ambulances are provided by local government entities, that it was legally tricky to prohibit ground ambulances. But again, I don't quite understand that because some states have been able to do it. But for whatever reason, ground ambulances are not included. The bill does set up a committee to study ground ambulance cases. It calls on agencies, certain agencies, to submit reports on ground ambulance balance billing, but it doesn't protect it. And the only thing I've heard is that it's because of that that interaction with local governments that often provide the service.
Well, Christian, just give some input, is the biggest complainers were the private companies because of the ones that were tied to the local governments, the fire departments and the local EMAs, that they were separate. Is that many times they had levies and they had different negotiation and different deals. So they didn't feel it was a level field. And so they're actually talking about bringing legislation back. And I just was curious to see, because we know when we get back that legislation is going to come back again to try to.
I hope so. That's the big missing piece in this piece of legislation, that patients aren't protected from ground ambulance balance bill. So I hope that is changed.
Thanks, Chris. Any other questions? Not. Chris, thank you. It was great.
All right. Thank you.
You have a good day. Second issue that we have is the discussion on the UK Supreme Court decision on business interruption coverage test case. And we have Matt Brewis, who's the Director of General Insurance and Conduct Specialist, Financial Conduct Authority, FCA. Matt, you should be online. And we're hoping he's on, Will. Okay. Matt, are you on mute? Yeah, Matt, are you on mute?
Can you hear me now?
Hear you now. You're good.
Hi. Good morning, everybody. And thank you very much for inviting me again to speak to you about our case. So when I last spoke to you, I think at your full meeting, we had just received a judgment from our High Court, which then went on to the UK Supreme Court. And so I thought what would be helpful is just to update where we've got to and kind of cover the main issues that have come out of the court case. So just to recap a bit of background, in the early days of the pandemic, a number of issues were brought to our attention about business interruption insurance policies and how insurers were handling claims. Many businesses were seeing closures and disruptions to their day-to-day business and were making claims for their losses under their policies, expecting to be covered. But the handling of these claims where insurers were rejecting them out of hand raised serious concerns about the contracts when it wasn't explicitly clear in the cover that it didn't cover pandemics. And so we determined that the best and quickest course of action would be to ask a court to judge and interpret contracts, a number of contracts with clauses in which could be read across as many firms as possible. So what we did was we took 8 insurers' wordings, and we chose those 8, not necessarily because they were the most egregious cases, but because their language was similar to language used by the 60 or 70 other firms that write business interruption insurance in the UK. So we used those words and we went through the courts with an aim to get clarity one way or the other, whether in favour of the insurer or in favour of the policyholder, as quickly as possible. So the test case focused on non-damage BI clauses. Many policies in the UK are damage ones. So if you have a fire or a car goes through your front window of your shop, but non-damage ones typically refer to, if you're a restaurant and your chef gets salmonella, or there is a murder on the street that your shop is in, and therefore you can't get access to your building. That's the kind of typical local reason why people might have such cover. But as I say, it was not apparent that that these policies did not also provide cover in the intent of a pandemic. So, as I said, when I spoke to you last in September, the High Court had just handed down its judgment in our test case. And what the High Court decided was that most of the clauses that we had around disease and prevention of access, these were and should have provided cover. So on the big elements of the case that we took, the FCA won on those points. And so at that point, we tried to reach an agreement with the insurers, but for a number of reasons, 6 of the insurers decided that they would like to make an appeal against the judgment. And so we have a process in the UK where if certain conditions are met, you're able to leapfrog various layers of the court system. And we went straight to the UK Supreme Court, who heard in December last year. And in January, they handed down their verdict, which effectively every element that we had won on at the High Court, we continued to win on. Those appeals by insurers weren't upheld, and those elements where we had appealed against what the High Court had judged on behalf of insurers, we won those appeals. And so to a very significant extent, for those elements that we took through the courts, the Supreme Court decided in favour of the policyholder. So what does that mean? Well, it found, if I take a few examples, the trends clause. So in the UK, the Prime Minister went on the news and said, please don't go out anymore. Don't go out to restaurants, don't go shopping. But the legislation that stopped businesses opening in the UK did not pass for another fortnight. And so what insurers were doing was saying, well, if you take the 2 weeks prior to when your business closed, i.e. when you're forced to close by the government, your footfall or your number of covers in your restaurant was at 30% of normal volume. Therefore, we'll pay out at 30%. The Supreme Court said, no, that's not right. Our view is COVID, the pandemic, was the cause of your disruption, and therefore you should take into account the full impact of COVID, and that includes things such as the Prime Minister announcing that people shouldn't go out, so you should compare it to, say, the same calendar period a year previously, as opposed to the 2 weeks just prior to lockdown. It also decided on a number of issues, such as there were some interesting decisions, such as if you were a restaurant and you had been forced to close because of the government, if before you were forced to close, you had started a takeaway business, or you had a takeaway business as that restaurant, then the cover wasn't provided. Whereas if you started up the takeaway business during the pandemic, then you were covered. The Supreme Court threw that argument out and said actually partial closure of premises as well as full closure should be covered. And then finally, probably the biggest impact more broadly on the insurance industry has been the Supreme Court overturned the Orient Express case. And for some of you may be aware that this case relates to a hotel in downtown New Orleans, which was damaged by Katrina back in 2005, but was repaired more quickly than the surrounding area. And when they tried to open and didn't have any business because of the damage to the infrastructure around, the insurer said, well, you know, you may be open, but nobody's going to be coming anyway, therefore your cover isn't valid. And that was upheld at the time by the courts. The Supreme Court found that decision was, in its belief, it was incorrect. And so from a UK perspective now, it relates not just to the immediate cause, but also wider causation of what has caused a business to close. And so this will have an impact on clauses and insurance contracts written in the UK and by things like the Lloyd's market that relate to wide area damage, so hurricane, flood, and pandemics, were we to have any in the future. So what are we doing now? So insurers are now making payments. We're publishing something we don't normally do, but we're doing in this case because of the amount of public attention this is receiving, the number of claims on a monthly basis that insurers have received and the amount that they've paid out. So as a result of the Supreme Court judgment, they've so far paid out about $1 billion equivalent as a result of our case, and over 50,000 policies so far have been accepted, but as yet decisions not, the total quantum of payout is yet to be decided. So these numbers will obviously grow, and we'll continue to push that. And more broadly, one of the lessons that we and other regulatory colleagues in the UK are focusing on is contract certainty as a bigger issue. There are, in our minds, whether it's pandemics, whether it's something like cyber insurance, which is still relatively new and not necessarily, you can imagine a similar situation to which we have now for this occurring for something like that with a wide cyber attack, for example. How can we ensure that contracts are written as clearly and with as much certainty for both policyholders and providers without being 300 or 400 pages long of exclusions? How can this be done as effectively as possible? And I think that's an issue that the industry globally is also very alive to and focused on. I'm sure you are as well. So I'll stop there, but very happy to answer any questions that you have. Thank you, Mr. Chairman.
Yeah, and Matt, thank you. This is, I know, the second time, and you've been great. Yeah, the only question I had, and I think you emphasized that, if the policy basically said there in black and white that it excluded, there's no way the courts were going to overrule the policy. It was only in cases where it just wasn't mentioned. It was an assumed type of coverage. Isn't that correct?
That's correct. Some had explicit lists of diseases that weren't covered. So it might include SARS, for example, but it didn't say COVID. So there were arguments that, well, SARS is a bit like COVID, so but in the main, this was not. If it said this does not include pandemics, those aren't. Those were never covered by this. This is where it was silent on the issue.
Okay, yeah, thank you. Any questions at all? I think we're good. Matt, thank you. Thank you very much.
No problem. Thank you, everybody.
Have a good day. Thanks for joining us. Our last discussion is discussion on the ERISA preemption in light of SCOTUS decision in Rutledge versus PCMA. And we have Professor Elizabeth McCuskey from the University of Massachusetts School of Law. And I know she's getting set up. She's on.
Hi.
Good. We see you and we see you in the background. That's
excellent. Good. Excellent. So I'm delighted to join you this morning to talk about some good news for state healthcare regulation and the ERISA preemption puzzle from the Supreme Court in December of this year, the Rutledge versus Pharmaceutical Care Management Association case. Who doesn't want to talk about ERISA on a Friday morning? So for this case, we're basically starting with the old ERISA law, federal statute passed in 1974, with this extraordinarily broad preemption language that has been an obstacle to state health reforms of all different kinds since then, because the statute preempts any and all state laws that relate to any employee benefit plan. The Supreme Court and federal and state courts' attempts to apply this inscrutably broad phrase have developed a very complex and opaque set of precedents that make litigation against state health reforms, or at least the threat of litigation, almost inevitable, and the outcome of many of those litigation challenges unpredictable. So even state laws that withstand ERISA preemption often face the headwind of litigation. Enter a law from Arkansas that is regulating PBM, or pharmacy benefit manager, reimbursement practices for pharmacies. So this was a law that essentially requires pharmacy benefit managers, the third-party contractors with a lot of health plans, to pay pharmacies no less than the pharmacy's acquisition cost for the covered drug. In other words, this was an effort primarily to save independent and rural pharmacies from the verge of bankruptcy for underpayment through these PBM intermediaries on behalf of health plans. In retrospect, this emphasis on how to prop up independent and rural pharmacies plays an even more important public health effect when we look at the success that particularly West Virginia had in rolling out its COVID vaccination strategy using these kinds of independent and rural community pharmacies. I think we have Delegate Westphal in the live audience. He can probably attest to the success of that. But the question about this seemingly rather narrow state law was litigated all the way to the Supreme Court on an ERISA preemption challenge, namely whether ERISA preempted Arkansas and other states who have similar laws from enforcing this PBM reimbursement practice. So with the trip to the Supreme Court, we should applaud this group. NCOIL participated at the Supreme Court as amicus and had a very persuasive amicus brief explaining to the Supreme Court the ways in which ERISA frustrates health policy at the state level and the ways in which ERISA preemption jurisprudence should not apply here. The Supreme Court agreed with NCOIL, at least in the holding of the case, unanimous opinion authored by Justice Sotomayor, stating that this state law was not preempted, particularly because it did not sufficiently relate to the employer-sponsored insurance plans that were challenging its application. The holding at the Supreme Court indicates the Supreme Court's unanimous view on how much federal uniformity ERISA demands. And the answer was not that much. So the Supreme Court explained in this majority opinion that ERISA's preemptive effect, creating federal uniformity, is primarily targeted at plan structure, benefit choices, and beneficiary status. So these kind of core aspects of plan administration or central features of plan administration. And the Supreme Court said that ERISA does not preempt state rate regulations that merely increase costs or alter incentives for ERISA plans without actually forcing those plans to adopt any particular scheme of coverage or substantive coverage. So this is an important clarification of a notoriously opaque area of Supreme Court precedent. And it gives states, I think, some running room to enact all kinds of different healthcare regulations that are aimed at cost control and affordability for patients, which are typically, kind of the primary aims of a lot of state healthcare regulations these days. So in particular, the court notes that crucially, not every state law that affects an ERISA plan or causes some disuniformity in plan administration has an impermissible connection with an ERISA plan. And it particularly singles out state regulations that merely affect the cost of administering a particular plan. So ultimately, the logic of this decision and the way that the Supreme Court approached its unanimous decision, I think first reanimates a 1995 case called Travelers, which was about state regulation of hospital billing rates and said that that was not preempted. And it expands the logic of Travelers and explicitly says the logic of Travelers dictates the outcome in this case. And in doing so, it really outlines a broader category of state regulation that is outside the bounds of ERISA preemption, namely healthcare cost regulation. So it provides a very good Supreme Court precedent and explanation of why healthcare cost regulation might not sufficiently relate to these core functions of plan administration and therefore not be preempted. It also focuses on the role of the PBM as kind of an intermediary or a contractor with the plan itself, and explains that state regulation of this intermediary, of the pharmacy benefit manager, as opposed to the actual plan, does not directly regulate health benefit plans at all. So the opinion seems also to carve out space for state regulation of health plan intermediaries, as opposed to direct regulation of the plan itself. And perhaps most useful and maybe most important in the logic of this opinion is that it singles out issues that are not covered by ERISA regulations as a space in which states should feel more confident in filling in their own regulations. This is a slightly different approach to ERISA preemption than several of the most recent Supreme Court opinions. So ERISA, the federal law, does not fill in the entirety of the field of health plan regulation, of employer health plan regulation. It leaves a lot of gaps. Many, many issues have no federal law at all from ERISA. The broad language of the statute in ERISA seems to say that states can't regulate in that space either. But this opinion and Justice Thomas's concurring opinion in this case make clear that the thrust of ERISA preemption is to make sure that states are not conflicting with ERISA regulation. And so there should be additional space for states to fill in areas that ERISA doesn't actually cover. And this is also important because it narrows the holding of the Gobet opinion from the Supreme Court in 2017, which held that Vermont's effort to collect all-payer claims data from an employer self-funded plan's third-party intermediary was preempted. But the Supreme Court in Rutledge clarifies that that's mostly because the claims data is a core feature of plan administration, and most importantly, the claims data collection is covered by some ERISA regulations and could be administered by the Federal Department of Labor. So there's less space for a state to regulate there than on this PBM regulation. So thinking even more broadly about the implications for state healthcare regulation of this unanimous Supreme Court opinion from December, the categories of state efforts that would be well served to rely on the kind of logic and the language from the Rutledge case include PBM regulation writ large. So there are all kinds of things that states might want to regulate about PBMs. And there are 45 different state regulations on PBMs. They range from PBM gag clauses to transparency on their rebates to limits on patient cost sharing and spread pricing. The language and the logic of Rutledge, I think arguably, place PBM regulation outside of the sphere of ERISA preemption because it's not directly regulating the health plan. It's simply regulating a contractor or some third-party intermediary. In addition, by focusing on cost control regulation or the mere impact of costs, the opinion suggests that I think there's a broader category now of healthcare rate regulation that would be outside of ERISA preemption, and that broader category includes both provider rate regulation from the 1995 Travelers case and the slightly broader category that would include also prescription drug rate regulation after the Rutledge case. Other aspects of state healthcare regulation aimed at cost control that might have some indirect economic influence on the cost or administration of plans also would fit within the sphere of protection that the Rutledge case offers. That includes all kinds of consumer financial protection laws in healthcare that states have passed, including surprise billing legislation, air ambulance legislation. And as Professor Garman explained, the federal No Surprises Act, the federal balance billing or surprise billing legislation offers a federal floor on what the protection for consumers would be against surprise bills, but it leaves room for states to add protections. The adding of protections on top of the No Surprises Act would ordinarily be subject to ERISA preemption analysis. So the No Surprises Act explicitly says we're not altering ERISA preemption. But the language of Rutledge and the logic of Rutledge would suggest that even though the No Surprises Act forgoes any effect on ERISA preemption, that there is space for states to add on top of that. So even more broadly, the state efforts at cost control and affordability that have become so urgent for state regulation particularly over the past decade are well served by the language and the logic of this Supreme Court case, which takes cost control and puts it well within the state sphere of authority, and also explains that some influence on the cost or administrability of an employer-sponsored plan does not doom a state regulation to preemption. Now, of course, Justice Sotomayor reminds us that actual benefit requirements, beneficiary status, and these core features of plan administration, or the actual forced choice of a plan to adopt a particular coverage scheme, are still preempted by ERISA. But there's a lot of important stuff that is even bigger than consumer financial protection that might fit within the language of Rutledge, particularly state regulation of third-party administrators and possibly even the state's establishment of public access plans and attempts to collect contribution from employers. So this is good news. This is some running room for states. The Rutledge decision gives states more latitude, I think, by clarifying the limits of ERISA preemption and leaves states more space to pursue healthcare cost control measures and improve affordability for consumers without necessarily facing the headwinds of ERISA that they used to. So overall, Rutledge versus PCMA is a pretty unequivocal win for state regulation, but leaves the underlying obstacle of ERISA's statutory language in place. and it leaves in place 4 decades of maddeningly incoherent attempts by courts to apply it. And so there is still, I think, a need for Congress to revisit ERISA with an eye towards perhaps adding a waiver or giving states some explicit statutory room to ask the Department of Labor to give its imprimatur to particular state experiments and remove the remaining uncertainty of ERISA preemption litigation. So ERISA reform as health reform is a drum that I beat every time that I am on stage. So that is why I am beating it here again. I have a few references that I'll leave here in the slides, including an article about Rutledge, as well as a ready-made ERISA preemption waiver legislation article. And I will commend to you the 2019 resolution of this group to ask for Congress and the Department of Labor to give states some much needed relief for ERISA preemption and some much needed clarity through adding a waiver to the statute. I'm happy to talk about any questions or hear your thoughts on the future of state health reform after Rutledge.
Thank you, Professor. Great job. Any questions from the committee here or on virtual? Anyone? Yes, sir.
Thank you, Professor McCuskey. This is Delegate Steve Westfall from West Virginia. Very informative. It's important to all the states, state of West Virginia for sure. But on a side note, our state auditor, JB McCuskey, wanted to tell me, my good friend, say good morning to you, his little sister. So thanks for being here today.
My pleasure.
Thank you. Yes, sir. Yeah, and I knew you would have a question, and I thought, boy, I hope Jason. All right.
They holding me outside the door trying not to let me in.
You know, Jason pushed for PM legislation in Arkansas. So,
yeah. Well, thank you, Senator Hackett. And I guess my question on behalf of myself and my heir apparent here to the Senate Insurance Commerce Committee, Senator Matt Pitch in Arkansas. I just, I did want to make a comment and ask because I got in on the tail end. But first of all, I just want to esteem NCOIL because for the first time in many, many years, NCOIL authored an amicus brief, which was important to this case and weighed in at the national level. And that was a big decision for all of the officers in the board at the time to take that step. And so I don't see Tom in front of me here. I may have walked right past him, but I want to esteem Tom Considine, his leadership with Will at NCOIL to put that together. It did make an impact. And we referred to that many, many times in some of the discussions and debates. What I wanted to ask a question about, we know the impact in the PBM space, but I'm interested, if you haven't already covered it, and if you have, just give me a snippet. How are you seeing this as it relates to impacting other areas? Because this really is a case that has the potential to redraft many different areas here. So I'd be interested in that.
Yes, and I agree with your instinct and your inclination there. And I do think that NCOIL's brief was targeted at that really important core policy level of the need for states to be able to regulate their own healthcare systems, particularly for cost control. So I have the implications kind of categorically, I think, on this slide, which I'm happy to share. So more broadly speaking, healthcare rate regulation, I think, is on the table for states, and states have now the Rutledge opinion as, I think, a shield that should deter some litigation against rate regulation. But in particular, the broader effort of states to control costs, including with prescription drug reimbursement, prescription drug pricing, and any other state public access plans, I think has some additional ammunition from the Rutledge opinion and its logic, because it explains how those state efforts are within the contemplated disuniformity that the original statute was passed under. And it explains the ways in which the relationship between those kinds of state rate regulation, surprise billing, consumer protection laws it explains that that is too tangential a relationship to the actual core features of an employee benefit plan to trigger ERISA preemption. So importantly, that takes those states' efforts outside of the ambit of ERISA preemption. So you don't have to get into the secondary argument about whether those things are enforceable against self-funded plans as opposed to fully funded plans. So thank you, Arkansas, for leading the way to the Supreme Court and devoting your considerable time and effort to producing this opinion.
Thank you. Thank you, Mr. Chairman.
Thank you, Jason. Any other questions? I think we're good. So the last thing on the agenda, on any other business, I'd like to introduce Roderick Scott, and he's going to say, give us a quick preview of a future committee top agenda. Good morning.
Good morning. Thank you very much. My name is Roderick Scott. I come from a historic coastal Louisiana community with no levee protection, 14 floods in 15 years. I am the board chairman of the newly formed Flood Mitigation Industry Association. This country is facing unprecedented threats from natural hazards, and the dangers to our buildings are increasing, and as a result, the insurance rates are increasing through the roof. We are headed for a massive asset devaluation, according to the banks. And 2 years ago, I sat in the Treasury building where the banks estimated $1.5 trillion of assets are at risk from the rising threat of flooding and the flood insurance rates. We told the banking industry and Treasury and FEMA that we think that it's about $600 billion worth of retrofit to elevate and dry flood-proof these buildings so that we can manage our way through this changing climate and not have flooded buildings when it floods. We don't know how to stop flooding, but we certainly know how. My town is 86% elevated. It takes a week to recover from a flood now. We're the most advanced mitigated community in the world as far as we can tell. We're here to ask you, January 1st, the Holy Grail of financing for this adaptation was signed into law by the former president, called the STORM Act. It is a state revolving loan program. And at that meeting at the Treasury building, I watched the banks commit to this government, to our nation, $600 billion in financing to fix these buildings. They can't loan it to us directly, but they can loan it to the federal government, back down to the states, to the taxing authorities, and attach it to the taxes to be repaid over 20, 30 years. People cannot afford to do this, but we can afford to finance it, and then people can pay it off. Bootstraps, pull up our boots, let's do this. We have to adapt to a changing environment to reduce our losses that are increasing every year. So we were introduced to NCOIL and have come before you to ask for some help. You are the legislators. In order to pass this money from the federal government, from FEMA to the state emergency management offices, there will have to be an enabling legislation created in each state to create a state revolving loan program. Our industry is ready to expand 2,000% in the next 20 years and hire an additional 500,000 construction tradespeople to build our way through this adaptation, which we call the Next Moon Project. We have to do this. Millions and millions of buildings are at risk. So what we're doing is asking NCOIL to entertain helping our industry. We know how to fix the buildings. We don't know how to write legislation. And we need state enabling legislation, model legislation for every state and territory to be able to create this pathway for the financing to come to its citizens. So I thank you. I look forward to meeting you again in Boston. And we're willing to make the investment and the time, and we need your experience to be able to create this model legislation for each state. Thank you. I'm willing to entertain.
Yeah, thank you. And this topic will be on the agenda in the next, at our next session in Boston or wherever we hold it. So that is actually all the business that's going to be here. We're not going to take a break because our keynote speaker is here, the Honorable Pamela Yvette, who's the Lieutenant Governor of South Carolina. So we're going to move right into that session, everyone. So if without any other questions or anything, this session we're now being adjourned. Thanks everybody for coming.
Good morning. My name is Ronnie Cromer. I'm a state senator here in the great state of South Carolina, and not representative, but Ray Farmer this morning welcomed all of the folks here to South Carolina at our welcome breakfast. And it really is an honor to have you here. I hope you enjoy our great city. We call it the Holy City. And in case you hadn't recognized, we have tons of church steeples or spires or whatever here in the city of Charleston. That's why they call it the Holy City. And let me just first say that Charleston is very unique. They've always been unique. About 50 years ago, we had a law in South Carolina where if you went into a bar to have a drink, alcohol was not served or not poured. They would serve you a mixer, and the mixers cost about 3 or 4 times what a normal drink would, but you carried your own liquor in your own brown bag. Well, in Charleston, they've always had their quote own laws, and you could drive to Charleston and go in any bar down here and you could get a mixed drink. You paid for the mixed drink. Nobody ever said anything to them. So we've always called Charleston the great state of Charleston. So anyway, now it's my pleasure to introduce to you our guest speaker this morning, our Lieutenant Governor. And Lieutenant Governor Yvette has been with us now as our Lieutenant Governor, I guess almost 2 years. Third year, going into the third year. Pamela lives in Travelers Rest, South Carolina. That's up around Greenville. Greenville is a large growing city in South Carolina. It and Charleston compete annually for the largest population of any major city in South Carolina. As I said, Pamela was elected in 2018, and prior to her election as the first female lieutenant governor in South Carolina, Pamela founded a company called Quality Business Solutions. It's a payroll, human resources, and benefit services firm that's headquartered up in Travelers Rest. And under her leadership as president and CEO, QBS grew exponentially, going from a startup business to one of the nation's fastest growing small businesses. QBS has been repeatedly honored among the fastest growing and best places to work in South Carolina. Yvette has received numerous business and professional accolades, including the Athena Leadership Award, the Enterprising Woman of the Year Award, the Women Presidents Organization 50 Fastest Growing Women-Owned and Led Companies Award. Pamela is passionate about and has been focused on improving our educational performance in South Carolina, and also assisting and helping the elderly, the young, and small and women-owned business enterprises. She is a native of Ohio, a transplant, but now she is a true Southerner. Her grandparents were Polish immigrants. So her parents were first-generation Americans, and they taught her the value of hard work and the importance of getting involved and giving back to the local communities. Yvette holds a BA degree in accounting from Cleveland State University, and she and her husband, David, who is president of QBS, and I might say he's probably only president because she got elected as lieutenant governor, but she probably still retains the title of CEO. Is that correct? The founder. Okay, founder. All right. So she gave him a title. They both attend, along with their children, the Prince of Peace Catholic Church in Taylor, South Carolina. And they have 3 children, Amanda, Joseph, and Jackson. Pamela, if you will, come on forward. Welcome.
Well, good morning, everyone, and welcome to the great state of South Carolina, but more importantly, the beautiful city of Charleston. Always proud that it's ranked one of the best cities to come and visit and spend your money at across this great country. So as you heard, I started and lived most of my life in the business community, and I had dreams that started with locking the doors and putting insurance companies and legislators all in the same room. So when I was asked to speak here today, I said, wow, if I could have just gotten this opportunity a few years ago, what a difference I could have made. I am, as you heard, the 93rd Lieutenant Governor of the great state of South Carolina, and am entering my 3rd year, have entered my 3rd year in public service. Prior to this role, as you heard also, I was the president and CEO of Quality Business Solutions. And that becomes important because I'm very passionate about what you're all working here today. Because in my role there, we help small and medium-sized businesses grow, helped them with all their backroom issues, from payroll to benefits administration to workers' comp, to all those things that you address every day. You know, I have a unique perspective now, sitting in my role as president of a company and now as lieutenant governor, just strengthened my resolve for why the three stools of that, the three legs of that stool really balanced on legislation, business, and insurance. Just how much the balance of that helps businesses grow every day, and why we continue to need communication, cooperation, and collaboration in this area is something that's very important to our business community here in South Carolina and to the continued growth that we are so blessed to have here in our state. You know, we just came through a really tough time, as you all probably have, through all of your states. But South Carolina took a much different approach. Because of the great leadership of our governor, Governor McMaster, South Carolina took a very targeted and focused approach on the pandemic. What we tried to do is focus in on key areas of our economy that we knew we had to tap the brakes on ever so lightly while we were getting our arms around what was happening with COVID-19. What we did, we were the last state east of the Mississippi to close down and the first to open up, trying to limit our impact on businesses around our state. And that has proved to be a very good approach. We keep hearing from big companies like BMW and Michelin that they have had record years. Other companies, those 2-tier, 3-tiered companies, have continued to grow during this very challenging time. The only slowdowns we had here in South Carolina and our manufacturing world was due to supply chain problems that stemmed from slowdowns and closures in other states, but we worked around those. Probably the most impressive thing that we did here, and the thing that I'm most proud of, especially being a former business owner, was the governor's development of the Accelerated SC Task Force. What the governor did was unprecedented. As a business owner, I always wish for the day that we would be able to come to the table and have a voice in what was happening in our state, a voice in regulations that were being brought down, and how that would impact our everyday lives. And that's what the governor did. With Accelerated SC, he brought our legislative body to the table. He brought local government. He brought business. He brought trade associations. He brought higher ed. He brought K through 12. And we all sat in a room just like this and talked about what the best way to reopen our state would be, and how we could all work together to make sure that we could have a prosperous South Carolina coming out of this. How we could have transparency be the key focus on this. So the governor went to South Carolina's SCETV, and every meeting that we had, whether it be in one of the subgroups or as the full committee, was aired on TV for all of South Carolina to see. We talked about how money coming in from the federal government would be used and distributed, where it would make the most impact. We heard from mayors and local leaders about what was happening in their cities. You know, South Carolina is a very small state, but we're very diverse. Up from where I am in Greenville, you have the mountains. Down here in Charleston and up into Horry County and Myrtle Beach, you have a very touristy community. So very different on the scope of what's happening in each part of our state. So it was good to hear the pain that every local government was feeling, and how could we help ease that burden. Out of that Accelerated SC, we talked to businesses that were very concerned about COVID-19 and what kind of liability lawsuits could be filed on them. What would they have to do to shelter themselves? And I'm sure if you're a legislator, your businesses in your state's worried about too. And if you're an insurance carrier, it's something you were probably really concerned about. So out of all of that collaboration, we have Senate Bill S-147. It's the COVID-19 Safe Harbor Act. It passed the Senate. It's made its way to the House. It made it there before crossover, so that is really good. And we are hoping to get it out of judiciary here in the next week. And the governor will be anxious to sign that. Businesses, commerce are very concerned. We're very lucky, though, that we haven't had a whole lot to worry about, but we want to make sure that we cover ourselves definitely moving forward. We'd like to make sure that we are doing transformative things here in South Carolina. How do we take what we have? How do we listen to our business community? How do we change and make them feel better about what's happening in our state? We're lucky and blessed to have Director Farmer lead our Department of Insurance. What we're looking to do this year is make some major changes in our insurance fraud unit. Right now in South Carolina, insurance fraud is investigated under our Attorney General, Alan Wilson. He has 3 lawyers that investigate that and a 600 case backlog. So as you can tell, it's not sending a great message to bad actors that are out there in our state. So what we're looking to do through House Bill 3586 is to move the fraud unit out of the Attorney General's office and into the Department of Insurance, where it sits in 35 other states around our country. With that, in our budget, in the governor's budget and the House budget, was appropriated $1.4 million and $1.6 million, with $400,000 asked to be used from fines from the Department of Insurance that they would collect through this endeavor. It would move the amount of attorneys that are working on these claims from 3 to 15, which would make a huge impact. And it would still include SLED, our state law enforcement division, doing the investigating of this. This is something the governor is very passionate about. He is encouraging the Senate to pass this bill and get it to his desk for signature, as he wants to send a very clear message to bad actors in our state that South Carolina is not the place to do business. South Carolina stands very unique in what we've done and when dealing with flooding and resiliency in our state. Our governor 2 years ago started the Floodwater Commission. It's the first of its kind and the only one in the country. He took and used that same cooperation, communication, and collaboration technique and brought in people from all over the state. Proud to say Director Farmer was with the Governor I on that day when we came down to hard-hit areas of our state. We were down in Marion, in Dillon, in Sellers. But what we did there was so unique. In those areas, we brought in local faith leaders, local leaders. We had judges, we had the governor, we had the South Carolina Guard, we had the governor and myself, and we worked on what could we do to help mitigate flooding risk in those areas. And that started the research of the Floodwater Commission. Headed by Thomas Mulliken, a brilliant environmental attorney, we started looking at canals. Our canals weren't moving. In some of our hardest hit flood areas, canals weren't moving. And why? Because of the debris that sat inside those canals. When they reached in, they pulled out sofas and TVs and chairs, things that had washed in there during prior flooding, which caused water to stand still. We all know water likes to go to water, and the best thing to do was clean that out. And together, we saw, as that was being lifted out of the water and disposed of properly, water flowing, cutting down underbrush, understanding that this is what we had to do all around our state. So it was a one-year project, going around the state and figuring out what we can do, and empowering every citizen in South Carolina to come together and do their part in cleaning up our great state. Knowing that litter, something that we could all be a part of, making sure litter gets to the right place, creates a huge impact on flooding. So that's what we've done. A year later, a volume was created about this thick of flooding, what could be done. So what is happening here in South Carolina in just a few, I think next week, right? We're very close to the 22nd. On Earth Day, the South Carolina 7, which was a group that was kind of born out of the Floodwater Commission, by direction of our governor, is planting 3 million trees, seedlings and saplings, across our great state. Trees we know, mature trees, soak up 11,000 gallons of water in a year. It eats up 133 pounds of carbon dioxide. We know by planting wheatgrass, which the governor and I have done at the coastline to help stop erosion, by planting trees, by making sure we mitigate the runoff of water, working with our local officials, we will help stop this flooding problem here in South Carolina. You know, Charleston is a beautiful city and people come from all over the world to get married here, but the constant joke is if 3 weddings happen at the same time and everybody's crying, King Street could get flooded. So it's something that is very near and dear to Charlestonians here in Charleston. The governor also got very involved. There's lots of little islands here around the coast of Charleston, and he got very involved this year in saving Bay Point Island, which is one of the Gullah Islands. He came down to address the fact that he did not feel putting an eco-friendly resort on an island that would be susceptible to flooding often would be a good idea. And it would displace the wildlife and the historic Gullah community that resides around the area of Bay Point. So the governor got involved and you'll be proud to know that Gullah Island is staying the pristine state that it was before this endeavor was to happen. I couldn't leave this podium today without thanking Director Farmers. You could tell this is the 3rd time I've thanked him today because he is not only a friend, but a confidant. Every time I have a problem or an issue or something arises, he's the first person I call. And I want to thank him for co-chairing the NAIC Climate and Resiliency Task Force. He sits on that task force and co-chairs it alongside California Insurance Commissioner Ricardo Lara. So Ray, thank you so much for what you do, not just here in our state, but making an impact across our great country. So they told me I had 15 minutes because they wanted me to leave it open for questions. So I just want to say thank you so much for coming to our great state. I hope you enjoy your time here in Charleston. Ladies, if you like to shop like I do, King Street is a wonderful place to be. For all you gentlemen and ladies, if you like to eat, there's no better city. Food is everywhere and at every corner, and it's all award winning. So please enjoy your time, wander around, spend a lot of money. That's what we're here for. Want to keep all of our business owners happy. It was my pleasure to be here joining you this morning and my honor to serve as Lieutenant Governor of the great state of South Carolina. But I'd love to open it up for any questions y'all may have. Great. Yeah, so the JASP report, something the governor works on alongside the governor of Georgia. But South Carolina's port is well, soon to be, we're almost there, the largest as far as depth and width on the East Coast. The port attracts so much into South Carolina. Businesses that I have the pleasure of sitting down and talking to, they came here with the port being a great reason. What a wonderful way to get your product in and out, especially if you're an international company. Life science, looking at South Carolina heavily, our life science community continues to grow. And there's so many branches to life science. We already know we stand out as being one of the best advanced manufacturing states in the country. South Carolina prides himself on being the largest tire manufacturer now in the country. And you can see that when you're standing at the port. Huge tires coming out, rolling out of our port, heading to destinations all across the globe. So the port has been a very real friend to South Carolina. Not only do we have our port here in Charleston, we have 2 inland rail ports that move cargo across and get it around our state, helping protect our infrastructure. And so something else that makes us stand out, but definitely is a huge seller to our Department of Commerce when businesses look at South Carolina. One other big factor in that is just how we handled this pandemic. I think it really showed that this administration doesn't just tout itself on being business friendly. We walk the walk of being business friendly. always keeping businesses first and foremost in our mind when making decisions, whether it be on insurance matters, pieces of legislation, or just how we allow us as elected officials to affect their day-to-day lives.
I got a question for you. Oh, I'm sorry.
Oh, no, go ahead.
Go ahead, Jason, always.
Well, thank you for being here. By the way, Representative John McCravey is a dear friend, if you know Representative McCravey as well. Senator Raypert from Arkansas. I wanted to see if you would say a few more words about the flooding issues and the concerns that you have. NCOIL is taking a big role in that over the years. And I actually was in Lake Charles, Louisiana just a few weeks ago. It was absolutely amazed at how they are still in the throes of devastation that is there. And a lot of people have just forgotten, and we've moved on. And literally they have people there that are not expecting to be back in their primary homes till next year or even later. And so I know that it affects all of our coastal areas. And so what would you say to us should be a primary concern that you would want us to take up as we move forward on those discussions?
Well, that's a great question. And I think the world of your Lieutenant Governor, Tim Griffin. So when you bump into him in Arkansas, please give him my best. So what we see here in South Carolina, and I, I guess sometimes you don't realize how fortunate you are because it's your home state and you just think everything runs that well everywhere. I toured with Congressman Tom Rice, that was his district, about 2 years ago, houses that were being rebuilt by FEMA. And, I was so proud of the way South Carolina has really worked with FEMA to get people back in their homes. We had legislation come through the House that was passed, where in areas that we know would continuously flood with very little hope of not getting that property bought out and people relocated so that we're not dealing with that same cycle over and over again. I think what we're doing with the Floodwater Commission is making a big difference. Really focusing in on the low-hanging fruit makes a huge difference. Reading that commission report, which I'm going to be honest with you, I have not read, the old Webster-style dictionary, the commission report, but having the ear of Tom Mulligan and hearing the Cliff Note version of that, there's a lot we can do. Clearing underbrush, getting very involved with making sure that in those communities that are continuously flooded, keeping debris out of yards, making sure that we're stopping things from getting in canals, from getting in our water basins, from making sure that we can continue to move the flow of everything. That takes a big coordinated effort from around the state, and that's what you're seeing. Local communities have adopted on. Big cleanups happen all over the state all the time. But then on a much bigger level is how do you control the flow of water? Some of our heaviest flooding in those areas we can't control because it's water runoff that's coming out of North Carolina. And there are things that, you can only control what happens inside your state. So really having good relationships with other states to be able to work in tandem to make sure you can don't make your problems and other states' problems. So that's what we're doing. And I mean, it's creating a big difference. We use the brilliant minds of our research colleges to come up with like the planting of sweetgrass, making sure that we're allowing nature to kind of sustain itself by planting sweetgrass and making sure we're creating barrier buffers for erosion, by planting trees strategically around the state. It'll take, for the ones that we're planting on Earth Day, it'll take a while for them to get to a mature state. But when you talk about trees, just kind of like our forestry around the state, we have a good bit of mature trees, planting more, making sure they come up. 11,000 gallons of water being absorbed by a mature tree takes up a lot of water that comes through heavy rains and flooding and things like that. So what we're trying to do is take a calculated approach and help Mother Nature do what it always does, help it get back to what we disturbed. But I think making sure that we're not getting involved in a rotating cycle of putting people back in homes that we know are going to flood is probably the biggest difference I've seen here at a state level. And that happened this year. And it happened with the legislators that sit in that area of the state that really listen to the advice of their constituents.
Yeah, you touched on the fraud issue, and one of the problems we're having in Ohio is, and I know Ken Cooley's on virtual with California, we're having massive amount of monies being defrauded out of our unemployment system. Are you, and I know you've done a really good job of your unemployment's not as high, but are you getting hammered like other states? I mean, and do you feel it just, once the pandemic's over, we'll come back to normal? But we're talking, I mean, they were talking billions in California and 340 million in Ohio. And so we're having that same problem. And I know unemployment, we talked a little about it before we started here, that unemployment's a separate deal and it's through job and family, et cetera. So are you expanding? Are they going to handle the new, with the insurance company industry or the insurance department, going to handle the unemployment or the fraud issues in unemployment?
No, so unemployment, so ours is handled under due, and they are handling that case by case. And we are seeing it too. We haven't seen it to the extent that other states have. I think some of that is because South Carolina kept so many of its people working. You know, our unemployment before the pandemic sat at 2.4%, basically non-existent unemployment. At those levels, as you all know, everybody that wants a job has a job. It peaked to like 12.6 when we had kind of our 20 days of tapping the brakes. And now we're down at 4.5 again. Still not where we were, but we know we'll get there. But I think, you know, having a vibrant economy where people were encouraged to get back to work, and we took it very seriously here in South Carolina. You know, I work very closely with business because those were my friends before I entered this world. And I still have, you know, very close relationships with all of them, encouraging at the leadership level, encouraging businesses to turn in employees who aren't coming back to work. We know federal stimulus created an environment where people didn't want to come back to work, but it wasn't an option. We made it very clear, and our governor said it very plainly every time he was at a microphone. If you are called back to work and you don't come back to work, your benefits will be stopped. So if there was a job for you, it was your duty to do it. And I think when we empowered businesses to call in, when we stood as leaders and said, we have your back, we know you need your people to get back to work and we need them to get working, it made a big difference. We had some changes made to our computer software here in South Carolina. They did some enhancements to try to catch some of that. I think where I have heard from DO, the biggest problem has really been with the independent contractors, that piece, because those rulings came from the federal government and you really didn't have to show anything to get the money. So, you know, always something we should encourage is good legislation for all of our legislators here. Always make sure that there is a backdrop to stop fraud. Make sure that there's something we can verify before money starts going out the door. Well, thank you so much. You know, I was asked when I first took my position as Lieutenant Governor why this is something that was so important to me. And, you know, BMW said that when they came and chose Spartanburg to make their home, they traveled around and they looked at how people kept up their areas and their homes, because they knew that that pride in where you lived, where you shopped, where you worked would translate into their work ethic. And that's why they picked Spartanburg. And so it became very clear that if we wanted business to keep coming here, this was an economic development issue. We wanted to make sure that when businesses landed here from across the pond, where they're used to seeing clean grass and clean roadways, that they would see that here, because so many times they would get back in a plane and leave. And then when you looked at the money, the amount of dollars that are spent on a state and local level just cleaning up. Imagine if you could take that money and use it towards education or infrastructure, the impact you could make. But one thing I try to say, we have an organization here in South Carolina called Palmetto Pride. And they are funded through our Parks, Recreation, and Tourism Department. And that is their sole purpose, is to kind of organize, to be the one place that people call when they have an unsightly area. They work with businesses to adopt a highway. But the best thing that they do, in my opinion, is they educate our children. Because that's where it all begins. And so this week in South Carolina, we work so well together. I have to give a shout out to all levels. In South Carolina, we have something called Team South Carolina. And it's not just a really cool hashtag that we use when we talk about our state. It's really how we operate, how our federal elected leaders work with our state local elected leaders, work with localities, and how we all pull together in the same direction. And that's what we do. So, just that way of all coming together, educating our children. But DPS, our state highway patrol, they are working with us in Palmetto Pride this week. This is Zero Tolerance Week. So when they see, debris coming out of trucks, if they see people throw it, it's a ticketed offense all the time. But they really put a hardline focus on this week here in South Carolina, and we call it Zero Tolerance Week. So really pulling together and using that spirit that the governor talks about here in South Carolina with cooperation and collaboration really does make a huge difference. Well, thank you all. You've all been very kind. Much easier questions than I normally get from the third graders that come into the Capitol. They quiz me on the height, the amount of pieces of marble, how long was it built, and how long did it take to do that? So thank you all so much. And again, please enjoy your time here in Charleston. It's been a pleasure.
Lieutenant Governor, thank you so very, very much for those very insightful and inspiring words. Thanks so very, very much.
Okay, everybody get a seat. We'll start. We're the only thing between lunch, so we won't get going. So, okay, good afternoon. And thanks for everybody joining, either live or virtual. My name is Steve Westfall. I'm the state delegate from West Virginia, where I chair the West Virginia House of Delegates Banking and Insurance Committee. I'll be the moderator for this general session. We have a great panel of speakers that are here today with us to discuss a very important and timely issue, the future of long-term care industry in light of the coronavirus 19. It is no secret that COVID-19 has reaped a horrible toll on our nation's 2.5 million nursing home residents and their families, resulting in more than 175,000 residents' deaths. People living in nursing homes make up less than 1% of the U.S. population, yet account for.
I'm sorry, everyone. We're starting this session. If everyone wants to have conversation, just please step outside. We're starting the session now. Thank you.
Thank you. Okay, where was I? Okay, but it's no secret that U.S. long-term care industry was unstable even before the coronavirus 19 hit. The tragic unfolded in a nursing home is the result of decades of neglect and long-term care policies. The session is a great opportunity to discuss whether the pandemic will lead to a thoughtful reform of U.S. long-term care industry. If so, what the reform will look like. We have three people on our panel today with us. We have Allison Hoffman, professor at Law University at Pennsylvania Law School, Susan Ryan, senior director at the Greenhouse Project, and James Balda, president and CEO of Artenium. So first, Allison, I think she is online with us.
Hello, I'm here. Very
Yes.
nice to see you all. You ready for me?
Yes, we are.
Okay, excellent. Thank you so much for inviting me to join you all virtually, and I've enjoyed the day so far. And I'm glad that you're taking a little bit of time to think about this, this topic that will become very important in the coming years. So what I'm going to do is I'm going to go backwards a little bit, and I'm going to talk about the history of long-term care policy and financing that was kind of decades in the making, paving the road to reliance on underfunded nursing homes, which then became this pandemic hotbed. And then I'll talk a little bit about what's coming next, the shift that's been happening in long-term care over the past few decades, and that we may see continue with the infrastructure bill. And then finally, I'll spend a moment talking about what is still missing. So I'm going to really focus on the kind of broad policies, and I will leave it to my co-panelists to talk more about what's going on the ground. I'm sure you all have followed the latest chapter in the story of long-term care in the United States, which has been a really tragic one. Over the past year, according to one estimate, COVID has killed 180,000 residents and staff of long-term care facilities, accounting for about a third of all COVID deaths. And it's not one reason. There's not one reason that this has occurred. It's a number of different reasons. We've seen over the past years a gradual decline in nursing home occupancy and in turn revenues, despite the fact that we have an aging population. So if you think about the money coming into nursing homes, there are two main public revenue streams. There are dollars coming from Medicare and Medicaid, and they're both declining. Medicare pays for short stays for post-acute care for people usually after hospitalization. And those dollars are declining. That revenue stream is declining as more patients are sent directly home, a trend that, as you can imagine why, has increased during the pandemic and was also heightened by Medicare policies that allowed more telemedicine during the pandemic so that people could go home and continue to be in touch with their care teams. Medicaid has increasingly been paying for long-term care at home, which I'll talk about more in a moment, instead of in nursing homes. So in addition to this decreasing revenue streams, there has been sufficient oversight, a problem that was heightened in the Trump administration, where we saw decreased fines for violations, including violations for understaffing, which became one of the problems during the pandemic. And then we've seen increased private equity investment in nursing homes, and recent research showing that with private equity investment has come stark decreases in the quality of care and increased deaths at these private equity owned facilities, in large part due to reductions in staffing, especially for the long-term residents, the Medicaid residents in these facilities. So many nursing homes were already stretched before the pandemic, and then were asked to respond to a crisis. And as you know, they didn't do so particularly well. They didn't get, and some still don't have, the necessary PPE and tests for residents and staff. And the staff in turn earn such low wages that they often hold multiple jobs to make ends meet. And as they were moving from one job to another or from facility to facility, they were carrying COVID with them. We've seen evidence that a large number of the outbreaks in facilities were actually cases where COVID was brought in by staff members. Okay, so you have to, if you want to think about the roots of these problems, you have to rewind back now almost a century and think about how long-term care policy developed in the US. Long-term care, the notion of long-term care first grew out of Elizabethan poor law. There was incarceration for the destitute. Otherwise, long-term care was the domain of the family. The notion that for the most part, long-term care should be, and caregiving should be part of a family's responsibility continued as we saw the formation of social welfare policy. So for Roosevelt, the goal of the New Deal coming after the Great Depression was to ensure that a family's security in light of the potential loss of a breadwinner's wages if he were no longer able to work. So in this model that informed the development of the New Deal, it was assumed that there was one wage earner and one non-wage earning family member, the wife and the mother. If she were disabled, until the mid-20th century, there were programs under the WPA called housekeeper or homemaker programs, where somebody would come in and kind of do the things that she would otherwise do, these non-medical aspects of care, and states would pay for that through welfare agencies. We saw this model start to shift in the mid-20th century with the growth of private medical insurance. It began to undermine home-based care by saying if we're going to pay for services, they have to be medical in nature and provided by licensed providers. So what that did was it took the medical aspects of caregiving from the home and into hospitals, and it excluded from health insurance, from medical insurance, the care intensive aspects. This continued. The Kerr-Mills Act was the precursor to Medicaid, and it built right on this model. Long-term care didn't fit well into this vision emerging for health insurance, and what is often called custodial or non-medical care was largely excluded as we saw health insurance developing. So Medicare limited caregiving, limited paying for caregiving to post-acute care, mostly in institutional settings. Long-term nursing care was excluded as more custodial than medical. And Medicaid then became the locus of, and over time, actually the primary payer for long-term care, paying for over half of all services. As I'm sure you all know, long-term care consumes about a third of states' medical spending. It's only available, though, to people who have significant medical need and low income and assets. So it's become the locus of how we pay for long-term care, but it's really limited in terms of who can qualify for it. Medicaid also initially had an institutional bias. It favored provision of care in licensed nursing homes. This nursing home care was what is called a mandatory benefit that states have to provide. In contrast, personal care in home settings was deemed optional, although there's conversation now around that may shift that in the coming years. Medicaid also limited the use of federal matching funds. It said it couldn't be used in public institutions, which furthered the dismantling of state public institutions and then bolstered the private nursing home industry that was starting to grow up at that period of time. So if you look at the years right after Medicaid was passed, spending on private nursing homes increased from 46 million in 1960 to 3.5 billion in 1967. A couple of decades later, we started to see increased attention to problems of care, problems in institutions of care, and problems of quality of care, which led to a lot of litigation. Eventually, the Nursing Home Reform Act of 1987, or OBRA, and one of the lines of litigation culminated in a case at the Supreme Court in 1990 called the Olmstead case. And in this case, the Supreme Court said that institutionalization, when avoidable, can be a form of discrimination against people with disabilities. It was an ADA case, Americans with Disabilities Act case. And the result of this case was that states were required to make reasonable modifications to their Medicaid programs in order to provide care in the least restrictive setting possible in response to this case. So what has happened since has been a gradual and steady shift of Medicaid funding from care in these institutional settings and nursing homes to what are called home and community-based services. The program calls it a rebalancing of dollars. In 2013, for the first time, we saw more money, a larger share of Medicaid dollars spent on long-term services and supports in these home and community-based services programs than on institutional care. Now, at the same time, we've seen these programs dramatically underfunded. And as a result, what has happened is an increased reliance on informal caregiving, on friends and family to provide that care. If you look at what's going on at the state level, states have long waiting lists for home and community-based services. 820,000 people in 2018 were waiting, with an average wait of more than 3 years. And even when people get access to these services, they typically only cover a slice of the supports people need. And you can imagine that during this pandemic, people watching what happened to family members in nursing homes, the pandemic will only heighten the demand for these kinds of programs. So with this shift, the cost, not surprisingly, to friends and family member, the informal caregivers, are immense. I call these costs the invisible co-payment of long-term care. It's costs that are kind of absorbed into families, happen in the household. And to the extent that we think about how policy has grappled with long-term care, it's really thought about the people who need care, what I call care recipient risk. What are the risks to somebody who needs help with their activities of daily living or their IADLs? And I've urged that when we think about policy, we should think about it equally from the perspective of the friends and family who provide this care informally, which I call next friend risk. So if you think about when we shift care into the home and we underfund it, who picks up the care? It's the friends and family. The cost to the people who do this are really quite immense, from lost income, job opportunities and advancement, health risks, physical and mental, lost retirement savings and security, and so on. There are lots of studies that quantify it. I'll just give you a couple of examples. One study says if you quantified all of the hours that family and friends provide in long-term care at the low hourly wage of formal caregivers, which is about on average $12 an hour, it would be about $500 billion per year. The average adult who leaves a job to care for an aging parent faces about $300,000 in total losses. So this has been the most neglected part of long-term care policy. We're starting to see some genuine attention to this problem. Just very recently, I wouldn't have had this to talk about a couple of weeks ago, but President Biden's proposal to include $400 billion in funding to the states for home and community-based services over 8 years in the infrastructure bill. But what he's proposed so far is only a partial solution. So a full solution needs to consider a couple of things. It needs to consider both home-based care and non-home-based care. What hasn't been dealt with yet is the fact that for some people, care at home isn't the right solution and never will be. But today's nursing homes are falling short, as we saw in dramatic ways during the pandemic. What we need are safer and more humane group care, collective care environments. When I present on this topic, I usually talk about the greenhouse as one of my favorite examples of what we need more of, and I usually share pictures of it. So I'm very excited to be on a panel with Susan, who's going to be talking about this, and I previewed her slides, so I know that she is going to share some pictures as well. So I look forward to hearing from her. And what's also missing is a solution for people who don't qualify for Medicaid. Even if the Biden administration were to provide a major flood of funding for long-term care, and so that if it were fully funded for Medicaid beneficiaries, and even though the $400 billion of the infrastructure bill seems like a massive amount, it won't come close to fulfilling the need for the demand for services under these home community-based services programs, in part because the bill intends to raise the wages for people who are currently providing the services as well. And even if it did that, even if it were comprehensive, it would still leave people who don't qualify for Medicaid out in the cold. So to close, let me just say what we really need at the end of the day is to grapple with this problem in a comprehensive way. And from the beginning of the development of social welfare programs in this country, we've failed to do so. If you look elsewhere in the world, you look at other countries, Japan, Germany, the Netherlands, Denmark, France, they have all developed universal long-term care programs. They all look different. They all pay for care in different ways. And so there's no one right way to do this. But it's time to kind of step back from the system that we have today and think about how to put together a more comprehensive way for thinking about long-term care funding in the future. Thank you all. I'll stop there.
Okay, thank you. We'll hold questions till the end. All three panelists are done. The next with us today in person is Susan Ryan. So Susan.
Well, first of all, thank you, NCOIL, for the incredible opportunity to what I call have a literal seat at the table today. And thank you, Allison. I can't tell you how much I appreciate the setup and the shout out. So I thank you for that. I don't know that they're in slideshow mode. There we go. So while they're getting that in slideshow mode, let me tell you, I'm a nurse and I have done the bulk of my career in long-term care, nursing homes specifically, and home care. So when Allison was kind of talking about the back and forth, I can tell you that that was my world. There was a time that I did everything I could as a nurse to keep people in their own homes because I said, I've got to keep them out of those dreadful places. And then when I went back, it was because home care is great, but the options there created a cost prohibitiveness for those needing care or a social isolation. And so I went back with the goal of reforming those traditional nursing homes. I found the Greenhouse Project and it has become the passion of my life. If I could, I would take you in to visit a greenhouse home and not do it virtually, but because it's COVID, we're going to do it virtually. So these are 4 homes in Providence, Rhode Island. And so take a look.
Welcome to the Greenhouse Homes at St. Elizabeth Home, a new and innovative model of nursing home care. These 4 greenhouse homes are each nursing homes for 12 individuals. St. Elizabeth Community is proud to open the first greenhouse homes in Rhode Island. Located on a cul-de-sac adjacent to St. Elizabeth Home, this intimate residential setting is unlike any nursing home in our state. Offering both privacy and autonomy for the residents, the model of care is a proven model which employs cross-trained certified nursing assistants and nurses. Let's take a look at one of the 4 greenhouse homes at St. Elizabeth Home. Upon entering the home, you come into the hearth room, a warm and inviting space for gathering with a gas fireplace and a large wall-mounted TV. A sunny sitting area is off the hearth room. The den, adjacent to the hearth room, is an ideal place for reading, playing games, or visiting. Doors can be closed for privacy and quiet. The entire home has radiant floor heating, which provides exceptional warmth and comfort. The heart of the home is the spacious kitchen and dining room. An open floor plan encourages community and fosters interaction. The kitchen is inviting and designed so residents can easily help in preparing meals or simply enjoy being in the kitchen. The dining room table is large enough so that all residents and staff can share meals together. And families are welcome to enjoy a meal with their loved one individually or with the community. Each private bedroom has been thoughtfully designed. A built-in locked medicine cabinet is located at the entrance. Rooms are fully furnished and have cable and Wi-Fi free of charge. Individual heating and air conditioning controls give residents the ability to adjust temperature for their personal comfort. A built-in ceiling track would allow for a resident to be lifted from bed to bathroom if needed. All rooms have private, accessible bathrooms with walk-in showers. A call system is in place in bedrooms and bathrooms so residents can alert caregivers. A master bathroom has a whirlpool soaking tub and adjustable hairdresser sink. The spacious room has a large mirror and heat lamps in the ceiling for extra warmth. A courtyard and screened porch complement the beautiful interior space. Residents are invited to participate in daily activities they enjoy. Laundry is done by the staff, but if a resident or family member prefer doing their laundry, they are welcome to do so. The greenhouse home concept of living empowers staff to support residents to live life to the fullest in a real home with privacy and community. Thank you for taking the tour of the greenhouse homes at St. Elizabeth Home. For more information, please call 401-471-606.
All right. Anybody ever placed someone in a nursing home? Anybody would prefer, I'm sure, to have someone in a nursing home that looks like that. I had the unfortunate experience with my own parents, and there wasn't a greenhouse home. And I know what it's like to place somebody personally. And I know what it's like, especially during COVID time, to deal with the loss. So let's take a look. You saw the video, but let's break it down. We define greenhouse by 3 core values. The first is what we see, what we know, what we love, and that's real home. That's the physical environment, and size matters. No more than 10 or 12 people live in a greenhouse home. Private rooms and baths. So when you think about COVID and you think about people sharing a room, 2 people to a room, sometimes 3 or 4 people to a room. Think about that in infection control, having your own private shower to be able to get in and out and not a central bathing area. Access to outside. How many nursing home residents were able to get outside during COVID? This is COVID time. And these are people that enjoyed gardening, people that enjoyed barbecue during lockdown. The second core value is meaningful life. And I can tell you it's all about relationships, being known as a unique person, being known. What makes a meaningful and purposeful life to each person that lives within the home? And we call it relationship-rich, person-directed living. Having the autonomy, the control, the ability to just direct your day and when you get up and what you eat and how you spend your day. Empowered staff, that is the third core value. Workforce. You heard a lot about workforce in the news, and I can tell you that workers were many times ill-equipped and not prepared. In the greenhouse home, we have decentralized departments like the dining department. And so each home has its own open kitchen, as you saw in the video. And so this group, they operate as a versatile worker. They do the meal preparation within the home. So they have special education that would equip them to do so. It's all about leadership, and we really spend a lot of time equipping leaders to make sure that their staff, the workforce, has all the resources they need to be successful. Consistent staffing. You can't have good, deep knowing relationships if you don't have the same people working with the same people. So it's important to us to make sure that they are working with the same individuals each day. Versatile worker. So what's a versatile worker? I think the picture begins to tell you a little bit about it, but rather than having dietary departments bringing in the food or laundry, folks taking the laundry in and out, they operate as a versatile worker, meaning they do the care, they do the cleaning, they do the cooking. And as you can see, apparently they do the caulking here. So what does that mean to infection control? What that means to infection control as a nurse, I'll tell you. The fewer people that are coming and going into that house, the less chance you're going to spread COVID-19. And so really keeping those interactions to a minimum. Empowerment doesn't happen unless you're educating your care team, your workforce. And we spend a lot of time really equipping certified nursing assistants to take on an empowered role. We also work with leaders to make sure that leaders are equipped to be in collaborative partnerships with them. This is where we are, 359 homes in 32 states. But guess what? There are over 15,000 nursing homes. That's a drop in the bucket. So I couldn't agree with Allison anymore when she said that we really need to reimagine nursing homes, and we need to see environments such as what I just showed you. So COVID-19 in greenhouse homes. I was traveling. I was in Atlanta a year ago, more than a year ago. I guess it was the beginning of March, just before lockdown. It actually happened to coincide with when President Trump was at the CDC. I was at a conference, not related to that, and I remember making a comment. The greenhouse model was made for this moment. And as a nurse, I believe that they were made to really mitigate infection spread. And I thought this model would do well. And then when it hit nursing homes so hard, and I'm reading the New York Times article that say they're death pits, I shuddered and I thought, I sure hope I'm right. So it was in April that we did some data collection. We ended up doing, we started the collection, we did a swath of data from January through May. That was the first collection when CDC was collecting. And then we did monthly data collection through the end of the year. So as you will see on the left, that's COVID cases, green is greenhouse, and on the blue, that's traditional nursing homes. And we were looking at per 1,000 residents. And so we'd have an apples to apples comparison. This is raw data, number of cases on the left and number of deaths on the right. So you can see that where cases, there were some cases in greenhouse home, we weren't COVID free, but certainly far, far less than our traditional counterparts. Similarly, when you look at deaths, the greenhouse homes did far better last year in keeping people alive. So there we go. This is by month. So as I told you, we wanted to test, keep checking through month. In fact, we're still collecting our data. You can see the dip and the surge. Remember, in the fall, we had that convergence of flu season. We had holidays happening, less sunlight, opportunity to get outside. But once again, we were consistently lowered. This happens to be the mortality rates. And green is greenhouse once again, and so far less. So here's the reality, though. What we learn is that there really is something about research was being done, and we learned that the COVID cases had a lot to do with the resident risk factors, and it had a lot to do with organizational risk factors, such as the size of the building and community spread. So there was this hypothesis that smaller models would do better, backed up by research, and they really wanted to take a look at greenhouse home. So I had a research advisor, someone, Dr. Cheryl Zimmerman from the University of North Carolina, reached out to me and said, would you be willing to work with us? And we want to do data collection. And we really want to drill down and we want to look at geography, location, as they say. And we wanted to look mortality rates and case rates. And they wanted, because we believe size matters, they wanted to look at greenhouse, which is very small, compared to traditional nursing homes less than 50 beds and traditional nursing homes that were greater than 50 beds to see if the smaller, less than 50 was still good. All right. So we did a monthly data collection. You can look at those slides later. This is kind of our sample size. And the objective, once again, we wanted to go in and look at greenhouse homes in the same geographical region. And we looked within about a 25, 26 mile radius to look at nursing homes less than 50 beds and nursing homes greater than 50 beds. We are looking here at the 75th percentile to really get as much variability as we can. As you can see, and these are COVID cases, traditional homes less than 50 beds had twice as many cases of COVID as greenhouse, and a traditional home with greater than 50 beds had 9 times more cases of COVID. And here's mortality. So looking again at the mortality rates at the 75th percentile in greenhouse homes, and this is looking at per 100 positive cases of COVID in greenhouse homes, less than 0.01% death. In a small traditional home, less than 50 beds, 100 cases of COVID, 50 of those resulted in death. In traditional homes greater than 50 beds, 30 of those 100 positive cases resulted in death. So you can see the greenhouse homes did incredibly better as we drilled down to geography. Community spread, where those homes were located, were critically important, and obviously size. So what did we learn? Obviously, it appears that the greenhouse model has done an incredibly good job, even amid a pandemic. And I think the other thing, they say the mortality rate is potentially due to the psychosocial factors. And when I showed you, wouldn't you think that your psychosocial, your well-being would be better in a place like that? And even if there was COVID, you would have a greater chance of recovery. Here's what we know about occupancy, and Allison alluded, whoops, let's go back. This was occupancy data gathered by the National Investment Center for Senior Housing and Care. And you can see this is from 2012 to October 2020. So you can see what happened in 2020, a precipitous drop. It was a pretty incredible drop, but it had never hit, it was below 90%. It was in the 80s in its best day and just was continually dropping. What's that say? Consumers are voting. They're saying that's not where I want to be. So in the next slide, which you already got the preview, you can see that during COVID, as we were collecting our data and measuring it against the same data that month for CMS traditional homes, you can see the greenhouse homes did really well and far better. In the sweet spot, those summer months, we were above 90%. The lowest we got was 86%. The video that I showed you at the beginning, they to this day have had 0 COVID cases in their greenhouse homes. So I have just a couple things, if I can get my, there we go. So what are the barriers? Why hasn't this model taken off? To me, as a nurse, I'm telling you, this is the best thing I've ever seen. I'll tell you what providers tell me. Barriers such as the regulations that would prohibit it. I'll give you an example, the certificate of need, where a provider or developer has to get permission in order to obtain beds. There are 36 states, including the District of Columbia, that have CON laws that would prohibit someone from just bringing this model to their state. In addition to that funding, the underfunding and what we need to do to really take stock of where we're putting our dollars. Financing, one way to make these homes viable is to have good financing terms. And last but not least, our workforce. There's a whole lot more that needs to be done there. Not time to completely solve that today. Whoops. Incentives matter. I just threw up some real quick ideas. Incentivize public-private investment. There's much more we can do there. Eliminate the regulatory barriers. I would vote to just get rid of the CON laws that really are inhibiting this type of innovation. Strengthen our workforce. It's time to pay a living wage to people who research would tell you they were doing the most dangerous job in America during COVID. Expedite adoption of key model features associated with quality. We have what we call Greenhouse 2.0, where we take our values and we go into a traditional home and really seek to get private rooms in there and really embrace a different philosophy. If you'd like more information, that's where to go. That you'll find the research. You will find an AARP bulletin. They did a spotlight on greenhouse during COVID, and it's really a good read. So thank you for your time.
Okay, thank you. Next, virtually, we had James Bolda. So James, are you with us?
I am. Thank you. I'm sorry I'm not able to join you, but I appreciate the opportunity to speak with you today. What I thought I'd do is I'll talk a little bit about our experience, really the senior living experience, which encompasses what we call independent living, assisted living, and memory care communities, their experience throughout the COVID-19 pandemic. And then some of our thinking about what's going to happen sort of coming out of COVID. And then also, just as Allison and Susan did, talk a little bit about how we think about the broader long-term care continuum, and really there's no one-size-fits-all solution, and the role we think we play, and how we think policymakers need to look at other options like the Greenhouse Project and others. Really, the long-term care industry, as you all know, as a whole, was one of the areas most impacted from COVID-19. Our population is extremely vulnerable to the virus, typically an average age in their mid-80s, dealing with multiple chronic conditions and comorbidities, and many with cognitive decline. Now, our communities, senior living communities, are not nursing homes. We're predominantly private pay. And we sort of fall short of providing the level of medical care that nursing homes do. We typically provide support with activities of daily living, so dressing, bathing, eating, medication management, transportation, housekeeping, and so on. But so our residents, though, were still highly vulnerable to the virus. And of course, this took a tremendous toll on the industry. Certainly a human toll, an emotional toll, and even a financial toll. And our industry has ultimately been changed like never before. But really what was amazing to see was how the industry and our team members in particular rallied and stepped up to ensure that residents were protected and safe, and that staff were supported. We heard stories all across the industry, certainly about hero pay, support with childcare and transportation for team members, mental health resources. As you can imagine, it took a tremendous toll on team members, even going so far as offering on-site pantries for associates and their families so they wouldn't have to go to the grocery store, and much more. But now with most of the resident population having been vaccinated, we're at about 98% roughly of our residents, our communities have had their full clinics, vaccine clinics at this point. And we're seeing 90 to 95% of residents getting the vaccine. And we're seeing increased vaccination commitment from our staff. Many are in the 60 to 70% range at this point. We're looking forward to sort of brighter days ahead, but we're still in the midst of the crisis, certainly, and the financial cost of the pandemic on the industry has been devastating. Some models show that last year alone, the industry lost $15 billion, really driven by historic declines in occupancy. So as our communities were closing their buildings, essentially restricting visitation, no tours, no new move-ins. We saw about an 8-point drop in occupancy, which had a big impact, but also the increased costs associated with COVID-19. Again, the hero pay that I talked about, personal protective equipment, which was certainly difficult to find, testing. Many of our providers had to purchase their own testing, enhanced infection prevention and control measures, and even increased staffing costs. When you think about delivering meals to private rooms as opposed to social dining, that has increased costs, just as one example. And so the industry has really been impacted. And again, as I mentioned, we're predominantly private pay. About 85 to 87% of our industry is paid for either through long-term care insurance or the sale of a resident's home, support from family members, retirement funds, and so on. So very little of it is supported through government funding. And that's really had a negative impact on the industry throughout this crisis. But even with these challenges, which, as I mentioned, we're still in the midst of, we believe the long-term outlook for senior living remains strong. Assisted living sort of started about 30 years ago, really in response to some of the concerns around what was going on in skilled nursing facilities and nursing homes, and family members and their loved ones were looking for an alternative, and assisted living really became an option for people that were looking and needed care outside of their private residence, but were looking for really more of that person-centered care, that option for having your own room. It is their home, and we're predominantly have private rooms, looking for socialization and engagement. And we think that still remains strong, just like the opportunities that Susan mentioned with the Greenhouse Project as an alternative to nursing homes. We think our product meets the needs of seniors looking for engagement and supports and services. But we need to recognize that COVID-19 could bring some permanent changes to the industry, and we need to be ready to adjust as needed. And these changes could come in the form of certainly operational changes to dining services, or building and community design, or visitation and screenings, certainly enhanced infection prevention and control, and staffing considerations as just a few examples. And while a lot of these changes will be driven by the providers themselves, and most importantly, driven by resident demand, because again, as a private pay component of the long-term care continuum, the residents and their family members ultimately sort of drive the direction of where our providers go within the scope of the state regulatory framework. But we anticipate that there will be changes from a legislative and regulatory perspective at the state level, and even potentially at the federal level, taking a look at issues like infection prevention and control, emergency planning, reporting requirements. And really, we're looking forward to and looking for opportunities to engage, particularly at the state level, with lawmakers and regulators on how to address some of these challenges on a go-forward basis, but really in a way that prevents what I would call the institutionalization of care in senior living communities, which is really what we need to avoid. And Susan's example of people in greenhouse homes being able to get up and have breakfast when they want is a great example of the choice that seniors deserve and are entitled to when they live in our communities. And so what we need to make sure is that even well-intentioned changes to the regulatory framework can't institutionalize that model and take away that choice for seniors, because that's what they've earned it. They deserve it. It's their right. And really, one of the things that we learned going throughout the COVID-19 crisis was that senior living was really a misunderstood industry. There continues to be confusion among the media, consumers, lawmakers, and the general public about who senior living serves. We now serve, sort of when you take into account independent living, assisted living, and memory care, over 2 million residents a year live in our buildings, in their homes, which are managed by our providers. Our industry is regulated at the state level, not at the federal level. And as I mentioned before, we're financed overwhelmingly through private pay, which is far different from other more traditional nursing home or skilled nursing facility types of settings. And there's been an incredible amount of confusion around that as we've gone through the COVID-19 crisis. But even outside of keeping an eye on and engaging in policy discussions as an industry, we're still working to advance several initiatives with an eye towards the future for senior living. And one area of focus, which has certainly been fast-tracked due to COVID-19, has really been around quality care and improvement across the industry. And this includes everything from combating any form of elder abuse, enhanced infection prevention and control, providing opportunities to advance the senior living profession through credentialing and certification programs and professional advancement, and also focusing on the need to grow the long-term care workforce, which Allison and Susan both mentioned is a critical issue for our industry moving forward. And we need to develop workforce development opportunities and initiatives such as apprenticeship programs to encourage people to come into an industry that's passionate about providing care, but also show them a career path to advance. We've got to give them some way to continue to make this a career, not just a job. And so we're working on spreading that message around rewarding career paths to prospective employees. And really in the business of caring for seniors, that involves more than just direct support. We've got opportunities in sort of all sorts of areas: sales and marketing, facilities management, operations, finance, development, HR, and much, much more. Really from a federal policy level, and as Allison alluded to, the Biden administration is looking to really expand more care into what I would call the private residence, into the home as opposed to an institutionalized setting. And we think that that's a great start. We're also looking to get support for investment in senior living infrastructure as we think about the impact of COVID-19, specifically investments in systems to prevent infectious diseases such as air quality and HVAC systems to reduce transmission of viruses, upgrades to water purification systems, investments in capital projects that can expand open and outdoor spaces to support social distancing and visitation, physical plant alterations to ultimately support cohorting in the event of an infectious disease outbreak in a building, installation of touchless devices and fixtures to reduce the spread of diseases, as well as really focusing in on use of technology, whether that's wireless infrastructure to support telehealth capabilities or expanding resident safety systems for surveillance tracking, robotics, internet-enabled devices, and so on. But moving beyond infrastructure, we really need to consider how long-term care services and supports are delivered. And senior living is, as I mentioned before, a successful model because it's driven by resident demand. And while we expect it to continue to grow and serve an expanding population of seniors, it is only one part of the solution. And so we need to consider support for family caregivers. We need to be taking a look at expansion of home care and home health through Medicaid and increasing Medicaid reimbursement. Other programs addressing social determinants of health need to be considered. We certainly need to consider investment in long neglected skilled nursing home system, but also how do we expand a successful private pay model by establishing new and tax advantaged insurance and financial products to support paying for senior care. I can tell you from a personal example, I had an aunt who needed services and supports, and she had 7 nieces and nephews, all willing and able to step up and help her financially to get the care she needed. How do we help more extended families find that opportunity to support the needs of their loved ones? We also need to think about this massive middle market that's sort of in the middle, that falls short of the private pay model that we have today and doesn't qualify for Medicaid. And how are those millions and millions of seniors going to get the care and services? Some will be able to stay in their private residence, certainly, but some are going to need continuous care in a congregate setting. And so we need to take a look at leveraging affordable housing development tax credits and marrying that with home and community-based waivers That's a model that's been used in Illinois with great success and should ultimately be expanded elsewhere. And so we're encouraged by the industry's outlook and have every reason to be hopeful for the future, but there's still a lot of work to be done. And we certainly want to be part of the solution.
Okay, thank you. So do we have any questions for any of the panelists? I've got a couple here myself. Okay, first for Susan. Do you think any type of funding toward the greenhouse project constitutes community reinvestment under the state banking laws? If not, is there something that some of the state legislators can do to help with that?
I wish I knew the answer to that. But that's a great question that I'd love to explore that as an option. Thank you.
Okay. And also Allison mentioned about other countries doing a better job than the United States does on how they set up their long-term care. Allison, do you think anything that as legislators we could do, or is more maybe possibly with the infrastructure plan that the Biden administration had could help with this, or what do you think?
One thing I think about that some countries have done really well is create flexibility in how long-term care funding is spent. And I think coming from the states, there's some control over that when the dollars are coming through the Medicaid programs, right? And how those dollars are spent, but also the voices of the state saying that if you're going to infuse more money into these programs, we want to have flexibility over how these dollars are spent. I mean, I used to live in California, and California had a program called the In-Home Supportive Services Program. And in that program, dollars for caregiving could go either to a family member to provide the care or to a formal caregiver. And so you could just imagine the flexibility that would give families to be able to meet family members' needs for long-term care without facing financial insecurity themselves. And then, I would love to see these models have flexibility so that dollars can go into programs like to think really about what does community-based mean under home community-based services, and to try to build up that piece of the funding streams as well. So I think both states innovating, with the money that comes in, because a lot of the home and community-based services programs are under Medicaid demonstration. And so, without even having to legislate, there's the chance to be able to redefine the kind of the locus of where those dollars are going and how we think about long-term care. Is that responsive?
Okay. I think we have a question on Zoom. Deborah Ferguson. Deborah?
Yes, thank you. I just wondered if the panelists might address a little bit, you talk about certificate of need. That's always a pretty controversial subject in our state. Of course, the nursing homes tell us that, when you get rid of certificate of need, then you have a lot of competition for the highest paying patients, and Medicare costs go up. What about states who have gotten rid of certificate of needs? Are those things true in those states, or can you sort of address that impact?
That is absolutely not the case, for sure. I can, name states where that has not been the case at all. It's really interesting to me that, it was deemed an archaic law years ago, and there's so many people have opined on why it's important to get rid of it altogether, because it disincentivizes innovation. And those that have gotten rid of it, it has not really been a problem. I consider it's really the lobbyists and on the nursing home industry side of things that want to control what happens and how it happens. But in terms of innovation, I think, once we get rid of it, then I think we can see more greenhouse. I can list so many states right now that have developers or operators who would love to bring greenhouse to their state, but to go through the CON process, beds in the state of Maryland, as an example, are running at $150,000 to $200,000 a bed to buy a bed to be able to build something, which we're trying to do in the state of Maryland.
Okay. Also, I think on Zoom we have Jim. Jim, you have a question? I'm thinking Jim's Gooch.
Yes, thank you, Mr. Chairman. My question, I guess, is for Susan Grimes. I think we all would agree that for ourselves or our family members, we would much rather have the greenhouse project options, and certainly it's much better. But it appears to me that those types of facilities are more of what I would consider assisted living facilities, where residents that are in those facilities are able to provide some of the their own, they can walk to the dining room area. They may be able to take their own showers, or they can do those sort of things, where someone that's in a traditional facility, especially skilled care, maybe they just came from a hospital where they still have a trach, or they still have an IV, or they have to have extensive rehab, or some of those types of things where, and we know that with COVID, people who have more underlying conditions and have more problems like that are more prone not only to getting the virus, but also dying. I'm just wondering, is it really fair to make that comparison when we're considering possibly different populations? Where some people are able to do some of the duties themselves, and others are maybe they no fault their own, have a lot more serious health questions. So that's my question. Is it really a fair comparison to compare the deaths in that situation?
Well, I can tell you that we did some research and we really compared ADL function, assistance with daily living tasks, and there was no difference. In fact, I'll give you an example. In Boston, there are 2 greenhouse homes that serve individuals living with Lou Gehrig's disease, 4 individuals on ventilators. And so it's really amazing to me. And as a nurse, I can tell you, when we're really focused on person-centered care, to have a small environment in which the home is such a visual reinforcement of who they are, they're in a home, and what that does to their ability to just say, I'm in a home. I think I could get up and go to the dining room table, because the dining room's not at the other end of the hallway. That is prohibitive for me to make it, but I think I might be able to make it. So we care for the frailest of frail. We care for them to the end of life. When I talked about empowerment through education means we equip nurses with skills so they're able to support them to the end of life. We've done research on hospitalizations. Hospitalizations are lower in a greenhouse home because, as a nurse, early detection is critically important to pick up on something before it gets far worse. So we can care for the same population, the incredibly frail, vulnerable population that the traditional nursing homes care for as well. That's not a problem at all.
Do we have any more questions? Yes.
Thank you. All the presenters did a great job on this. And my question, it really is for Susan. The numbers that you produced that showed how many people actually perished as a result of COVID in greenhouse homes versus the rest of the population was pretty phenomenal, I thought. Did you take those same numbers and compare them with normal death totals from a previous year? Would the statistics be significantly different?
That's research that wasn't done. I mean, COVID has hit us hard, and it has certainly, when it hits somebody that's got those pre-existing conditions. I mean, obviously, it's remarkable to me that so many recovered from COVID. We did not compare mortality rates from the year before to see how that compared, if that's the question.
Yes, that's it. That's the question. I was interested to see, because obviously in that type of a setting, there are deaths on a normal basis from routine types of ailments.
Seasonal flu and all sorts of
Correct.
other things. Sure.
Correct.
Right. Well, and again, empowerment through education. We really support them with palliative care and really help them to know how to support people with serious illnesses, and equip nurses and care staff with the appropriate skills.
And the results were impressive. Thank you.
Mm-hmm.
Any more questions?
Yes, I have one.
Yes.
The greenhouses look very appealing. Who's the payer for the most of those?
The payer would be the same as a traditional nursing home, 3 payer sources. Medicare would be for short-term stays, rehabilitation. We have some greenhouse homes that do nothing but short-term rehab. If you think about rehabbing, would you want to go to a traditional nursing home or to a greenhouse home? Well, most people would probably want a greenhouse home. So Medicare is one. Medicaid is one. We did a survey, about 47% of people living in greenhouse homes are supported by Medicaid. And then the final would be private pay.
So on the Medicaid, the facilities look very nice. They look too expensive for Medicaid. So how were you able to, and many of the nursing homes have to or want Medicare to kind of subsidize the Medicaid patients. Are you able to make your model work on the Medicaid reimbursement?
And it depends on the state. I was sitting with someone at breakfast and we were talking about the pitifully low rates, Medicaid reimbursement rates in her state. So it depends on the state you're in. Arkansas, on the other hand, they have about a $10 bump a day in their Medicaid reimbursement rate if you're doing this type of model. So it's getting the payer mix right. We have found that people are willing to pay more, drive further to have their loved one in a greenhouse home. And so, you know, people are typically, depending on the state, once again, able to, we have people that in some states, they have very little Medicaid that they're able to have. In other states, we have people supporting about 70% of those living there on Medicaid.
How is medical care determined and get delivered in the greenhouse?
I'm not sure I understand your question. I mean, it's skilled nursing, so it would be, you know, the same staff.
How is it, but are they on site?
Absolutely.
I mean, in the house?
Yes,
So are they 24/7?
absolutely.
How many staff per house? You say you have 11 or whatever in a house?
So we've got 10 in a house. You would have 2 care partners on days and evenings, 1 at night. You have a nurse coverage going between 2 houses on days and evenings, a nurse to 3 houses overnight.
Okay, so you've got a care person all the time.
Correct.
With kind of roving or available nursing.
Absolutely.
All right, thank you.
Any more questions? Okay, I want to thank all 3 of the panelists today. Did a great job. We all know this is a problem, not just in my state, but every state. So if nothing else, I think next is lunch. Thank you. Thank you, everybody.
Well, good afternoon. This is the NCOIL NAIC Dialogue, and I'm Assemblyman Ken Cooley, the chair of the NCOIL NAIC Dialogue meeting. My colleague, Martin Cobboff from Indiana, is unavailable today. He'd hoped to be with us, but has had matters arise elsewhere. So I thank you all for joining us. I want to acknowledge that we have represented here our host insurance commissioner and immediate past president of the NAIC, South Carolina Insurance Director Ray Farmer. Thank you for your joining us and your presence here. I also want to acknowledge the presence of NAIC President David Altmeyer from the great state of Florida with us. Delighted again to have Oklahoma Insurance Commissioner Glenn Mulready. And I want to convey a welcome to Montana Insurance Commissioner Troy Downing, and welcome Commissioner Downing on your successful election last fall. So you're in that special category of regulators that are elected and not appointed. I want to acknowledge long-term Mississippi Insurance Commissioner Mike Cheney, and then also Mi Ti To, the New York Executive Deputy Superintendent, and congratulate you on your, I believe, somewhat recent appointment just before COVID hit, and probably changed your job description some as to the issues you were facing once 2020 hit. In your first 6 months, probably, that was a head turner, I'm sure. And then Dana Popper Severinhouse of the great state of Illinois. It's great to have you here acting insurance director of insurance in Illinois. I also want to acknowledge for the various members, we have representatives of your legislatures present. From the great state of South Carolina, we have Senator Ronnie Cromer of Prosperity, South Carolina, and then Representative Carl Anderson of Georgetown, South Carolina, and Representative Kevin Hardy of Loris, South Carolina. So I thank you for being here. Glenn, we have Forrest Bennett of Oklahoma City with us, Representative Forrest Bennett. And Mike Cheney, we have Senator Walter Michael of Ridgeland, Mississippi, and also Senator Dean Kirby of Pearl, Mississippi with us today. And I overlooked Insurance Commissioner Alan McLean, so I apologize for that, Commissioner McLean. And we, of course, have Jason Raypert, our immediate past president of NCOIL, with us today, along with Senator Matthew Pitch of Fort Smith, Arkansas, and Representative Deborah Ferguson of West Memphis, Arkansas, who's with us online as I am. And then from the state of New York, Deputy Superintendent Mee Tee-To, we have Kevin Cahill, who is an officer of the NCOIL as treasurer, joining us virtually. We also have Assemblywoman Pam Hunter, who chairs the NCOIL Health Insurance and Long-Term Care Issues Committee. Assemblymember Ken Blankenbush from Black River, New York is with us. And of course, Senator Neil Breslin, former NCOIL president and chair of our NCOIL Special Committee on Race and Insurance Underwriting. So again, thank you all. And with that, let me turn to our agenda and ask, I call the meeting to order and I ask that we conduct a roll call, and those members in the room, please announce yourselves. In the room, let's start there.
Representative Joe Fisher from Kentucky.
Very good.
Senator Ronnie Cromer, South Carolina.
Very good.
Senator Bob Hackett from Ohio.
Matt Lehman, Indiana.
Delegate Steve Westfall from West Virginia.
Senator Jason Raypert, Arkansas. I thought are you going to say something?
Representative Dear Rendon from Michigan.
Senator Paul Whelan, Missouri.
Senator Matt Pitch from Arkansas.
Representative Jim Dunnigan, Utah.
All right, I think that's the room at the table here.
Very good. So then lawmakers online, identify yourselves. I'm Ken Cooley, California Assembly member.
Kevin Cahill, member of the Assembly in New York.
Deborah Ferguson, Arkansas.
Senator Paul Edke, Minnesota.
Kevin Good, Kentucky.
Lana Tice, State Senate, Michigan.
Okay, and if that is it online, can I have a motion?
Sorry.
Oh, pardon
Wendy
me.
Thomas, Pennsylvania. Sorry about that.
No problem, Wendy. Thank you very much. Anyone else online? Members? Okay, well, with that, may I have a motion to waive the quorum? And then is there a motion to waive the quorum requirement?
Second.
Moved by Mr. Lehman, seconded. All those in favor, please say aye.
Aye.
Aye. Opposed? Hearing none, the quorum requirement is waived. And then can I get a motion to adopt the December 11th, 2020 committee meeting minutes?
So moved.
Moved by Mr. Lehman, seconded. All those in favor, please say aye. Okay, we'll count that completed. As we start our agenda, I want to note we are in this hybrid format and all of us are having sort of adjust our game plan. I think nationally to COVID and how we get work done. We've certainly had to adapt to these unprecedented times. And we certainly know in the insurance context, insurance lawmakers as well as regulators have had to adapt to these changed circumstances, and including how regulated entities can perform their requirements under the law. We do note that the NAIC has done a great deal in this area to try to support ongoing effective regulation and yet at the same time practical business needs in this radically altered business operating environment. And just want to acknowledge that that is an outstanding adaptation that the times has required. So certainly want to thank you all for just that work. I want to invite, just as we start, I welcome you here, Commissioner Altmeyer, and I wonder, just as a preliminary matter, do you have any remarks you'd wish to offer as president?
Absolutely. Thank you, Mr. Chair. Mr. President, thank you for having us here for this important discussion again. This is the first time I've been able to have a conversation without my face being pixelated on a computer screen. So I'm particularly excited to be in the room this afternoon. And thanks to all of you who have joined us virtually. We have at the NAIC long valued our partnership with NCOIL and the important discussions that we have had over the years. We clearly have a number of key issues that are on our agenda for this afternoon that are going to impact insurance consumers in all of our states. And the partnership between our legislative branches and our executive branches is going to be critical as we move forward in addressing those issues. And so myself and my colleagues that are here this afternoon very much look forward to this discussion. And with that, I think we should just jump right in it, Mr. Chairman.
Very good. Well, let's pick up with the update on the state adoption of the amended NAIC credit for reinsurance models. Obviously, this is an important model to get adopted in states around the country because under the global agreements, if it is not adopted, it undermines state-based insurance regulation, which is a common priority of both of our organizations. There's a timetable that applies 60 months from September of 2017. And there was a shorter timetable upon the occurrence of which was this past February that the federal government was going to begin conducting a survey of how states were doing in complying with the adoption of the revised reinsurance models in conformity with the covered agreements. And so can we get an update on how that is looking from NAIC's standpoint, as this is vital to state-based insurance regulation?
Absolutely. I think Director Farmer is going to tell you how Florida has just recently sent that to their governor and might even mention some other states as well. Director Farmer?
Thank you, David. And, good morning, Mr. Chair. It's good to see you even virtually, and good afternoon to everyone else. Mr. Chairman, you are correct. This is an extremely important issue to NAIC, to our legislative partners in state-based regulation. We are making what I would call good progress. You know, last year was a little bit of a setback with COVID-19, but some of us persevered on and got it done last year and did not have to come back this year to do what should have been done last year, Mr. Altmeyer. But we're making great progress. So the numbers are, and they're changing daily, as David just said. We're up to 26 states that have had the measure signed into law. We have 4 states currently with the legislation on the governor's desk, and we expect some of those to be signed as early as next week. So we're basically up to 30. We've got 18 or 19 others that have it under consideration, and we could add to that number by the end of this year. So we're headed toward the goal. I don't think we get any credit for the delay under COVID, so we're pressing on. As far as I know, there's been no discussions with FIO or anyone else about extending, nor do I think that would be fruitful. But we are moving ahead, and I think you can look for us to be carrying our load on this, our weight on this issue. And yes, we are aware that FIO is beginning to look over our shoulders and see how we're doing.
Very good. And I want to acknowledge, I'm sort of laughing here, the famed hospitality of South Carolina, and your remark to President Altmaier about the status of the adoption of his state. I guess that was sort of lobbing a pineapple his way.
It was indeed, sir.
Despite his best efforts, I still have a lot to learn from Director Farmer. So.
Very, very good. Moving on, so thank you for that update, and it continues to be a priority for the NCOIL to urge our member states and lawmakers to get this important work done so that we satisfy the requirements of these covered agreements. And I do think that the flexibility that the United States government have would be greatly limited by the fact that these are international agreements. So it is incumbent upon us to focus attention, even in the time of disrupted operations in state legislatures, to get this important work done. So moving along, we're to improve the flow of topics. We've got several subtopics, 3 of them under the main topic of the NAIC race and insurance issues. So the first one is just what has been happening at NCOIL. The 3rd meeting of the NCOIL Special Committee on Race and Insurance Underwriting concluded yesterday. This committee has been busy working on the definition of proxy discrimination from the standpoint of state lawmakers, and discussing insurers' use of rating factors in underwriting. If there's questions on that, I believe my colleague, Representative Lehman, can address those. We've also been following, of course, the NAIC Special Committee on Race and Insurance, and are interested in getting an update as to that committee's progress and timeline.
All right, thank you, Mr. Chair, and it's David Altmaier again. I'll take this one. This special committee has indeed been very busy. As you all know, this was a committee formed last summer under the leadership of Director Farmer, and is focused on 5 work streams up to this point. Those 5 work streams, there's 1 each for diversity and inclusion in the insurance industry, as well as in the insurance regulatory departments and at the NAIC. And then the other 3 work streams are related to each of the 3 major areas of business, 1 for life, 1 for health, and 1 for property and casualty. The full committee has had 3 public meetings so far. Our most recent one was this past Tuesday in conjunction with our spring national meeting. At that meeting, the committee heard status updates from each of the 5 work streams. Each of the 5 work streams submitted a report that included recommended next steps or charges for our special committee going forward. We had some really good discussion during that public meeting with a broad spectrum of stakeholders. We appreciate the letter that you all sent to us on that, and we will get to that in just a moment. We currently have a draft set of charges that are exposed for a 30-day period that began this past Wednesday. So if my math is correct, that concludes on May the 14th, at which point I anticipate some additional discussions with respect to that. Just to underscore, we are certainly committed at the NAIC for having a very thoughtful and deliberative process with respect to this. Issues such as unfair discrimination, unfair bias, proxy discrimination, disparate impacts, these are all very complex issues. And so while progress is important, we need to make sure that we are being deliberative in order to avoid creating unintended consequences in our markets. State insurance regulators have been discussing these issues. For example, last August, we adopted a set of guiding principles on artificial intelligence. These principles included a non-binding concept encouraging industry participants to take proactive steps to avoid proxy discrimination against protected classes when using AI platforms. And so we're looking forward to more work of that nature continuing across our letter committees, our executive level task forces, and our special committee. We are aware that NCOIL is working to define the term proxy discrimination. I understand there were some good discussions yesterday and also during your last meeting. Do feel compelled to offer some initial perspectives from some of our members that have raised some concerns with respect to the direction of this at this point, as essentially restating current laws that already prohibit intentional discrimination and might not take into account the technological evolution that's taking place in the insurance sector and the concerns surrounding availability and affordability of products to individuals of certain demographics. And so we're looking forward to continued engagement on that as we work through our own process and as you all continue to work through yours as well. We do intend to continue moving forward with this work. As we discussed when this was formed over the summer, we view this as a very long-term project. We don't think that this will have necessarily too many short-term deliverables. And so we will have a significant opportunity for engagement and collaboration. Happy to pause there, Chair, if there are any questions. I know there are a couple of different items that we wanted to touch on during this portion of the during this topic of the agenda, but wanted to pause there to see if there were any questions about what we've done so far.
Well, I think a big question is partly a process question, I think, that we have an interest in. And I will use an analogy from the California legislature. As COVID hit, it forced a change in our typical procedures, how hearings operated, how people participated, the concern for social distancing. Just a lot of changes were imposed upon our system. And this actually led to us in both the Senate and the Assembly going back and examining the state constitution for the rules it laid out for how these bodies conduct themselves. So we are a body subject to rules which we have to adhere to. And it constrained our options in order to comply with our Constitution. And so with respect to the process that you've established, there are some basic questions about how does this conversation relate to precedent in the organization, the use of a special committee, the idea that a special committee, since of course there is no parlance in your bylaws for a special committee, you have working groups, you have committees, you have task forces, your public records rules don't relate to the work of a special committee. The idea that a constituted quote unquote special committee would be a coordinating body. What exactly does that mean? What is the authority that is vested in a special committee? Where is the authority for that in your organizational documents? Just as we had to ask ourselves, what's the authority for how we conduct our business? That's the general question we have, is just tracing the authority and the foundation for discussion, because that then gets into what is the basis for calling a closed session. So if you can comment a little bit about that, and then I will invite questions from colleagues in the room or online.
Certainly, and thank you, Chair. And that was actually the next topic on my list, so it's a good segue into that. So first of all, just a couple of things. The NAIC does have an official policy on open meetings, which I hope that you each have a copy of, and if not, we're certainly will facilitate getting that to you. And so the special committee is subject to the terms of our open policy proceedings. So taking on the question with respect to the title of the committee first, special committee was just simply a title that we used in order to underscore the importance of this particular work. Outside of that, the term special committee has no special treatment or what have you with respect to how we govern the operations of the special committee. We are treating the special committee for purposes of how it is processes are governed, essentially the same that we would treat any other executive level task force. And so again, the term special committee was just simply a way for us to designate that this is an issue of critical importance to us. That being said, the special committee and its work streams had a blend of public and open meetings as well as closed meetings. The closed meetings we felt very comfortable met one or more of the criteria that are contained in our open meetings policy with respect to our ability to close into a regular session. It's important to note that at no point did we make any decisions during a closed meeting. All of the things that we have proposed have now been discussed in open and transparent meetings and have been exposed for additional comments from our stakeholders as we do with any number of regulatory items. With respect to the coordinating aspect of this particular special committee, this work will cut across a broad spectrum of the insurance segment and therefore will cut across a broad spectrum of ongoing NAIC work streams, particularly with respect to the work that's ongoing at our letter committees. And so we have characterized this as a coordinating body in an effort to streamline and make more efficient the work streams that are already ongoing so that we don't have redundancies in our process and to hopefully make that process a little bit more efficient there.
Well,
Pardon me.
a question just by way of response is typically the way organizations exist, you have bodies, they assign work to committees. That is a delegation. And the delegation is what it is until it gets revised. Most typically, it seems in my experience, the NAIC, the assignment of duties comes through the executive committee process. So it still doesn't really answer what differentiates the special committee that they have the authority to modify work delegated by the executive committee. I mean, it just seems you've got a body that is poised to provide a great deal of direction across the NAIC organization that is differentiated from the executive committee where, most matters of structure, because when you look at the definition of your executive committee, its role is actually to set up the structure and assign the work. So it seems you have a select committee that's doing the work of the executive committee without an explanation of how that is done. And to me, this is analogous to us in California needing to re-examine how we do our meetings so that it aligns with law, because that's the foundation of everything.
Well, thanks for that question. So to be clear, the special committee does have charges that have been assigned to it by the executive committee. So the executive committee has approved and delegated to the special committee the charges that they're currently overseeing. The charges that have been exposed by the special committee, once they have been approved or adopted by the special committee after we followed our normal process, those will also go to the executive committee to be approved by that body as well. That's a process we have followed with all of our other executive level task forces. And so charges that are being delineated to other NAIC work streams will go through that executive committee process like we have done historically. So again, even though we called it a special committee, we are treating it exactly the same way we would any other executive level task force. We would anticipate that once those charges have been approved by the executive committee, the letter committees that are assigned those will follow their normal process in adopting those charges, which has historically been very transparent at the NAIC and will continue to be so. And so I do think that the special committee has been delegated charges in the same manner as our historical level task forces have been in the past.
Well, on that historical point, historically, aren't discussions of charges in a public setting at various meetings? I mean, it still is unusual, I think, to call it internal matters and have a great deal of substantive work direction come out of it without public commentary. I mean, we go through our budget process. Everything gets exposed in conversation.
Right. So each of our work streams had public meetings with the exception of work stream number 2, which is exploring diversity amongst the insurance departments. And so we did solicit public comments on the charges before we had the open discussion on Tuesday. And we solicited public comments on those charges during that meeting, and we are now engaged in a 30-day exposure period for the charges as they've been exposed. And so I do think that's actually very similar to what we've done in the past on this item.
Yeah. Well, thank you, Commissioner Altmaier. I want to open it up to any colleagues that have questions.
Senator Rayford.
Yes, Mr. Chair, and I appreciate you for being here, President Altmaier, and all of the commissioners for being here. Since it's open floor, I want to ask about maybe one of my favorite topics, Mr. Chairman. What's the NAIC's posture now on sort of the PBM legislation that you were working on, the model that you were working on?
Sure, I'll take a crack at that one. My understanding is that at its last stop, there was some discussion around the PBM model. I believe it went to the Regulatory Affairs Framework under our B committee. I think there were still a couple of pending items that needed to be discussed amongst regulators, and so they held off on a vote on the final PBM model at that time. And the group that's been working on that is going to take a look at a few additional items that are pending and bring that one back at a later date. Would welcome any feedback from other commissioners if they were part of it.
I specifically would like to ask, because and sorry, I haven't looked at it lately, but is your model going to encourage that PBMs be covered by insurance departments in each of the states, or have you left that open-ended?
Senator, to be candid, I'll have to check on that to find out. I don't know the answer, but would be happy to. Director Farmer, do you happen to know that one?
I think currently it's probably open-ended, but a number of states, including South Carolina, Senator Cromer was our drafter and sponsor of the bill that we passed last year. And it is in the Department of Insurance where we think it belongs.
Right. Well, I appreciate that. You know where my voice is on that, Commissioner Farmer. And all I will tell you is anything that we can do to be of assistance, because I will tell you that in spite of all the good things that have happened, even though that the NCOIL model has been utilized in many states to start their own conversations, these entities just continue to morph and do their best to end run anything that we do. And I reiterate, especially for the PBM and the PCMA folks that may be listening, I have no problem with people doing business. I just want them to do business fairly. And so I appreciate the focus the NAIC has put on that, and for all the legislators in the various states that have made a difference on the issue.
Well, thanks, Senator. I recall you visited our NAIC meeting one year and made a number of presentations that we found to be insightful. So thanks for your engagement on that issue. Commissioner Mulready, did you want to make it?
Yes, thank you. Just to add on to what President Altmaier said, Senator Rayford, I think the hang up, if you will, or the details, more feedback specifically to the drafting notes in the model act that we've got going.
Very good. Thank you very much. Thank you, Commissioner Mulready. Well, to close out the prior topic, I think President Altmaier, I appreciate your comments. Obviously, issues of race are highly sensitive topics. And personally, I think the use of unfamiliar nomenclature, in my experience, years ago, NAIC did have a body that had a coordinating role in the area of climate, but I don't actually recall it as providing direction to the other committees. I just think that in your organizational life, units get delegation, and I think running the traps on how decisions get made, how responsibilities get allocated, really vest in the executive committee. And when direction starts coming from other bodies, that's anomalous within the organization. And I certainly think that in the time of COVID, it is incumbent to provide for opportunities for comment which are meaningful time-wise. Some of the associated timeframes for comment in the special committee have been very short, And that makes it difficult for people to reflect upon, as you say, you describe it as a deliberative process, but commenters need opportunity for deliberation. That invariably takes some time for reflection. So I just, honestly, I would say, I think it is well to go back and look at the specifics of your public records document, because I've looked at that and trying to line it up with the bylaws and the role of the executive committee. You've taken a highly sensitive topic and conjured up an organization that doesn't mesh with what you've done in the past as an organization, how your bylaws are laid out, how your public records, open records. It's a level of improvisation on a topic of first importance in the life of our country that seems less than judicious, given the long established workings of the NAIC through committees, working groups, task forces. So that I will just leave it at that. I'd like to turn now to the New York DFS circular letter number 5 regarding diversity in corporate governance. And on this topic, I'm going to turn to Representative Matt Lehman.
Thank you, Mr. Chairman. And I think, I believe we have, is it Meet Toe on Zoom, because I think this stems from them, but just a couple of things that have, I want to address maybe, and that is that we've heard, as the chair has said, regarding NAIC's work on the issue of race and on NCOIL's issue on race. About a month or so ago, the New York Department of Financial Services issued a circular letter discussing New York domestic foreign insurance companies working towards their DEI efforts that make diversity of their leadership a priority, key elements of their corporate governance. And as we look at the collecting and publishing of data, board tenure, keyboard, senior management roles, these are pretty heavy lifts. It gets into a lot of the collection of data and publishing of data. And while we all agree that this increase is to be applauded, it is a bit of a concern that this is being done more from a regulatory standpoint. I think I'll cite, if I may, Chair Cooley's own state, which moved to have some diversity requiring at least one racially, ethnic, or diverse board director by 2021, which was done by the California legislature. And so when you're a group driven by legislative, regulated by you, but laws put in place by us, when we start to see things like this, it does raise a little bit of a concern as to what is being done legislatively versus regulatorily. So I don't know if somebody from the NAIC wants to address that. Do you envision more departments going down this path? Do you envision more structure around these as we move forward with your committee doing what it's been doing? We're getting in now to more the issue of, I think you had talked earlier, Commissioner Altmeyer, about the 5 paths. And I know Commissioner Farmer, I talked about this a year ago, where we have focused on the products. You guys have gone into more the industry. And there's some concern when you start talking about boards of directors and some things like that. So maybe can you address that, or New York address that as to where's the kind of the goal of this long term, and does that become part of a regulatory, whether it be accreditation or things like that? And so then where's the legislative role in that versus the regulatory role? So I don't know if that's something that the NAIC here wants to address, or New York wants to address, or Ken.
Okay, well, I'm happy to kick off, and I know Meet is on the Zoom call, and certainly Meet, if you'd like to speak specifically to New York's, what New York has done in their circular letter, I certainly would love for you to have the opportunity to do that. I would say that this is an issue that's very similar to many other issues that we deal with at the NAIC, in that while we certainly use the NAIC to strive for consistency across all of our states in terms of how we are regulating our markets, certainly each state has jurisdiction over their state via their legislative bodies and their executive branches. And so while we will have these kinds of discussions with our first work stream under the Special Committee on Race and Insurance with respect to what are ways that we can explore increasing diversity and inclusion in the insurance space, as that work progresses, there's nothing stopping a state like New York from proceeding with their own efforts. And so I'll leave it at that and see if MITI wants to talk specifically about what they've done in New York with their circular letter.
Sure. Thank you, David, and thank you for the opportunity to talk to you this afternoon. So what I can do is provide a high-level overview of our recent guidance and explain our process that led to the issuance of the guidance. And before I start, though, I'd like to acknowledge our very own New York Senator Neil Breslin, with whom we've always had an open dialogue on many insurance topics, including diversity. As was already mentioned, in March, mid-March, we issued a circular letter that focuses on diversity and corporate governance. It's addressed to all New York domestic and foreign insurance companies operating in New York. And this guidance was issued following extensive research and discussions within industry, and that was intentional. It was very clear to us that we had to have a very collaborative approach, and that's what we did. It was mentioned earlier that I've been in my position for a little over a year. COVID did delay some of our discussions, but by the end of the year, we resumed. And I would say, in sum, the result of all of our discussions with industry is that there are a lot of initiatives and significant commitment existing today in our industry, in the companies we regulate, on improving diversity in the industry and in these organizations. So we framed our approach as what is the best way for us as a regulator to support those existing efforts and that existing commitment. And the result of that inquiry is the circular letter that was issued. And just to sum it up very quickly, it really makes 2 points. It outlines an expectation that insurers make diversity a business and corporate governance priority, as was mentioned before. We really don't say how insurers are supposed to do that. It's deliberately not prescriptive. We considered many other approaches taken by other regulators and in other jurisdictions, other countries, including in California, the approach of the quotas. And we deliberately did not go in that direction. Our approach was that based on the studies and based on what's happening in the world, including investor pressure on insurance companies and other companies to hold companies and businesses accountable for increasing diversity, we felt that this should be treated as a business priority. Companies know how to implement their business priorities, so we're not in the business of telling companies how to do that. So as I said, it's not prescriptive. Interestingly, in our informal outreach, because before we issued it, we really bounced the concept around to make sure that it would be well received by industry. And some of the feedback we got from industry is that they would actually like some help around best practices, because, as I said, a lot of companies want to make effort, but have obstacles, don't really know how to do it. So in response to that feedback, we did not put anything in the guidance on specific practices we expect companies to follow, but we will host a webinar focused on best practices at which we will invite industry to come and share and learn from other people's experiences. So that's number one, high level expectation that diversity be made a business and corporate governance priority. Number two is, as was mentioned, an effort to collect and publish data relating to the diversity of boards and management of companies, New York domestic and foreign companies. And why are we doing that? In our research, we realized that there is really no data out there that is specific to the industry, to the insurance industry on diversity. And industry participants actually mentioned that to us as something that was lacking, because it did not, the absence of data meant that companies didn't know where they stood compared to their peers. And so to remedy that and to really increase transparency, we concluded that collecting this data, publishing it on an aggregate basis would be helpful to the industry, because it would allow companies to see where they stand compared to their peers. And we hope that transparency is going to be a powerful motivator to for companies that are below the average to strive to improve diversity. So that was the thinking. This data and collection effort, we were very concerned and focused on not imposing an undue burden on smaller companies. So we used a cutoff of $100 million in annual premiums, New York premiums, to exclude some of the smaller companies that might find this collection, overly burdensome. We're planning to collect data on the diversity composition of boards and senior management, so not the entire workforce, again, in an attempt to really focus on the top of the house, the top of the organization, and to make the effort, not such a huge data collection effort. So we are planning to collect the data over the summer with the expectation that we would publish it in the fall on an aggregate basis. And we are designing our collection survey to gather information about, for example, the type of insurer, the size of the company, and other relevant factors, so that we can slice and dice the information in ways that we hope are useful to the industry. So that's really the letter. Let's see. I think we did encourage companies to disclose publicly this diversity data as part of their DEI efforts, but we are not mandating it. So that was just a strong encouragement. And that really is it. I'm happy to answer any questions about the letter or the process or the feedback. But actually, one more thing in terms of the authority, since that was asked. From a New York perspective, obviously that's all I can speak to. Our authority, we believe, exists both in the broad mission of our agency to promote the financial stability of our industry. We believe issues of corporate governance clearly fall within that purview. In fact, there is a model law, an NAIC model law that is an accreditation standard on corporate governance that includes a question dealing with diversity policies. And so we really believe that falls in the scope of that authority. So with that, I'm happy to answer any questions.
Thank you very much, Commissioner Mitito. Representative Lehman, do you have a follow-up comment?
Yeah, and there might be some questions in the room as well. I guess the notes I have written here is thank you for those comments. A couple of things I hear there do cause some concern from a legislative standpoint, and that is when we start to, I think a couple of terms you used is investment pressure and publishing data to create pressure upon these companies to adapt and expectations. My concern would be and I know you set it at $100 million limit, but what do you do with like a mutual company that doesn't have that investor pressure? What do you do with maybe privately held companies where their board is more or less their family members, not a real diverse group? So are there any parameters that you would take, that you take into consideration and say, well, we're not mandating this, but I think initially even in the bulletin, it refers to first steps, which whenever you have a reference like first steps, it means there's normally going to be a second step and a third step, et cetera. So I'm kind of laying the groundwork here as a legislator, is what to expect to be brought to us as, these are things that we want to see put into statutory code. And so maybe initially focus a little bit on what do you do with the companies that fall outside the 100 million, but meet the criteria of, not a mutual company or a privately held.
Yes, I'm happy to answer that. The data collection has the $100 million cutoff for the reasons I explained, but the guidance generally applies to all companies, regardless of size and regardless of corporate form, whether they're a mutual company or otherwise. I did mention investor pressure as just a data point for that we considered, understanding, as you correctly point out, that certain types of companies are not going to have public bondholders or investors. And the basis of the guidance, and I'm sure you have seen it from the actual circular letter, is vast body of data and research around diversity, making a compelling case that increased diversity at the top of organizations is good for business. And you can read the circular, there's a lot more detail there. And as financial regulators that are focused on strong financial performance of companies, that's why we're focused on that. We want our businesses, we want our companies to be competitive, we want our companies to innovate, we want our companies to have access to the best talent. And that's why we're focused on it as a financial regulator. So I think that addresses, hopefully, or tries to address the part of your question. In terms of first steps, next steps, I think the idea there was, we believe that there is, as I said, really a lot of effort already underway. Maybe all we need to do is issue this circular letter, and there will be no further step. I think the reference to as a first step is really to say that we'll see what happens next. And of course, we will always be in dialogue with our own legislatures to make sure that to the extent we need legal authority, statutory authority that we do not have as a regulator, we will make sure to seek that. And that's why the dialogue with Senator Breslin and others is so critical.
Very good. Thank you, Executive Deputy Superintendent Miti To. I believe Senator Bob Hackett wanted to ask a question or offer a comment. Senator Hackett?
Bob said he's good. Is there anybody else in the room here that has a question? I think we're good in the room here.
Okay. I definitely want to thank you for that explanation of the circular. Companies need to operate in the American and the global marketplace, and I do think that's important. I'm sitting in front of the flag for the city I helped found, and in the 2000 census, little old Rancho Cordova was identified as the most rapidly diversifying place in California during the decade that led up to that. And number two, for all of California's diversity, number two in the state for diversity right into our individual neighborhoods. And this has led to it actually is unusual. We have more commercial office space in Rancho Cordova than in downtown Sacramento, which is 12 miles away. And in fact, it's been referred to as insurance gulch because an awful lot of Fortune 500 companies put their offices here, which just says that, among other things, it is good business to have businesses that are populated by people who reflect all of America's markets, all global markets. And it does support credibility in the marketplace, but also supports a sensitivity to the variation within those markets. So I thank you for your comments today, and I do thank you for persevering. It surely was sort of a wild ride over the course of the last year and a half. So the next item I'd like to turn to then, noting the time, we've previously talked about the proposed changes to the Statement on Statutory Accounting Principles, SSAP number 71, the Policy Acquisition Cost and Commissions. We've had several discussions on this topic, including in Tampa most recently. And there's questions about how that will work, how it may disadvantage certain organizations. We at the NCOIL were hoping in this area of commission funding agreements that some carriers enter into with third parties, that it was perhaps a more nuanced subject than this particular statement of accounting practices provided. And we have definitely felt that there are substantive changes present in this circular that will have a significant impact on a number of insurers. And we were looking to kind of a phase-in period to allow companies to adjust. And just wondering, is there an update, Mr. Altmeyer, for any of your colleagues who have not yet spoken on SSAP number 71?
Sure, and I think that at lunch today, I was also designated this particularly non-controversial item to discuss as well. So thanks to my colleagues for that, but they're welcome to chime in as often as they would like here. I did have the opportunity to discuss this with you a little bit while you all were in Tampa, and I attended virtually from Tallahassee. Thanks again, by the way, for coming to the Sunshine State. So the update on SAP 71 since that point in time is that we've had a number of our working groups and task forces advance this revision through its process, and it landed on the desk of our E committee, which is our financial condition committee, on March 15th, where the E committee adopted the proposed revisions. I want to highlight just a couple of things from that that I think were the subject of some of the discussions we had in Tampa. Firstly, there was well, let me back up just a step for those that might not necessarily be familiar with SAP 71 and what we're attempting to do here. Back in 2017, a state insurance department, through our examination process, identified a carrier that was using this type of
are telling sad stories.
I'm not sure if that's a question or just okay.
I think someone make sure everybody has their mute on. Okay, go ahead, Commissioner.
Sorry about that. All right, so we identified a carrier that was engaged in this accounting process, and the state insurance department felt as if it was not in compliance with SAP 71. Subsequent to that, in 2019, we began revisions to clarify SAP 71 to confirm that. Since that point in time, we have identified only 4 insurance companies that this revision would impact. So with respect to the substantive nature versus non-substantive nature of this change, that is a basis of the fact that we did not believe that this change represented a significant shift from the accounting policy. So it wasn't a factor of how many dollars of impact it might have to these 4 firms. It was because we felt like this was the accounting practice previously, and we were just clarifying the intent of that because of the difficulty through that particular examination process. That was reaffirmed by the working group and the task force, and then subsequently our financial condition committee as recently as this past week on March 15th. They adopted an effective date of December the 31st, 2021. At least 2 of the commenters that have been engaged in this issue requested that the effective date be no later than December the 31st, 2021. And so we believe that was responsive to some of the comments that we received at that point as well. We had also discussed grandfathering. That concept was considered by the various working groups and task forces, but ultimately determined not to go down that path. Because of the small number of firms that are engaged in this practice that we have found, we felt as if our current framework for carriers to get permission for a permitted accounting practice from their domestic state regulator would be the most appropriate way to handle those. So typically, in terms of next steps on this, when our financial committee adopts things of this nature, we would generally consider that at the following plenary meeting, which we held a couple of days ago. Because of the discussions surrounding this issue, we pulled this item off of that particular agenda so that our members and our stakeholders could give it further consideration. And we will have another discussion about that at our next scheduled plenary meeting to take place within the next few months. So that's the status of that particular accounting treatment. I welcome the input of any of my colleagues from the NAIC on that item. And if they don't have any, certainly would be willing to take questions on that item.
So I have a question. If with an implementation date of the end of the year and taking no action really on this until September, how would I, if I'm one of those four companies as you cited, how do I prepare? I mean, I guess I know it's coming. Is it a done deal or?
It's not quite a done deal because it does have to be approved by our plenary body, which is the entirety of our membership. But I would just say that given the discussions that have taken place at our working group, task force, and committee levels, I would be surprised if there was a change at the plenary in terms of the outcome of this. So because we've been working on it since 2019, I would expect that these four carriers would have hopefully been considering the possibility that this change was going to happen and be making preparations to accommodate that.
So maybe a follow-up on that is, you said you cited four carriers this would impact. I guess I'm heard from others that it may be broader than four, four that we know of, but as this comes out, is there, and you indicated that there was actually some discussion of delaying this, but I guess, this is an interpretation that came out after, I think this has been around for about 22, 23 years. Is there a reason this has to be put in so quickly? Is there any reason to hold this a year? I mean, I'd rather have a year's notice or 3 years notice even to implement this kind of an impact. 'Cause this is going to have a pretty serious impact on at least on those four and others who might be brought into this. I think it's a bigger impact than something I could pivot and handle, in a 6-month period. So has there been some discussion on the NAIC level of maybe doing this, but doing this in a more of a delayed fashion, or bringing this in a little bit on a drifting it in versus, or phasing it in versus this, it's going to be this date period?
I would say that yes, that consideration was given to phasing it in, and ultimately the working group and task force and finally the E-committee determined not to implement a phase-in period, primarily because I think you all probably are well aware our insurance industry is not shy. If there had been more than 4 carriers, I think we likely would have heard their commentary through this process by this point, given how long we've been discussing this. And because of the fact that we feel reasonably comfortable that we're dealing with a small universe of carriers, should there be any necessary needs to have a more delayed implementation phase, the permitted practice process with their domiciliary state insurance regulator would be the most appropriate venue to achieve that.
Can I ask our other commissioners, this is obviously an issue of interest to legislators as it touches operations of carriers. And would any other commissioner or director wish to make a comment? Commissioner Farmer, Mulready, Downing, Cheney, McLean, or Dana Popish, Severn House. I think this is an issue of interest to lawmakers. So a little comment from your various jurisdictions' perspective would be of interest as we conclude.
Mr. Chairman, Glenn Mulready.
Thank you, Mr. Mulready. Yes, indeed.
Just a quick comment. I think most of you know, as part of this group, that I had my concerns and issues, and you also, anyone who knows me knows it's not my normal lane to dig into the weeds of financial accounting. However, I did have my concerns I'll just say this, as I've dug more and I've dug substantially, I've become a lot more comfortable in the number that it's impacted, to your question. Because that was the big concern of mine, is who does this really impact? And so I think it is limited to those. I will say, there was public meeting the other day with the E-committee. I mean, there was quite a bit of conversation about delaying the implementation of it. So I think there's some energy of possibly that, because of when the vote will take place, implementing that. But outside of that, I think it is sort of settled in that place where it's going forward. I think the only question mark might be, could there be a delay? And I just let you know, if you weren't in on that call, there was some regulators that were voicing that concern.
Good. Thank you, Commissioner Mulready. Anyone else care to offer a comment?
Mr. Chair, Ray Farmer, South Carolina.
Yes, Commissioner Farmer. Director.
So you very well know that the NAIC is a pretty diverse membership of 56 jurisdictions, and it's been outlined throughout the comments today. We have the committee process, and this issue has been debated an awful lot. I sit on the E-committee. The other day, the vote for South Carolina was no. One of two or three, but I respect the committee process. And as President Altmaier indicated, that, this will be on an agenda of the plenary later, instead of the one that we just had the other day. So there is, time for additional debate. I'm sure that there will be. But I think this is one of those examples that the NAIC, may have some disagreement within the family, but it's still the process that we follow. And I'm comfortable with that. Thank you, sir.
Very good. Thank you, Director Farmer. Anyone else wish to offer a comment on this topic?
Well, thank you, Mr. President. I would say Mississippi has no policies that would be affected by South 71, but we did vote no in the committee process and the E-committee for a reason, that we wanted more time to look and see just what the ramifications of South 21 being adopted immediately would have on certain companies. We operate by, as all of you know, you're legislators, and I'm an ex-legislator, by the committee process. So if you don't vote no, you don't have a voice. You shouldn't be able to argue that point when it gets to plenary. So the issue is, are the companies able to put up the dollars that have been deferred for up to 5 years? Most of them have 5-year contracts. And we do know of 4 companies that are affected, and possibly 3 others. The dollar amount minimum is about $400 million. It would have to be put up immediately. It could range up to 600, maybe 700 million that would have to be put in. So this is essentially dollars that would be in surplus. And if you grandfather the people in and let them go forward, they'll have all of the dollars in within 5 years. If you require that you make it effective the end of December, and you could argue that we'll give you 24 months to put the 400 to 600 million back into your surplus. That's a possible solution instead of 5. So there are things to look at. And Mr. President, to your comment, I would say that I would agree that we need to go ahead and address it and get it out of the way. And I think we'll do that, as President Altmaier has told us, probably in September. Would you agree, David?
I think probably before September.
Well, good.
Yeah.
So we have the same constraints that you have of having virtual meetings, and the race and diversity thing, one, because anybody's trying to handle it. We all tired of virtual meetings, and you can only do so many at one time, and it's hard to schedule that many commissioners to meet on a meeting sometimes. So thank you.
Yeah. Very good. Thank you, Commissioner Cheney. Well, we have got to our closing moment. I want to invite any comment that Commissioner Downing or McLean or Acting Director Dana Popish-Severnhouse would like to make. Thank you all for joining. Thank you for participating in today's conversation. Any final remarks?
Mr. President, Troy Downing, Montana. I just want to, thank everybody for this process. A lot of the comments that were made, it was already, rather than saying ditto, I just stayed silent. In terms of the instant case we're talking about, again, Montana, just like Commissioner Cheney's, we don't have any domestic that are affected by that, but we're still listening, trying to understand what those issues are with delaying or not. But it doesn't affect us in Montana at all at this point. Just trying to be part of this conversation, but just honored to be here. So just want to say thank you.
Well,
And I don't have anything to
congratulations
add on that subject either, but I would like to say I've attended NCOIL in the past when I worked on the company side. So it's my pleasure to be here and attend as a regulator, and thank you for the invitation.
Very good. Dana, Severn Hills.
Yeah, and I just would add that similar to Dana's comments, I've been involved in some NAIC working groups in the past when I was with other state agencies, and I watched the collaboration also with NCOIL a number of years ago. And I've always thought is a very important collaboration as we do the work of the NAIC and some of the work there to make sure that this discussion happens with the legislators in order to make sure that some of the best practices are put into policy and into legislation. So thanks for the opportunity to be here.
Very good.
Mr. Chair, Glenn Mullidy, Oklahoma, just for a second, if I can.
Of course, Glenn.
Just a final comment on the SAP 71 too. I just want to point out that, even though it has held as a non-substantive or substantive, which for general terms just means it's a clarification and not something new. But due to feedback from NCOIL, Scott White, the chair of E, was in Alexandria at that meeting and heard loud and clear the concerns. And then that following meeting. So based on that, the officers and executive committee made the decision to handle that process a little bit differently. Didn't change substantive, non-substantive, but it's been through a multi-step process that it typically would not go through because of concerns expressed by NCOIL and others.
Very good. Thank you for that addition, Commissioner Mulready. I thank you all. I thank you, President Altmaier, and each of your colleagues for joining us in this exchange. And obviously, in the realm of commerce, insurance is a narrow part of the global commerce. It's a very important field and one where rules matter a great deal, and it's of the utmost importance to the citizens. I just thank you for your participation in this, and we look forward to our next conversation. With that, I will call this meeting adjourned. Thank you.
So I'd like to say welcome to the Life Insurance and Financial Planning Committee. I am your chair for today. Unfortunately, Assemblywoman Carlton could not make it, but I will do my best to run an efficient meeting this morning. So let's start, or this afternoon. Let's call to order. We need to do a roll call. And let's start with the legislators on remote who are on Zoom. If you could please introduce yourselves.
Ken Cooley in California.
Kevin Cahill in New York.
Pam Hunter, New York.
Jim Gooch, Kentucky.
Paul Epke, Minnesota.
Okay, anyone else? All right, could we have the legislators in Charleston please identify themselves?
Joe Fisher, Kentucky.
Bob Hackett, Ohio.
Kevin Coleman, Michigan.
Carl Anderson, South Carolina.
Ken Blankenbush, New York.
Dear Rendon, Michigan.
Senator Matt Pitch, Arkansas.
Great, I'd like to welcome everyone, and I'm again Wendy Thomas from Pennsylvania. I'd like to I'd like to ask for a motion to waive the quorum.
So moved.
Second.
Perfect. Everybody have a voice vote, say aye.
Aye.
Aye. And the motion passes. I'd then like to ask for a motion to adopt the December 11th, 2020 committee meeting
So
minutes.
moved.
So
Second.
moved. Second, great. Can I have a voice vote, please?
Aye.
Aye.
And it passes. Thank you all. So now we begin our discussions today on retirement security initiatives in the Biden administration. And we have Monique Morrissey, an economist with the Economic Policy Institute. So Monique, if you'd like to get started, that'd be great. Thank you.
Thank you so much for having me. Can you hear me?
Yes.
Yes.
And I apologize. Apparently my internet connection is unstable. It's very windy here. Also, can I share my screen? I have some slides, but they don't need to be shown. There's nothing particularly interesting in them. But if I wasn't allowed to share screen before, so
We'll try to do that. Oh, there you go.
all right. Okay. Okay, so my name is Monique Morrissey. I'm an economist at the Economic Policy Institute. I focus on labor markets, retirement, public sector workers, and other issues. The Economic Policy Institute has been around since 1986, and we're particularly concerned with policies that affect low and moderate income households and families. And today I've been asked to talk about what the impact of the COVID-19 recession was on retirement, and also, how the policy response to it, both to the COVID-19 pandemic and the economic downturn, and also just in general, what the Biden administration and the Democratic Congress might have in store for us. Okay. So the COVID-19 pandemic recession was very different from typical recession. Usually, and this includes the Great Recession, which was atypical in its severity, but not atypical in its cause. What we've seen in more recent recessions is that there was an asset bubble that burst, and then there was a collapse in demand, an aggregate demand, and the economy recovered only as we had fiscal and monetary policies that supported a recovery. And the Great Recession, it was a big collapse, and the recovery was very slow, in particular in the public sector, which I imagine some of you guys probably remember not so fondly. This was atypical because it wasn't so much that there was an unexpected collapse, it was that the economy shut down for precautionary reasons. And basically a lot of leisure and hospitality and some other industries, people were told to stay home, don't do this, it wasn't safe. So that affected the service sector in particular, which again is atypical. So it wasn't the usual cyclical industries like transportation and manufacturing and construction, especially durable goods manufacturing like auto. That's not what really got hit. It was things like restaurants, hotels, and also healthcare, which was somewhat of a surprise considering this was a healthcare crisis. And the other thing that was atypical, women were famously disproportionately affected by the job declines. And again, because they're also overrepresented in the service sector, and especially in some of the other specific sectors that were impacted. And also because they were probably more likely to stay out for caregiving reasons as schools shut down. And what was atypical also, what was typical is we always see in a recession that young workers and minority workers are disproportionately affected. And this was absolutely true in this recession too. But what was atypical is that we also saw that there was more across the board declines in jobs, and that included older workers, workers over 65, but also workers in their late 50s, for example, who are usually relatively protected during recessions because they have more tenure on the job. But when they lose their jobs, it's much harder for them to get jobs back. This is atypical because we saw that their job losses were significant, but we also saw them rebound reasonably well, with the exception of the over 65s and also with the exception of minority older workers. So some of the most vulnerable groups are still in trouble. But overall, I think I was expecting even worse problems. I was expecting that maybe when the economy rebounded, that older workers would be left on the sidelines, and we're not seeing that as much. But they were, impacted more than usual. so, why, so it also as a labor economist, I should say that when we look at job losses, it's been very difficult. There's problems with surveys, people not answering surveys the way they used to. And also it's very often the distinction between being laid off, being temporarily laid off, and quitting for health and safety reasons, not quitting, but taking yourself out of the workforce, it was harder to do than usual. So we had, on the bright side, unlike the Great Recession, the policy response to this pandemic recession has been basically scaled to the task at hand. So the Great Recession lingered for many years after, especially in the public sector, because the policy response was inadequate. And this was not the case this time. We actually saw strong fiscal policy response, both during the Trump administration and now in the Biden administration. And we think that other policies that the Biden administration and the Congress are putting in place will have long-term positive effects on the economy too. Notably, the American Jobs Plan, which is not, it's another. People look at it and say, "Oh, that's another multi-trillion-dollar plan," but it is stretched out over a decade and it's largely paid for. So it's not an obvious fiscal stimulus, but we think it still will have, support the recovery. So I was recently listening to a panel by the chief economist for Moody's, Mark Zandi, and he is optimistic that we're really going to see a short, sharp recession. We've already seen about 2/3 of the job losses have bounced back. So, and it's looking good for the future. So unless we have ongoing problems, assuming we get the pandemic itself under control, assuming we don't have another wave that's worse, unexpected wave with the variants or people refusing to get vaccines or something like that, it's looking good for the economy overall. That said, the pandemic itself, and we expect the recovery, has had very, very different impacts on different groups of people. Some people had called it a K-shaped or recovery or pandemic or something like that. Basically, upper income households were largely unscathed. A lot of them were able to work remotely. They, in fact, their spending power in some cases was, high. And we're seeing that even sort of sustained or caused potentially a bubble in the stock market. Housing values are really high. So people who own houses, who have 401ks, unlike in the Great Recession, especially these are more likely to be older households who have accumulated assets. They're not going to see the kind of decline that we saw among older workers, people approaching retirement, after the Great Recession, where the upper income and older households who had accumulated significant savings, significant assets, also were most affected by the decline in the housing and stock prices. This is not happening this time. We're also not seeing any evidence that even though there was rules about tapping into your 401k savings, we haven't really seen any significant increase in people tapping those early, because people who have 401k savings of any significance are not the kinds of people who are hurting during this pandemic. So that's the good news for upper and middle income people. For people in the bottom half of the income distribution, those are the people who bore the brunt of the job losses. And I think, though, the good news is that we have seen, again, I think that it's going to be short and sharp. And my worst fear is that a lot of the most vulnerable people, including vulnerable older workers, would have trouble getting back into the economy, is not being borne out. It looks like, that people are being rehired. Again, 2/3 of the jobs that have, job losses have been recovered. And I think that that's going to continue, assuming no further, no additional COVID problems. And we also have seen that basically, I'm having trouble, quite honestly, keeping tabs on everything that's going on in Washington, even though that's what I'm supposed to talk about. But one of the reasons is that, after years of mostly incremental reforms, especially as relates to retirement, detailed things, basically things that were not, that didn't get major pushback from employers or major pushback from the financial industry. Now we're seeing that things are moving fast, and that what we call the Overton window has shifted, so that people, even moderates and centrists, are considering things that would have been unthinkable a decade ago. And it's not only because the Biden administration is moving fast on a lot of things. It's not, and Congress, it's not only because of the pandemic, has sort of broken things and open, but it's also just because there were things, I think that longtime work by people in the retirement space have made things that were once unthinkable seem like necessary now. And I'll talk a little bit about that in a second. But simultaneously, even though I think there's a potential for big moves on Social Security, on possibly mandating employer contributions to retirement plans, things like that, we're also seeing at the same time that the people who had been working on incremental fixes, notably, Chairman Neal of the Ways and Means Committee is, teeing up a Secure 2.0 plan, and I'm sure that your committee, the NCOIL, has been very active on, is more knowledgeable than I am about the impacts of the Secure Act 1, but I will talk a little bit about what might be in the offing there. So again, incremental and potential for bolder changes on the retirement in the retirement area. And when I say bold, I mean anything that would require employers to do anything, including potentially contributions. Where, as opposed to the incremental reforms that focused on maintaining, the retirement system that we have now, which is largely voluntary, tax incentivized, and focuses on individual accounts and maintaining consumer choice. And I think that increasingly retirement folks are focused on making things simple, automatic, or mandatory, de-emphasizing choice, and emphasizing affordability, fairness, keeping costs low, and addressing risk. Not that all of those things are going to happen this year, but those are more on the agenda than they used to be. Why is it? I mentioned that it's not just because of the what's going on, not just what happened this year, but that there is a lot of reasons why what we call the Overton window has shifted. First of all, there's been growing support for Social Security expansion among Democrats, not bipartisan yet, but among Democrats. And I think that lit a fire under people who aren't interested in expanding Social Security, but realize that the incremental reforms to 401k plans and similar plans were not going to cut it, that they needed to do something a little bit bolder, even if they wanted to preserve a system that relies heavily on individual accounts. Also, the states, many I think represented here, have taken the lead on things like auto IRAs and related plans, and that also made something like auto IRAs more, that pushed Congress to do similar federal legislation. I think also there's been heightened awareness of wealth inequality, racial wealth gaps, and also previous incremental reforms haven't had the impact that people hoped they would. So those are all reasons that we're seeing probably a little bit more bold plans. My evidence that this isn't so much recent, but for example, Senators Coons and Klobuchar in 2019 introduced the Saving for the Future Act, which mandated a 50-cent per hour employer contribution. They're not, known for being on the fringes of policies. So the fact that there was an employer contribution mandate I thought was significant. Also, it didn't get as much pushback as you would have expected. This is not so much legislation, but one of the big players on this is AARP. AARP for many years said, well, we will not support anything that has an employer mandate. And I mean, we won't oppose it necessarily, but they weren't putting their weight behind it. This is not an official AARP plan, but an influential person at AARP co-authored with Jason Fichtner, who's a Republican at the Bipartisan Policy Center, formerly at Mercatus, and somebody at Working. So these are very centrist, people. Also had a plan that would require employers and employees to contribute, and this would, a modest amount basically to allow people to delay Social Security take up and get a higher monthly annuity. I think it's a great plan. It's not huge, but it's great. So these are some of the things that are in the background. I'm not saying these are happening anytime soon, but this would not have happened even 5 years ago. So I'm going to talk mostly about retirement specific policy areas, but I think that we should just always remember, and I think you guys are very focused on the fact that the things that will really prevent the most vulnerable people from extreme situations in retirement are often things that have nothing directly to do with insurance. I mean, with insurance or retirement, but address other problems that lead up to having, precarious retirements. And that includes things related to disability. And I just want to, and long-term care, which I just want to put a little, in case I don't get a chance, oops, sorry, to talk about it. I know that the Washington State is taking the lead on long-term care. They have a new, they're putting in place a plan, the Washington Cares, I think, that would, that's a social insurance plan to support home care, home, I forgot what that acronym is, HBCBS or whatever, home care, long-term care services. And so I think that that's really interesting. So in addition to the states taking the lead on retirement, you guys have taken, are now starting to take the lead on long-term care, which I think is wonderful. Okay, so what is on the, what do we have on the agenda? Again, it hasn't surfaced yet, but the Social Security Subcommittee Chairman Larson is going to be pushing, or has been actively pushing, is very popular, again, among Democrats, Social Security 2100 Act, which is an expansion plan. And we've gotten word that the leadership in Congress, the Democratic leadership in Congress, may want to push this forward soon because it's viewed as politically popular, not necessarily among Republican legislators, but definitely among voters, both Republican and Democratic voters. On the employer side, employer-based plans, the big thing that's already happened, as you guys are fully aware, I'm sure, is that the multi-employer pension crisis has been resolved. And so that also, in addition to the impact that it's having on states, the sort of Rust Belt states that were most impacted, the Rust Belt and Appalachian states that were mostly impacted because it was, because of the Teamster and mine worker plans that were most affected, that this also frees up Senator Brown, who's been very active on retirement, to do other things. So I think that that's going to also have an indirect effect. And he's also talked about, he wants to have some kind of a mandatory employer plan in the past. So I think we're going to see some more action from him. So, but what is on the offing and what's been talked about a lot is the Secure Act 2.0, which is the follow-up to the Secure Act. And I can talk a little bit about that. Also, auto IRAs in general, more generally, is something that I think is going to be more short-term showing up. Just to briefly cover the Social Security 2100 Act, it was one of the actually more moderate of the expansion acts that the Democrats have supported. It will not appear in its current form in this Congress because the Democrats are being careful about not, keeping to the pledge to not raise taxes on people earning below $400,000. And so, and because also they included a gradual increase in the payroll taxing, and that got a lot of pushback. So they're going to have to trim it down. But Representative Larson, Chairman Larson, is very intent on pushing this forward. And again, I think that the House leadership is very interested in making this, a priority. So I think that something like this pared down, maybe, that will still extend the solvency of the Social Security trust funds, but maybe, but maybe trim back some of the benefit improvements will be put, I think will appear in this Congress. I certainly hope so. I mentioned that the Secure Act 2.0. So I was recently in another conference where Chairman Neal's general counsel spoke about what was going to be in it. I don't think, none of this is firm, but it's a follow-up to the previous, to the Secure Act, which I won't go over for time reasons, but I think you guys are very familiar with. I think some of the things are quite interesting and actually would be a little bit farther reaching than the original Secure Act. One of which I think is great is that it would allow employer matches on student loans. It would also potentially include auto enrollment requirement on employers. And then there's sweeteners for employers to have matches, and there's things I don't support. I don't think that relaxing the required minimum distributions, that's a solution waiting for a problem. But anyhow, I think it's great that they're looking at the saver's credit, but I don't think that there's any indication that they're going to make it refundable. And so that's, I think that's going to have not as much of an impact as it ought to, but otherwise that should be a priority. And some other stuff, but those are the big things that I've heard are going to be in it. But again, this could change. The first act and I think the second one are a bit of a hodgepodge of whatever they think they could get support for. Of course, legislative fixes are not everything. I want to flag that Social Security folks are very, very concerned that with Social Security offices closed, there has been a drop off in applications for disability and SSI. I think this is very worrisome. I'm probably already used up my 10 minutes here, but I would like to put in a big plug in for states to try to help their constituents access these benefits, because there's a big problem where people are not aware of the fact that they may be eligible. So it is not normal to see a drop off in applications during a time when we know that there are major health problems happening. And so this is entirely due to information and access problems. And until these offices open up, and even after, I mean, this is going to be an ongoing issue, but states have an incentive to try to get their constituents to access these benefits. It's federal money. So please, if you can do something to advertise and encourage people to apply for these benefits that are necessary. This is not a good sign. Another thing, I haven't had a chance to look at it, but the Biden administration just released, I think, a draft of its revised fiduciary language. And so I can't speak to that, but I know that the consumer advocates are happy about it. So I think that's a good thing. I think you guys probably were all involved in that issue too. So that's, I will, I'm sorry, I think I've overshot my time. But there were other things that I was asked what Biden might want to do when he had a joint task force with Senator Sanders after the election. And there were other things that were on his agenda that have not been raised, but we might see. One's a caregiver credit, it's a very popular kind of way to expand Social Security benefits. Another one is to focus on how unequal the tax incentives are for retirement saving. And there are also issues related to just people's access to affordable banking services, which I think indirectly affects people's financial security. I'm happy to take questions later, but I'll put a stop there. Thank you.
Great, thank you very much. And yes, we'll have an opportunity for questions. You can stay for a bit.
Yes.
Wonderful, thank you. Next, we have a speaker on the mega trends defining the next wave of life insurance and retirement. We have Martin Spitt, insurance strategist and transaction leaders with Ernst & Young. Martin?
Yes, can you see and hear me?
Yes, I can. Thank you. Oh, looks like you froze. There you are. Martin, are you back? Sorry for the technical difficulties. Martin?
My apologies. My technology is failing me, I think. But,
No.
We'll do this old-fashioned, but
No,
10,
but
15 minutes for remarks and then questions. Does that still work?
yes, please go ahead.
Terrific. Thank you. And I have a few slides as well, but I'm happy to also talk through this. Would you want me to present, or shall we just get going?
Monique, if you could stop sharing. I think somebody in Charleston may have the power to do this. And once you stop sharing, Martin, you should be able to start sharing. There should be an icon at the bottom of your screen. It says share screen.
Perfect. After a year of working remotely, I should really have been much better at this than I am, but.
That's right. I say that every time I'm not on mute. I mean, I'm on mute and I think I'm talking.
Yeah, I actually don't see it here.
Okay. Why don't you just go ahead and get started in the interest of time? Oh, there you go. Your screen is being shared.
Terrific. Thank you. So Martin Spitt, out of the beautiful state and city of New York. In spite of my accent, been here for 20 years. I have the privilege of serving life insurance companies throughout the United States. And we conduct market research fairly frequently to understand where's the market today, where is it heading, and how do we think that companies should respond. So we are pleased to share with you the results of our latest research in this. It's available on the web, so we'll share the URL later on if you want to take a more detailed look. But I wanted to give you a quick flyby of where we think the industry is heading. And when we say that, I recognize that, you know, when you ask consultants what's going to happen, everything is in turmoil and everything is in disruption and everything will change overnight. I actually don't think that's the case. If you look at the life insurance industry today in the United States, it's in good health. Companies are mostly very well capitalized. The total premium numbers are edging towards $700 billion per annum. And we see that the life insurance industry continues to fulfill a key role in the savings and retirement plans of Americans. What we do see, though, is that if you take a very long-term view, for instance, in, say, the late 90s, about 10% of all household assets in the United States was in life insurance products. Today, that is less than 4%. So on a really long-term scale, right, you can say that the life insurance industry is losing some of its competitiveness against other asset classes. And what we see, it's overwhelmingly gone to retirement accounts, IRAs, etc. So it's a shift from one to another. But for many players in the industry, this convergence and this shift between traditional life insurance players and more asset management driven entities is of great importance. And against that backdrop, when we look at the industry, we've simply broken what we think is going to happen into three things. What are the trends that impact the insurance today? What do we think how that will play out in some future stories and in the responses to those trends? And then if we aggregate that, what do we think that future business models will look like? And I'll touch briefly upon these. I think I'll stick mostly on the trends, and then I'll pick a few of the stories and business models just in the interest of time. So if we look at trends, we really see six things shaping the industry going forward. And our research, when you read it, you'll notice that it was global in nature. I will focus mostly on the US here, so you see that some of these trends are a little bit more applicable to the US, others are a little bit more applicable to other regions. But the first trend that we observe is that financial health and wellness is a key theme. And what we mean with it is that increasingly consumers want to be treated less from a product by product basis and want to be treated more from a holistic advice perspective. And we've seen that in the technology side with robo-advisors like Betterment and LearnVest, etc. But we also see it in some of the way that companies are starting to deliver advice to clients and take a really much more holistic perspective to what people want and need. The second trend that we observe is around long-term value, and this takes different shapes. The ESG trend is part of that. It is definitely a view that the insurance companies have had for a while, because clearly, if you're in a life insurance business, you are in it for the long term. But we see that consumers are starting to have different expectations on, for instance, the assets that companies invest in. And we see that there is both a need and a drive for clarity around ESG frameworks and the way that is even measured. And frankly, that's an area where a lot of my clients today are struggling with, because there's really not an apples to apples comparison between these different frameworks. The third one that we think is of global importance as well as of US importance is a collaboration with governments and regulators. And trust me, we didn't write this in because I know I'll be speaking with you today. We think that as a regulated industry, this has always been very, very important. But we also see that the tax environment, the encouragement, for instance, that the Secure Act has given to annuity products is very important in terms of getting these products into, around the right attention and giving people the right trade-offs in making sure that they invest in the products that are right for them. Personally, I haven't seen as much pickup from, for instance, the Secure Act as we would like to have, but we also think that the current economic environment for annuity writers is pretty tough. So maybe it takes a little time before these things will settle in. Fourthly, we think that ecosystems and omni-channel engagements are going to become more and more important. And what we mean with that is really a blend of different products, different distribution strategies, relevant at different times in consumer lives. We just heard about student loans, for instance, right? But we see that when we do direct research with consumers, is that priorities have shifted, and that student loans 2 decades ago didn't really feature in priorities that much. Today, they are a key concern of people entering the workspace. And we expect that companies that position themselves well would try to understand what are needs of consumers throughout their pre and post-retirement needs, and how do you respond to that. Fifthly, and this is probably the trend that I'm personally working on most today, is around capital optimization and convergence. We've seen that in the COVID crisis, interest rates have both gone up and gone down a little bit again, but currently the capital environment for many of the clients that I serve is pretty tough. And it means that a lot of them are looking at better ways to structure that, for instance, through reinsurance transactions, and to seed a bit of the books that they have built up over time, and see if they're better owners and stewards for those books. One of the big things that we've seen over the last decade is really the rise of alternative capital and PE-backed capital in the life and annuity industry. And that is a trend that we expect to continue. And many of those companies actually have come to great maturity and are being seen as very serious counterparties these days, maybe more so than they were 10 years ago when they just got started. And then lastly, we do see a level of commoditization as well as customization in the industry, and that's maybe a little bit counterintuitive to see those both together. But what we mean with that is it becomes increasingly easy for a consumer to understand how are my funds invested if I close an annuity product with a carrier, and can I do that on my own? And certainly we see that the more sophisticated consumers are applying that as a strategy. We think the answer to that is to both recognize that is the case, and with commoditization comes usually also a different price point, and I think that's something that the industry should really think about in terms of its overall long-term competitive position. And then customization, we believe, should come out most in being at the right time, at the right place to meet consumers where the demand is. And that could be in a traditional kind of like retirement planning session, but it could also be in a 5 minutes at the airport when somebody knows that they want to get term life insurance and just want to get that over with. And those are the models that the insurance industry today is not really geared up to. So when we think, what will happen, we've actually thought about again 6 ways of the industry responding to that, and I will leave the full 6 for your own reading time if you're interested. But for instance, we do see that things like life and wellness concierges or subscription models, where you talk about insurance as a service, are becoming more interesting to people. And we think that the right that companies need to find the right balance in serving different customers in a different way. I think I'll skip through the rest here, gladly go into some detail. And then we recognize that the industry is complex today, it will be complex tomorrow. So it's a little arrogant, to be fair, to say these are the business models that we think people should comply with and live up to in the future. But we've tried our best to articulate 6 that we believe will be prevalent in the industry going forward. And I'll do a quick flyby on these without going in a lot of depth, but we think that there remains room for global and regional consolidation, because there's definitely benefits of scale in this industry, both from an operational perspective as well as from a capital perspective. We believe that ecosystems and meeting consumers at the place where they want to transact business will lead to a level of market extension. And we think that there are companies that will specialize in that. We believe there will be increased segment specialization, for instance, on high net worth individuals, but also on individuals that would need income protection for the remaining 10 or 20 years of a working life, for instance. We think that overlaps with solution specialists, so I'll leave that aside for a sec. We believe that digital challengers will grow in importance quite a bit. Maybe 3-4 years ago, thinking about digital and direct to consumer distribution of life and annuity products was pretty unheard of. Today we have Haven Life, we have Ladder, a little bit more on the lower end of the market, but also we have entities like Policy Genius that try to broker policies up to $750,000, for instance. So we think that's definitely maturing, and it will find its place. And then lastly, we think that there'll be a group of companies that will say, we're not so good in originating, but we're really good at managing books of business. We're really good at managing capital that is deployed in there. And they will become what we've dubbed here back book aggregators. Chair Thomas, maybe I will leave it at that for a quick flyby of what we see going on. Happy to take questions now or to hang around and take them later.
Actually, I think I would like to open it up for questions for either speaker at this time, because then we have 2 other pieces of business we have to get to. So do I have any questions? I think you've both done a great job. We have lots of information here to think about, and I hope you'll share the slideshows so we can share the slides. They're not already in the books.
I'm sorry, I did have a question.
Okay, good. Go ahead.
We were looking at the slides on the screen. It was the previous slide, number 3, and it talked about the mega trends facing the market and unfunded liabilities and retirement programs, and it mentions collaboration with governments and like regulators. I was just wondering if we could expand on that a bit and talk about what you see coming down the road. Thank you.
Yeah, I'm happy to. It's when we talk about unfunded liabilities, mostly in the pension risk transfer market, where there are company pensions that are not as funded as they should be. We continue. That's a pretty mature market in the United States already, and also in places like the UK, the Netherlands. We think that will continue to increase, and what you actually see is that the solutions that used to be available only for very large corporations to make a pension risk transfer happen in a meaningful way are now becoming more available for the lower end of the market. It's not exactly for small and mid-sized enterprises yet, but the industry is definitely maturing, and it's actually quite attractive for a number of capital players in the market, given the long-term cash flows that are associated with it and the long-term assets that come under management with it.
Thank you.
Anyone else? Okay, great. Thank you, Monique. Thank you, Martin. We certainly appreciate you joining us today and sharing some great information. At this time, we're going to move on to consider a resolution in support of the Living Donor Protection Act, which is a federal act, S 377 and HR 1255. It is sponsored by Assemblywoman Charlton and myself. And I just would like to take a moment to say a few words. I am particularly proud to sponsor this resolution along with Assemblywoman Carlton, as it deals with a very important topic. A copy of the resolution is in your binders on page 206. The resolution is very straightforward and supports a piece of federal legislation that has bipartisan support and is supported by the American Council of Life Insurers and consumer advocacy organizations such as the American Kidney Fund. Both organizations are here today to speak in support of the resolution. I don't want to take too much time away from the speakers we have here today, but the resolution essentially protects living donors and promotes organ donation by making it unlawful to decline or limit coverage of a person under any life insurance policy, disability insurance policy, or long-term care insurance policy solely due to the status of the person as a living donor. This is a bit personal for me, as I have two legislators that I serve with. I have two legislators I serve with that have been involved in this. One is a legislative colleague, Representative Tara Toohill, who actually donated a kidney to her mother. And I didn't know this when I agreed to sponsor this, but just last week, we had another representative in the Pennsylvania State House who received a kidney, and she is recovering and doing well. So it is particularly important to those of us in the Pennsylvania House. I support this resolution and urge its adoption as it strikes the right balance between the needs of living organ donors to protect their families' financial futures and the need for life insurers to underwrite fairly. I also think it's important to note that while NCOIL will always remain cautious regarding federal involvement in proven state-based systems of insurance regulation, such involvement is sometimes warranted, and under federal legislation such as the Living Donor Protection Act is enacted to give baseline protections to organ donors nationwide. States are operating under a patchwork of living donor protection laws currently. So at this point, I'd like to introduce our two speakers, Deborah Darcy, Director of Governmental Relations at the American Kidney Fund, and Karen Melcher, Regional VP of State Relations at the American Council of Life Insurers. And Deborah, if you'd like to go first.
Thank you. Good afternoon. I am Deborah Darcy, and I'm from the American Kidney Fund. I'm also an appointed consumer representative for the National Association of Insurance Commissioners, and I'm here to support and to thank you for the resolution in support of the Living Donor Protection Act. And I'm hopeful that with your support, we will get the bill over the finish line and get it enacted. As you know, the Living Donor Protection Act will help people obtain the transplants they need. The bill is great for patients and living donors and really good for society. As a patient advocacy organization, the American Kidney Fund works on behalf of the 37 million Americans living with kidney disease and the millions more at risk. We support people wherever they are in their fight against kidney disease, from prevention through transplant. 1 out of every 6 kidney failure patients cannot afford the cost of care, and AKF is there for them, providing treatment-related financial assistance. And last year, we assisted 74,000 kidney patients with their health insurance. And in fact, 1 in every 14 transplant recipients in 2020 were able to get their transplant because we helped them with their health insurance. We are one of the nation's top-rated nonprofits. We invest 97 cents of every donated dollar into our programs, and we hold the highest 4-star rating from Charity Navigator and the Platinum Seal of Transparency from GuideStar. The American Kidney Fund has been working on the Living Donor Protection Act at both the federal and the state level to ensure that people who donate a kidney will have access to affordable life, long-term care, and disability insurance. We believe the bill will increase the number of living donations because it will provide assurances to people who have concerns about the availability of these types of insurance. And in order to provide more dialysis patients with transplants, we need more living donors. The American Kidney Fund appreciates your time and effort in creating the resolution. I want you all to know that we believe that with your support, the Living Donor Protection Act will help enactment of the legislation, and ultimately it will improve people's lives. From the patient perspective, the statistics are clear and you state them in the resolution. There are about 108,000 people on the transplant waiting list. 82% of those are in need of a kidney. Every 9 minutes, another person is added to the transplant list. 17 people die each day waiting for an organ. Only 1 in 5 people on the wait list will receive their organ. On an individual level, the reality is even harder. The physical and emotional cost is high for those waiting for a kidney transplant. Patients with kidney failure must be on dialysis 3 days a week for 4 hours per treatment, or be on peritoneal dialysis overnight most nights of the week, and they must do this until they get a transplant. 80% of dialysis patients are too sick to work. A kidney transplant would give them their health back and provide opportunities to once again be in the workforce. Again, in order to increase the number of transplants performed, we need to increase the number of kidneys available. Living donors can help fill that gap. Giving the gift of an organ is the ultimate altruistic act. It takes an incredibly special and selfless person to donate an organ. Organ donors are the healthiest people. If they are not healthy, they will not be accepted as an organ donor. If someone makes that decision to offer their organ so another can live more fully, they should be rewarded and protected. Unfortunately, living donors can face some difficulty with life insurance. A patient on dialysis told me that a friend was willing to donate his kidney, but then he heard rumors that he might not be able to get life insurance. He had children, needed life insurance, and he rescinded his offer. We also know from 2 studies that some living donors have faced these difficulties. A 2014 Journal of the American Society of Transplantation article reported on a survey of 186 living donors. 25% of respondents faced some difficulty in getting life insurance. A 2000 study created a secret shopper who had the exact same profile, except one was a living donor and one was not. He applied for life insurance at 10 companies using both profiles, and he had difficulty getting life insurance at one company when he used the profile of living donor. Studies have shown us that living donors are just as healthy and live just as long as non-donors, so the living donor should not have faced any issues. The prohibition on discrimination will ensure that people who make this decision to donate an organ will be protected. Another important aspect of the bill is that it would codify a 2018 Department of Labor opinion letter, which stated that living donors are covered under the Family Medical Leave Act. Prior to that opinion letter, an advocate of ours, a woman who needed to take time off from work to donate her kidney to her husband, had been told by human resources in her office to fill out the paperwork saying that she needed time off to care for her husband who was receiving a kidney transplant. At that point, she could take time off from work to care for her husband, but they didn't know if she could take time off for herself for donating the organ. Now that the opinion letter has been issued, living donors know that they're eligible for the Family Medical Leave Act, and they know that they'll have a job when they come back. And recovery times are usually about, recovery times, people can get out of the hospital in a couple days. So 2 weeks is usually fine. Some people need a little bit more time. But we believe that the opinion letter that was released can also be rescinded. So we would really like that to have the force of law behind it. Finally, the bill is good for society. In addition to dialysis being really hard on the individual waiting for a transplant, the cost to the healthcare system is also high. Again, as you correctly stated in the resolution, Medicare spends about $89,000 per dialysis patient per year. Compare that to after transplant, Medicare would spend about $35,000 on that same patient per year. Hence, the bill would result in better outcomes for patients and lower healthcare spending. So once again, I just want to thank you so much for this resolution, and we're in full support of it. And the American Kidney Fund looks forward to continuing to work with you on kidney issues in the future.
Thank you so much. Karen, are you on?
I am. I'm actually here in person.
Oh, excellent. Please go ahead. Thank you.
Very much. Good afternoon, Madam Chair, members of the committee. Thank you for the opportunity to speak to you in favor of the resolution that is before you. The American Council of Life Insurers and its 280 member companies are dedicated to protecting consumers' financial well-being through life insurance, annuities, retirement plans, long-term care insurance, disability income insurance, reinsurance, dental, vision, and other supplemental products. The Living Donor Protection Act, a bipartisan initiative in Congress, ensures living organ donors will not be denied life or disability income insurance solely on the basis of their decision to help someone in need of a vital organ. The bill strikes the right balance between the needs of living organ donors to protect their families' financial futures and the need for life insurers to underwrite accurately and fairly. People need to be able to make a life-changing decision without it negatively impacting their life insurance choices. We are honored to stand with the American Kidney Fund in support of this organ donation and the immeasurable value it provides to humankind. And we greatly appreciate NCOIL for bringing this resolution forward, and we urge its adoption. Thank you.
Thank you so very much. Do we have any questions for either speaker on this topic? Oh, I see a camera moving. Go ahead.
Hi, I'm Representative Dear Rendon from Michigan. I just, not so much a question, but I just want to say thank you for this. I have a brother who received a kidney from my sister 31 years ago. He fine for 20 years. My sister's now retired in Arizona, and he is now waiting for his second kidney. So this is a big, big deal. And I understand the importance of it. So thank you.
Thank you so much for sharing that. Anyone else?
Jim Dunnigan from Utah. I have a question for Karen. Have you done any analysis to increase the mortality risk for insuring a donor?
That I do not know if we've done the analysis on that. We have worked on this resolution and the bill that's before us in Congress with the American Kidney Fund. And I think there is obviously some impact to a person's vitality, but I think we've come to the conclusion that it is not as significant as perhaps we thought it might be. So it's something we would consider, but would not be a sole basis for denying coverage or raising rates.
I can forward the study that shows the same longevity. I'll forward it. I don't have it at my fingertips right now.
I'm sorry, could you say that again?
Sure, I can forward a study that shows that it has the same longevity.
Okay. So I think it's wonderful that people are donors. I really do. In your presentation, though, you're kind of commingling different pots of money. You're saying it's going to save money in the health arena or productivity or whatever. And so, but it's going to maybe cost somebody over here. You know, the ones that have to increase cost aren't going to get the savings. You know that, don't you? I mean, you're talking about that we save it here. Yeah, but it may be here. So
Yeah, that's why I talked about the healthcare system as a whole, and I didn't really say Medicare. But in terms of dialysis patients, yeah, once somebody has their transplant and saves money in Medicare.
Yeah, that's wonderful, but saving money in Medicare doesn't do anything if there's additional costs in the commercial market. They don't help each other. But it's certainly better for the person. I support that.
So the number of living donors is a small group. And I can forward that study. It was done, I believe, by a researcher in Baltimore. I don't know if it was Johns Hopkins or University of Maryland, but I'll be happy to forward that.
All right, thank you.
Thank you. Any other questions? Okay. Seeing no other questions, can I have a motion to adopt the resolution?
So moved.
Can I have a second?
Second, Pam Hunter.
Thank you. All those in favor say aye.
Aye.
Aye. Any opposed? Hearing none, the motion passes unanimously. Thank you, and thank you for your presentation, ladies. We appreciate it. Moving on to our last item of business, the readoption of the model laws. Per NCOIL bylaws, all NCOIL model laws must be considered for readoption every 5 years, or else they sunset. The 3 model laws scheduled for readoption start on page 208 of your binders. Are there any questions about the model laws? Any questions? I just want to give everybody enough time to check. Seeing and hearing none, I'd like to have a motion to adopt all 3 model laws. Can I have a motion?
Carl Anderson, South Carolina, I so move.
Can I have a second?
Second, Pam Hunter.
Thank you. All those in favor of adopting the model laws, please signify by saying aye.
Aye.
Aye. Any opposed? Okay, motion carries, and the 3 model laws will be adopted. So we win for the best session because we're ending early. So I appreciate everyone's attention. I hope you found it informative. Anyone have any other business at this time? Okay, so the meeting will be adjourned. Thank you, everyone.
Thank you. Members, welcome to the Workers' Compensation Insurance Committee. I'll call this meeting to order. And first thing, we've got to do a couple housekeeping things that we're pretty used to by now. But first of all, would all of the legislators online on Zoom identify themselves? And I guess I'll kick it off. I'm State Senator Paul Etke from Minnesota. And then go ahead.
Kevin Cahill in New York.
Tom Oliverson from Texas.
Jim Gooch from Kentucky.
I see Assemblyman Ken Cooley is online with us, just muted. Any others? If not, thank you. Let's go to those in-house there in Charleston, if they would go around the table and identify themselves.
Dennis Powers, Tennessee.
Representative Jim Dunnigan, Utah.
Senator Matt Pitch, Arkansas.
Representative Dear Rendon, Michigan.
Representative Kevin Coleman, Michigan.
Okay. Thank you, everyone. If we've got everybody there, we are set to jump into our meeting here. Our first speaker today to join us this afternoon is Gary Cannon, Executive Director, South Carolina Workers' Compensation Committee. Welcome, Gary, and go ahead when you're ready. Oh, Gary, you're muted.
All right, can you hear me now?
We can hear you now.
Great, thank you. Thank you very much for the introduction, and thank you for the opportunity to speak to you. I'm going to see if I can share my screen. I have a PowerPoint.
I think Will can probably help you with that.
Yep.
Is there someone in the room there in Charleston? Oh, there you go.
I get it.
You had it.
Is it up there now?
Yes.
Okay, great. Thank you. Well, we'll get started. Been listening to the presentations today, and some great issues that this association is involved with. So I'm going to try to drill down to, rather than the 50,000-foot level of the policies that y'all been talking about, just give you a little flavor about the Workers' Comp Commission here in South Carolina, how we're set up, and some of the major issues that we've dealt with this past year. We have 6 commissioners that are appointed by the governor, confirmed by the Senate. They're staggered terms, and we have 7 districts that these commissioners conduct hearings in across the state. They rotate their district every 2 months so that there's some sense of rotation there. We have the chairman and 2 other commissioners that are up for reappointment this year. We just learned that they will be up before the Senate Judiciary next week. And then next year, we will have 2 more commissioners up in that 6-year rotation. They do serve for 6 years. There we go. The commissioners basically serve in a judicial capacity of the 7 districts, conducting administrative law hearings of the disputes between the individual claimants or the claimants and their employers. They also approve informal conferences and approve settlements. The public policy capacity, we are a little different here. They also approve regulations and approve our medical fee schedule. Many states, medical fee schedules that service providers have to abide by or must be approved by the General Assembly, but in South Carolina, our commissioners approve the fee schedule. It must be updated once a year. That's by statute, and we are based on the Medicare CMS values, and we're typically about 40% higher on our values and our fee schedule than the Medicare. Our mission statement, of course, is very much like yours, I'm sure, where we try to provide an equitable and timely system that benefits to the injured workers. And one of the core values that we press and to our employees every day is to apply the facts of the case to the law. It's a level playing field. There's no special interest groups out there. We also try to seek continuous improvement and respond timely to our constituents. Our stakeholders, again, very much like yours, employers, employees, insurance carrier, medical service providers, certainly attorneys, uninsured employers fund, the guarantee fund, and members of the General Assembly. As I mentioned, we have a very small agency, but the system economic impact of workers' comp in South Carolina is about 1.04 billion annually. This past fiscal year, we paid out $451 million in medical and then $587 million in indemnity payments. So you can see the economic impact and that doesn't include the premiums, insurance premiums that are paid. Our annual operating budget for the commission is about 8.1 million a year. We get 2.5 million appropriated by the general fund, and 5.6 million is approved as expenditures from our funds and fines and fees that we collect from our stakeholders. We have 63 approved FTEs, but for the past several years, we've only been funding 53 of those, 18 into the general fund and 45 in the earmark fund. The departments and divisions that we have, commissioners, executive director, have certainly in information technology because it is the foundation of all that we provide to our services. Our insurance and medical services division does the coverage and compliance requirements. The claims division makes sure that all the forms are filed every year on the periodic basis, and our judicial division is like our clerk of courts. They're the ones that take the disputed cases and get them over to the commissioners. As I mentioned earlier, the commissioners had two functional capacities, judicial and public policy. And these are some of the intergovernmental partnerships that we have right now. We do not have dedicated hearing sites in South Carolina. We have to beg, borrow, and steal these hearing sites for the individual commissioners to conduct hearings across the state. So we use local government council chambers, courthouses, other state agencies, hearing rooms. We have about 100 of those that we have on our list that we use, but that's a constant battle for us to continually obtain those sites for the commissioners to use. We use the Department of Employment and Workforce for our employer wage and personnel data for our coverage compliance. We have a regular contractual relationship with the Voc Rehab Department where they use our database, and the last year they referred 2,200 referrals to the claimants for potential service from Voc Rehab. Probation, pardon, and parole, we have an ability to go to their facilities so that the incarcerated persons who are filing a workers' comp claim would go to the prison conference room, and our commissioners do not have to attend that. And then certainly with the Department of Insurance, we have a great relationship with Ray Farmer and his staff over there. When we have to notify carriers that are in fault of payment of their fines. And we're looking at adjusters training. I'm not sure that many of you are having this, but in South Carolina, we have a lot of out-of-state adjusters that are handling individual cases. And many times they don't know South Carolina law. As you can imagine, the law in our state may be a little slightly different than yours in adjudicating or handling a claim. So we are working with Department of Insurance to look at getting some training requirements for the adjusters in South Carolina. Some of the challenges and opportunities that we faced this past year, of course, was COVID-19 and the pandemic. We are in the process of upgrading our IT information technology legacy system. Again, I mentioned the venues. That's always on our list to determine what we need to do and how we can get those hearings held there. And then our medical services provider manual. And then the adjuster training. Tell you a little bit about how our COVID-19 cases came in this past year. Since February of last year, we've had 3,200 cases filed with the commission that were related to COVID. This past month, we had 175. As you can imagine, the three largest counties were the most populous counties in the state: Greenville, Charleston, and Richland. We only had 25 fatalities. I don't mean that as a haphazard statement. One fatality is bad, but we had 25 this past year. Open cases denied are 13, and closed cases denied were 1,800. Most of these cases did not go to a dispute. Most of them settled, and that's why they were closed at denied, and there was some settlement there. The agency, I'm sorry, there's more on the COVID-19. We had 101 with attorney representation, and as you can see, the medical amount paid out on the closed cases was $444,000. And then for the non-medical, the indemnity, $1.8 million was paid out. And that was a total amount, certainly not per case, but that was a total amount of those closed cases that we had. And as you can imagine, the highest number in the occupation of the cases filed was what happened to be registered nurses and the medical field. Last year, Governor McMaster issued an order, executive order, where he closed the agency to the public, all state agencies. We pivoted basically by having 20% of our staff work on site, 80% work from home, and the commissioner suspended in-person hearings from March until June the 1st. Then once they started having hearings again, the hearings were conducted by electronic Zoom and court call. Many of the pre-hearing conferences were conducted by telephone, but it was decided by the jurisdictional commissioner whether they were going to have something in person as well as, or if it was going to be electronic. So each of the 7 commissioners managed the docket that way. We then cut off any paper documents being submitted to us being hand carried. We only accepted them by electronic version by the Postal Service. June 1, the commission resumed those in-person hearings, and we established a lot of CDC safety protocols on the in-person hearings, but they continued to hold the meetings via Zoom and court call. And we are having our first business meeting this Monday, in person. Since March of last year, we've had all of our business meetings via Zoom, and we're having the first one this coming Monday in person because the numbers are going down. We established the advisory notices that would go out to notify our stakeholders of what was going on with those hearings. The IT project that we've been working on, we initiated in 2018 to replace a 30-year-old claims management system. And we did this. The new system is plans to allow online form completion, electronic payments, electronic service of orders, allow the stakeholders to view and download documents. It also would set up additional electronic security and provide us with data collection and analysis. Well, we worked on it for over a year, and we had an initial release date of October the 31st. And once we released it, it was delayed until December the 4th. And we had some problems with the system that we released. The vendor was unable to correct the problems. The product that they delivered to us was unacceptable. The vendor, of course, wanted additional funding to correct them. We denied the request, and then the vendor terminated the contract with us on February the 14th in 2020. We were able to get Microsoft to conduct a gap analysis of the system that they developed to find out exactly how much of the code that they provided us we could use. And basically, Microsoft said that the system that they delivered to us, we're going to have to start over and do a complete rebuild. We filed a dispute with the chief procurement officer against the contractor. The dispute hearing is pending, and we have initiated a tracking responsibility sort of a double track where we are now contacting other states who have recently initiated this upgrade of their legacy IT systems to determine how they went through this. I know Minnesota is one of the states we were in contact with. Kansas is another. And so we're determining exactly what needs we will have for the new system. We're accepting guidance from the state procurement to obtain those proposals. We're hoping that once the hearing is conducted, they'll have no bearing on us moving forward to doing RFPs with soliciting proposals from vendors to get our system up and running. Commission has a responsibility of the medical costs in the state. There's a balance there of adopting a fee schedule to put a maximum amount of the amount that a medical service provider can be paid. But of the balance of that is to make sure that there's medical care is available to the claimants. As I mentioned, we have a medical services provider that's updated annually. Our manual is based on Medicare. We currently have updated it effective April the 1st, and it is based on the resource-based relative values from CMS. We have, these are some of the issues that the commission were addressed to the commission during the revamping of the medical services provider manual. They decided that some of these things needed further study, so they will be chartering an advisory committee, ad hoc advisory committee, to look at these issues and any other issues to help ease the administrative burden that is placed on the medical services providers. So we'll be starting that process starting next week. We'll have the commissioners charge the ad hoc committee. I mentioned to you that the venues is an ongoing issue. We have 7 districts, 54 sites and 9 rooms. We have no dedicated hearing rooms, and we have to use the following courtrooms, county council chambers, state agency conference rooms, and technical colleges. So that was sort of the 50,000-foot view of the administration and where we are right now with our commission here in South Carolina. I'll be happy to entertain any questions if there are. I know I'm me and what other speakers you may have, maybe standing between you and the reception and cocktail hour. So we try to cut this as short as possible.
Yeah.
I'll be glad to answer any questions that you may have.
Thank you, Gary. And can you feel that there's a pry bar behind all of us to keep moving, right? But anyhow, members, any questions for Gary before we move on to the next next speakers, and we can catch them at the end too. But if you got any that are ready, we'll take them. I can't see what's around the table there, so if anybody's waving at us. If not, Gary, can you hang on till the end just in case
sir.
we collect? Okay.
I'm glad to do it. I'll be around. Thank you.
Perfect. Thank you. We will now move on to our next speakers. We have from California Staffing Agency Reform Association. I like the acronym CalSARA, but with us today, we have Mark Bertler, the Executive Director, and Polly Pent, the Membership Chair and former California Department of Insurance Detective. Welcome. Okay, now we switch screens. So I don't know, do you guys have slides or anything? There we go. We got them back up. So I will turn it over to you. So thank you.
Thank you, Mr. Chairman, and thank the committee. We're pleased to be here to talk about our model in California based on, I think, some frustrations with workers' compensation insurance fraud in our state and perhaps across the country. This is just to make sure that we look like our pictures. I'm Mark Bertler. I'm the Executive Director of CalSARA. Polly Pent is our Membership Director. And you have our bios in your materials. So we formed this trade association in October of 2020, so we're really new. And we formed it to be an association of businesses to promote legal and regulatory compliance in the sale of workers' compensation insurance and to promote the common business interest of our members in recognizing and eliminating workers' compensation fraud in the temporary staffing, and recruiting industries.
So now I'm going to talk a little bit about the current situation in California. And to do that, I'm going to use a metaphor with one of the last patrol calls I took when I worked patrol prior to going to work for the city and county of San Francisco. I got a call for a domestic violence in progress. I showed up to the call, I heard screaming, I increased my backup to code 3 and I made entry. And from the very, very back of a long hallway, a woman jets out of a room. She's obviously injured, and behind her is a man. He starts coming toward me. I order him to get down. He starts crawling toward me. I finally get him to stop. I start cuffing him while he's on his belly prone, and I get his left hand cuffed, and when I go to cuff his right hand, he starts actively fighting me. I'm basically sitting on him, controlling his right hand, and he's just moving, like slinking. And what I notice is there's 5 blue accordion style lid bins in sort of a half circle, and he's crawling toward those. And I'm, of course, giving commands, stop, stop. I can hear the siren of my backup coming. And the wife yells at me from the corner in the back of the hall where I told her to stay, that there are 6 rattlesnakes in every box because he's dealing illegal reptiles. And I can hear as he starts trying to hit the boxes to try to turn them upside down so that the snakes will slither out on me, I can hear their tails starting. At that moment, at the door comes my backup. He's a guy much younger than me that was sort of like a surrogate son. And he looks at me and he's almost like laughing at the sight of me on top of this guy with the guy breathing all over. I'm like, dude, there's rattlesnakes in all these boxes. We need to control him. And the deputy backing me up pulls out his gun and starts going like this at the boxes. I'm like, if you don't have snake shot in that gun, it's not going to be helpful. So what we need to do is control him. We did, took him to jail. Wife was safe. Everything turned out okay. Turns out he was dealing illegal reptiles. The reason why I use this as a metaphor is because that's how workers' comp fraud felt to me when I first got involved at the city and county of San Francisco. Then I lateraled to California Department of Insurance. When I got involved with PEO and staffing fraud, what I learned was there were boxes all around me and snakes of different colors in each box because the fraud is plurific. In the PEO and staffing industries in California, it's actually an underground economy. There are billions of dollars a year that are being diverted out of the state regulated system into the fraudulent system. And this system undermines business practices because it creates unrealistic, false, or what I call fake pricing, because cheaters actually do it cheaper. I remember when I was a campfire girl, we would sing that song over and over, you know, cheaters never prosper. And that is not true in California work comp right now, especially in the staffing and PEO industry. The fraud is not addressed in the state of California by any specific rules and laws as far as regulation of PEO and staffing. There is zero regulation. All we have in California is California penal codes that have to do with grand theft, forgeries for fake certificates of insurance. We have 2 insurance codes in the penal code, and then we have our insurance code. That is the only way to regulate the problem is criminal prosecution. Criminal prosecutions in California, and for 4 years, I did nothing but work staffing and PEO fraud in California. In that time, I had 3 cases filed. My 4th case was filed immediately after my retirement in August of 2020. And the reason why they're difficult to file is because only California Department of Insurance really has the expertise to file these cases. The cases are extremely complicated and multifaceted, and because of that, they take a lot of time. The crimes range from simple grand theft for basically stealing money for monetary instruments to forgeries for passing certificates of insurance, which are monetary instruments. But the investigation of these require specialized units such as computer forensics. So when we serve a search warrant, we're going to get all of their data, we're going to get all of their payroll records, and we're going to get all of their internal and external communications from their email. That's all vital to criminal prosecution. But they also require forensic audits, especially if you're going for theft or premium fraud issues. And these are very, very difficult to find in California. In fact, the entire northern part of California, which is Bakersfield North, if you're familiar with the state, that's a lot of territory. There's one forensic auditor at CDI. These cases don't offer a lot of bang for the buck as far as stats go. The dollar amounts are huge, but I had one case where I actually got it filed. In California, it was a 64 billion case, but they were also operating, they were based out of Georgia and operating in several other states, including South Carolina. We figure it was really 120 to 200 million, the best we could track by audit. I arrested 4 people for that. So from a time frame, it took 3 years to investigate and file. The state flew me to Georgia several times. And there wasn't a lot of bang for the buck for that case from a statistic level because I only got 4 arrests for that case. And the idea that I was actually going to get money back, it's very low because many of these fraudsters, even if we do asset seizure, they're very clever, their assets are offshore or they've spent it all. California Department of Insurance is drastically understaffed like many law enforcement agencies right now. And they often, well, most often they deny cases, even good cases, for lack of resources. Injured workers in California in these cases are most often vulnerable populations that have low skill levels, no English for the most part. The percentage at one time I had was 68% of the workers in one of my cases didn't speak English, and they were 95% Hispanic. And they have limited employment options. And because of that, they're easily intimidated and silenced. And I'll just add here that an important part of PEO and staffing fraud is making sure that claims go away. And this is a perfect workforce to do that with because they don't understand their rights under workers' comp laws. And they don't often, they want the job. They need the job. That's why they came to the US. And so they are easily intimidated and silenced into not pursuing claims. For all of these reasons, this type of workers' comp fraud involving staffing and PEO is rampant and unchecked. And that's a polite way to say because it is out of control.
Let's talk a little bit about our approach. One of the reasons we came together as a trade association was to address the challenges that Polly's been talking about. We want to encourage our stakeholders to join CalSARA and commit to combating fraudulent practices. And I'll talk a little bit about our code of conduct. We want to develop educational materials and presentations to inform people about fraud and to empower them to fight fraud in their businesses. We want to participate. We don't think we can do this by ourselves. So we want to participate in coalitions and joint efforts to address and expose fraud. We want to identify and assist whistleblowers. It's awfully hard, as Polly mentioned, people have limited English proficiency and when they know something's wrong and they want to come forward, there needs to be a safe haven for them. And so we want to act as that safe haven. And we want to pursue litigation to hold fraudulent actors accountable. One portion of our association is a litigation arm. And one of the reasons that we're here is because one of the first things we did in November is we sued one of the largest workers' comp fraud companies in the country.
So when we file litigation, what happens is we receive a fraud referral. We sometimes receive them on the CalSARA portal. Sometimes people call me directly, or sometimes insurance brokers will actually send us information. We use the Unfair Business Practices Code from the California Business and Professions Code 17200 as our basis. we do this because California case law has allowed for any sort of business practice that offends public policy, is oppressive, that causes injury to business or markets, that is unscrupulous, unethical, or immoral. So it gives us a pretty wide breadth of ability to go after people. The other thing that we have done is looked at aiding and abetting, which is a criminal statute. Obviously, we're not going to file a criminal case. So what we have done is used civil conspiracies in California. This requires the plaintiff to provide us with CalSera to provide evidence that the defendant had knowledge of and agreed to both the objective and the course of action that resulted in the injury, and that there was wrongful act committed pursuant to that agreement, and that there was resulting damage. And I can tell you in the number of cases that we've taken into CalSera to date, which I'm gonna say we're litigating 3 right now. And there's 6 others that I've done the initial investigation on. It's not hard to prove. In fact, it's very easy to prove. And I actually, as Mark mentioned, we like to work with other partners. We also package them. I notify CDI of them and let them have a chance at taking the cases, but ultimately I've been taking them straight to the county DAs, and that's been very, very fruitful and successful, and almost all of them have been accepted for prosecution in a criminal sense.
Our membership includes staffing agencies, brokers, PEOs, and others, and we ask that they support our association, of course, with dues. And also, as I mentioned, we have a litigation arm, and so we ask for contributions to our litigation fund to pay the lawyers. One of the things that we understand is that workers' compensation fraud is multi-directional. It's not just insurance companies purporting fraud on staffing agencies. It's staffing agencies trying to get by and either going around or violating the rules. So we ask that our members sign a code of conduct that says they will not be involved in these sorts of activities. And since this is the 21st century, we provide them a digital badge. And what you're seeing, all the CalSera graphic is in fact a digital badge, and we allow them to use that on their materials. And the reason we like digital badging is because if we find out someone has violated our code of conduct, we can take away the digital badge electronically, and they can't use it anymore. They're barred from using it. It won't show up on any of their materials. And if it does, our agreement says we can prosecute them for it. So again, mission is to work with industry stakeholders to create and maintain a fair and compliant California staffing agency marketplace. We're focused on staffing agencies. Our core functions are education, assistance, and as I mentioned, taking action. As we've talked about, we reach out to like-minded individuals and organizations to join forces to identify and eliminate fraud in the workers' compensation insurance marketplace. As Polly mentioned, if we, for instance, one of the large organizations that we're in court against right now, we're adding to the plaintiffs. We're adding that to that case in the federal district court in California. And we're also, as we mentioned, interested in developing and borrowing educational tools to help individuals and organizations identify and avoid workers' compensation fraud. We believe education is a really important part of this. I think sometimes people believe what a fraudulent insurer tells them, and they have no other way to determine whether that's real or what kind of trouble they might get into.
So CalSera, we're going to continue to pursue our current litigation. And I should add that members, we have to have standing in any kind of litigation. So that's why we ask people if they have a complaint and want us to file, they join as a member. I should add that. And we're going to continue litigating and investigating and looking into these practitioners of all different kinds of fraudulent workers' comp activities. Right now, we've got a MIWA that's illegal that we're looking at. We've got a staffing company that was dissuading their injured people. We've got illegal collateral agreements, another MGA that we sued, a big company that's doing most of the staffing in California, and their collateral agreement was not actually approved by the state.
And we're developing and producing educational materials, including webinars, to explore the various aspects of workers' compensation fraud and its impact on the staffing industry and its workers. That includes partnering with our governmental agencies and regulators. But by the same token, one of the things that Polly told me that I thought was very interesting, she was an insurance investigator and a sworn officer tracking these things down. And one of the things we're able to do as CalSera, one of the reasons that we function better as a trade association, is it allows Polly and our other fraud investigators to take any pathway that works. So if we get stalled going up through the chain of command in the Department of Insurance, we can go to a county district attorney. If we get stalled at a county district attorney, we can go to federal court. So that's one of the benefits of building an association like this. And again, thank you so much for letting us talk about it. We're looking forward to a lot of feedback because we are new, and we are hoping to hear from you and any suggestions you have or any ideas you might have, and happy to answer any questions.
Okay, thank you very much. As we get members back up here on the screen, you mentioned that you are a trade association. So you're separate from the state as far as funding and stuff goes, or do they help fund you, or how does that work? And then it sounds like it's a massive job. We got a lot of you got plenty of work ahead of you. How big is your organization, or how many people are involved at this point?
Well, let me answer your first question first, Mr. Chairman. We are an independent 501c6 trade association. So we're a nonprofit, domiciled in the state of California. And we have about 3 of us who are working on it right now. And again, building a dues base. We started in October of 2020. We filed a massive lawsuit in November of 2020. We hit the ground running, but we're trying not to get too far ahead of our supply chain.
Okay, thank you. Other questions or comments?
Senator Page from Arkansas, I have a question if it's all right.
Yes, please go ahead.
Fascinated by this. What percentage of, I'm an engineer. I want numbers. I want percentages. Is this happening? It sounds like in lots of states, and most states are ignoring it, short of you guys being called in to come help in other states. What's the size of the elephant in the living room here? Should we as legislators be finding that number and dealing with it?
Go ahead.
Well, that's exactly why we're here. Part of what we're trying to do is get awareness out. So the cases I were working, they were all multi-state. I might have done the prosecution in California for victims and losses in California, but every single one of them was working in almost every state in the nation. And I would say that, I could name out of 4 large PEOs that were committing fraud, I could say we're in the maybe way above 20 billion, just in what I could quantify for the state of California losses. And that does not cover all the premium loss to the insurance companies. I'm talking about losses to businesses, losses to the uninsured fund in California, losses to everybody down the chain. So are you familiar with the certificates of insurance?
I am.
Yeah. So everybody listed on that certificate of insurance in California under Workers' Compensation Appeals Board rules, all of those are named in any lawsuit, including the EPLI providers for those companies. So it's just a shotgun approach to trying to fix it, but it's not fixing the system. It's just kind of band-aiding the infection.
And one follow-up question, Mr. Chairman.
Yes, please go ahead.
every state involved? I mean, this is occurring across our country.
Yeah, and I think it's just not surfacing. As Polly mentioned, that she's being very kind to her former employer. Sometimes things just get stalled, and one of the most recent fraud cases we were pursuing, the department said we don't have adequate resources. And Senator, as a former lobbyist, my request to them is show me your budget proposal. And where you asked for additional resources to prosecute this sort of thing. And that we want to partner with them, and we don't want to demonize state regulators. What we want to do is have them take more seriously the fraud that's going on. And frankly, it's hard to quantify because there are a lot of people involved, and a lot of people don't know that they're being taken advantage of. And so that one big lawsuit is one of the reasons. When we filed that suit, people from around the country, staffing agencies, insurance brokers said, we know those people. We know, we have lots of problems with them. Thank you for doing that. But that's kind of the big splash that we just started with this small little snowball. And hopefully we pick up the steam that gets rid of at least some of the larger fraudsters. And one of the things we talk about is what if we're successful? If we're successful, that there will be fewer workers' compensation insurance providers because of the amount of fraudulent ones that go out of business. So then how do we handle that challenge? And one of the things we are going to talk about is perhaps market remediation rather than getting big cash settlements that go to who knows who. Use it to rebuild the insurance infrastructure in the state, just like you would if someone environmentally polluted land or water.
Could I add one thing as well, Senator?
Yes.
What I found in my cases I was working was I noticed that a lot of the actual middle level brokers that were involved with the fraudsters were located in a state in the Midwest. And when I would get my prosecution packages ready, I would send it to him thinking, okay, I've done your job. You just do your follow-up and go arrest these people. But I found that this was in Illinois, they only have 5 detectives in the entire state. I talked to another broker who told me that he moved from Georgia to Tennessee because Tennessee's Department of Insurance was not robust either. Where in Georgia, they have a very robust Department of Insurance. They don't have a lot of special agents, they're called there, but they're very aggressive in their actions, and they have a separate workers' comp department. So a lot of it depends on what the states have going as well.
Sounds like the unknown out there is as bad as that box of snakes that you were about to turn over and see really how bad it was and how many were in there. But anybody else? Questions, comments, both online and in the room there? I'm not seeing any. So if you think of something as we go forward, thank you, Mark and Polly, for your comments. And we'll see if questions come up as we get to the end of our meeting. But let's move forward then. Our next speaker is going to talk about the early impact of COVID-19 on the workers' compensation claim. And that will be John Russer, President and CEO, Workers' Compensation Research Institute. So welcome, John. There we got audio.
That sounds better. So, Mr. Chairman, thank you very much. And thank you to the committee members for providing me with this opportunity to speak about the early effect of COVID-19 on workers' compensation claims. I want to stress that this is an early look at the data through the second quarter of 2020, but I also want to argue, and I'll show you with some statistics at the end, that the findings that we present in this study tend to generalize that that the same findings would be found if you were looking at more recent data. So just a real brief note about us. We're an independent not-for-profit. We were founded in 1983. We have diverse membership and funding support from insurance companies, large employers, labor unions, state agencies, and independent rating bureaus. We focus on the delivery of workers' compensation benefits. We don't focus on pricing. There are other organizations that do that. Importantly, we don't make policy recommendations, nor do we take positions on issues. We just present the facts so that all stakeholders can make informed decisions about the workers' compensation system. So we're a resource for public officials such as yourselves, but also for all stakeholders. So I'm going to answer a few questions in this brief presentation. I'm going to talk about how COVID-19 claims have varied across states in the first 2 quarters of 2020 and what are some of the factors behind the variation that we see. I'll talk about non-COVID claims and to what extent the pandemic has affected the number of non-COVID claims in 2020 as compared to the previous year. Finally, a little bit about how time from injury to medical treatment was impacted by COVID. And then I'm going to supplement it with a little bit of state data to show the continuing relationships that we see in the data. So we're looking at 27 states here. We're using a database that WCRI has built over the years of workers' compensation claims. It's a very large database of claims. It's highly representative of many states, including the states in this list. For the study, we're going to be looking at claims with medical or indemnity payments that arose in the first 2 quarters of 2019 and in 2020. For 2020, you may ask, well, were these all claims that were accepted? Interestingly, not necessarily. These are claims that had a payment. In some states, a payer can make a payment to a claimant, but not actually accept a liability for the claim. So first, we'll talk a little bit about COVID-19 claims. And what you see here is the percentage of all paid claims that were COVID-19 claims in the second quarter of 2020. And what obviously jumps out at you from this graph is the remarkable variation in the percentage of COVID claims among all claims across the different states. The state we're in right now, South Carolina, had only 1% of all claims being COVID claims as of the second quarter of 2020. And the numbers rose all the way up to 42% in Massachusetts. So what are the reasons behind the variation that we see? Well, of course, the severity of the pandemic at the time of the data is crucial. Compensability rules play a big factor here. And so I know you've talked about presumption rules and laws and policies in previous meetings. Presumption laws and orders and policies do have an impact on the fraction of all claims that are COVID claims, as I'll show you in a minute. However, there are other compensability factors that come into play. Massachusetts has a pay without prejudice. So an insurance company doesn't have to accept the claim, but could be making payments. And it's a common practice in Massachusetts. And then New Jersey has a special law in place before COVID hit. It's the Thomas P. Canzanella 21st Century First Responders Protection Act that allowed for first responders to receive workers' compensation in the event of an illness due to a pandemic. So these are rules that would have affected whether or not a claim receives payment for COVID. We're calculating our numbers as the number of COVID claims relative to all claims. So if there's a big drop in the volume of non-COVID workers' compensation claims, that also affects the numbers. So a bigger drop in the number of non-COVID claims means a bigger increase in the ratio of COVID to all claims. One thing we found that did not seem to matter was the variation in industry mix across the different states. So for example, the fact that there's a lot of healthcare in Massachusetts really was not a factor behind Massachusetts' high number. So I'll show you a couple graphs to show how some of these factors impact the variation in workers' compensation claims. The colored bars represent the number of COVID deaths per million population in the general population. This is not the workers' compensation population, but among all folks in the state. And there are 3 states, Connecticut, New Jersey, and Massachusetts, that at the time of the study had over 1,000 deaths per million due to COVID. And so those are the states that, not surprisingly, had the most COVID-19 claims at the time. So at the other end of the spectrum, those with the green colors had fewer than 100 deaths per million population at the time. And again, not surprisingly, those are states that tended to have fewer COVID-19 claims at the time. Another issue is the presumption laws in the states. So in gold, we've indicated the 8 states that had presumption laws or executive orders in place at the time of the study. That was through June 30th. Some folks here will know that, of course, there were other laws that were passed after that time period, including New Jersey, for example, in September. But these are the 8 that had them in place at the time. And what you can see is that COVID claims tended to be higher in states where there was a presumption law in effect. So I guess that's not really a surprise. However, again, there are other factors that come into play. Massachusetts not having a presumption law did not affect the fact that it was the highest in terms of the fraction of COVID claims. And the other thing to note here is that there were many states that did not have presumption laws in effect that still had COVID claims up to 5%, and even Pennsylvania and Delaware up to 10 and over percent. So where did we see COVID claims amongst all of the industries and occupations at the time of the study? We saw them in 2 categories of industries: high-risk services and low-risk services industries. The risk is being measured here in terms of the risk of a non-COVID related injury. So it's principally high-risk and low-risk industries that had most of the COVID claims. So what we did a little bit more drilling behind those very broad industry categories. And what we saw was, again, we know this now more and more, is that most of the COVID claims arose in assisted living facilities and hospitals and the offices of physicians. Let's talk briefly about what happened to non-COVID claims at the beginning of the pandemic. We saw a big drop in the number of non-COVID claims during the second quarter of 2020 as compared to the same quarter of 2019. In Massachusetts, the number of non-COVID claims dropped as much as 50%. And in a typical state, the number of non-COVID claims dropped by at least 30%. The red line there shows the percentage drop in employment between 2020 quarter 2 and 2019 quarter 2. And it shows that indeed, there was, of course, a drop in employment as the result of the pandemic during these quarters, but it doesn't account for a lot of the drop in claims. Some of the claims dropped because of a slowdown in economic activity without necessarily a drop in employment. It also related to, of course, things like working from home and social distancing and the like. One thing that's really fascinating is that even though the number of non-COVID claims dropped substantially during this time period, if you looked across the different kinds of injuries, they didn't look that different as compared to 2019. So for example, the most frequent kind of injury, both in 2019 quarter 2 and 2020 quarter 2, was other sprains and strains, and followed by lacerations and contusions. So while there tended to be fewer workers' compensation claims for non-COVID injuries, the distribution looked very similar during the pandemic as compared to before. Very briefly, talk about time from injury to treatment. We all have heard a lot about the potentials for delays during the pandemic in terms of getting medical care. So what we did here is we looked at non-COVID-19 claims with paid medical services during the first couple of quarters of 2020 and compared them to the same quarters of 2019. And then for this particular study, we looked at more severe claims, those with more than 7 days away from work. What we saw was relatively small drops in the proportion of claims that received various medical services in 2020 as compared to 2019. So on the left, those are the quarter 1 injuries that arose either in 2019 or 2020, and on the right, quarter 2 injuries. And what you see is some modest drops in the provision of medical services. Let's take quarter 1 injuries. 64% of the quarter 1 injuries in 2019 64% received PT. Only 61% received PT in 2020, or a very modest 3% percentage point drop in the claims that receiving those medical services. So what we see here is when an injured worker filed a workers' compensation claim, they tended to get medical services during the pandemic, just as they had before. when it comes to time to medical treatment, the number of days before an injured worker receives a medical service. Here you see, in fact, perhaps in 2020, the medical services were delivered a little faster. But essentially, if you looked at this, you'd say they were delivered about as fast during the pandemic as they were before the pandemic. And again, this is, there weren't as many non-COVID claims, but when they occurred, they tended to get the same medical treatment. And this is the number of services provided, both for evaluation and management and for physical therapy. And you can see that the injured workers got the same number of services during the pandemic as they did beforehand. So I'm not going to skip the major summary. So some recent evidence. So I've been showing you evidence about the first couple of quarters of the pandemic through the middle of last year. Does it hold up to more recent data? So what we saw in my presentation from our data was that non-COVID-19 claims were lower in 2020 than in 2019. I'm going to show you some other consistent evidence that suggests that continues to be the case. I showed you that COVID-19 claims were mostly seen in healthcare and social assistance industries, as well as in public administration, which includes first responders. I'll show you that remains the same too. So I'm going to show you some really excellent data from the state of Minnesota, provided by the Minnesota Department of Labor and Industry. And it shows the monthly claims counts for COVID and non-COVID claims. And there are three things I'd like you to draw from this graph. The red line shows the number of COVID claims that arose in each month of the year. And you can see that the number of COVID claims spiked in December of 2020 and sort of surged around the same time as the pandemic surged in Minnesota and many other states during the winter of this past year and into this year. So that's one thing that's consistent. Obviously, workers' comp claims tend to follow the pandemic. So the blue line is non-COVID-19 claims in the previous year before the pandemic, while the yellow line is non-COVID claims during the pandemic. And consistent with what I showed you before, you can see that the non-COVID claims in 2020 have been consistently below the non-COVID claims in 2019. The yellow line has been consistently below the blue line, particularly low in the April-May time period when we did our study, and again in the winter time when the pandemic hit Minnesota. Another piece of data from the Minnesota Department of Labor and Industry is which kinds of workers are filing COVID claims. And you can see, consistent with our data, it's healthcare and social assistance workers, doctors, nurses, the like, and public administration workers, first responders. These folks are covered by Minnesota's presumption law. But what you can also see is that there are some COVID claims arising in other industries where the presumption doesn't cover those workers, including manufacturing and transportation, warehousing, and you can see the other industries that are listed here. So the takeaway here is while most of the COVID claims in Minnesota have occurred in the healthcare and social assistance and public administration where there was a presumption, there are others as well. Let's quickly flip over to Washington State. These are some data that I extracted from a Washington State publication showing that 80% of all of the COVID claims in Washington through February 8th of 2021 were in healthcare and social assistance and public administration. So again, very consistent with the data that we show. So I thank you for giving me the opportunity to present some of our data and some of the other states' data, and I'd be happy to answer any questions.
Thank you, John. Members, any questions, comments for John, or if you thought of anything for the previous two speakers? We've got a few minutes.
So if I may, Mr. Chairman, Representative Lehman here.
Please.
Question I have is, it's maybe it's an odd question, but it's one I've always thought about. Is you're looking at claims data with as much as we went to work from home, were there injuries within the home that became compensable? Because you think of being in the course of your employment, if I fall at my office, I'm covered. If I fall at my home in the course of my employment, I'd also be covered. Did we see any increase in those types of claims?
That's a great question, Representative. And we are not able to answer that yet with our data. We're trying to tease out in the data where the location of the injury. It's not as obvious as it might be in the claims data that we receive. So I think it's something that we definitely need to be mindful of. There are clearly ambiguities about injuries that arise in the home when you're working from home. Were you on work status when that occurred? Another issue that probably will arise is more musculoskeletal disorders. If you look at US data over the past quarter century, there was a big drop in musculoskeletal disorders, carpal tunnel syndrome, the like, as employers put more ergonomics in place. That's not necessarily the case in the working from home environment. So we'll be also looking to see whether we see any rise in those kinds of cases.
Well, because I think your last slide there with Minnesota, if that would track for the US, so that's pretty much not an outlier. When you look at healthcare and social assistance, public administration, manufacturing were the three biggest. Those people were not working from home. The majority of them were in their, healthcare obviously was doing their job in the hospitals, et cetera. So I've always wondered if that played a part, but I'm not sure it really did. It'll be interesting, but I think to your point of more long-term, are we going to see or more long-term injuries that as a result of not having my same office chair, and my repetitive work is not what it was. And so, my muscles changed, et cetera. So it'll be interesting to see that data as it comes out.
We'll continue to follow the data in subsequent years of data.
Thank you. Any further questions, comments? In the room, speak up, or anybody here online? Unmute, let us know. Okay. Well, I want to thank all of our speakers this afternoon for a great job. Before I get to the NER, any additional business, our committee chair, I saw Tom Oliverson was on earlier on the phone. Tom, are you there? Any comments you want to make? Maybe he's not with us anymore. So with that, any other business to come before the committee this afternoon? Well, seeing none, I thank everybody. We got done a couple minutes early, so we didn't want to go overtime with when we're separating you from the next function, which will be the social or dinner or whatever. So with that, we will adjourn for the day, and I thank you. We stand adjourned.